one. If you look at the next sort of interesting trend, it's investors' love for mid and small caps, and that really illustrates the point. Look at that, small cap funds drawing in the highest ever inflows of nearly 6,500 crores. That, is huge in comparison to the 2,100 odd crores that large cap funds have garnered. So clearly the market's preference is towards SMIDs, at least the retail investors. Then let's talk about SIPs. Again, a very heartening figure coming through. The SIP trend is rock steady, and this is also a record high. Last month, June, the number was over 27,000 crores. This month, it's almost 28,500 crores. So even as the market has been sluggish, returns have been tough to come by, investors have been keeping the faith. Last but not the least, an interesting sort of perhaps example of how investors are also getting savvier. They're looking at diversification, asset allocation, which is why this category, which is known as the multi-asset category, this is pulling in more and more money almost on a consistent basis. And this time around, if you look at the multi-asset category, then it's garnered almost 6,200 crores, which is a record high for the multi-asset category as well. All put together, a fantastic month, a month of records when it comes to equity inflows coming into mutual funds.
Okay, Surabhi, thank you so much for that. A month of records that's come in for equity mutual funds and the flows there. But on that note, we're going to step into a very short break. Don't go anywhere. We'll be back with more news flow after the break. Welcome back to Power Breakfast on CNBC-TV18. Now let's get into the updates that have come in between the United States as well as China. Now the United States and China have extended a tariff truce for another 90 days, preventing triple-digit duties on Chinese goods. Trump announced on his Truth Social platform that he had signed an executive order suspending the imposition of higher tariffs until November 10th, with all other elements of the truce to remain in place, which means current 10% reciprocal tariff remains in in effect during this suspension period, the trade talks will continue and both the countries will remain committed to ongoing negotiations to resolve trade disputes and strengthen the economic ties. So that's the update that we have coming in there. But in fact, let's listen in to what President Donald Trump had to say on his relationship with China before signing the executive orders on trade truce extension.
China's been, we've been dealing very nicely with China, as you probably have heard. They have tremendous tariffs that they're paying to the United States of America. And we'll see what happens. They've been dealing quite nicely. The relationship is very good with President Xi and myself.
Now, Freedom Capital Markets' Paul Meeks says that China has a lot of leverage and says that the Nvidia and AMD deal is essentially a reverse tariff. Listen to what he had to say.
I think China indeed has a lot of leverage because they can reciprocate to the tune that nobody else can. It's interesting to me with the Nvidia and AMD deal, which I said in my note is essentially a reverse tariff, something unprecedented. I can't recall when this was ever done before, but of course our president lives in that world to keep everybody on their toes. But in that particular deal, Nvidia and AMD paid the price. So it goes to show you that the Chinese have a lot of leverage and they didn't necessarily succumb. Nvidia and AMD are so desperate for those revenues because it's such a big market, they are paying the price, which I think is pretty interesting.
And this is going to be an interesting week because Donald Trump is also slated to meet the Russian president in Alaska at the end of the week. Speaking to reporters at the White House, he said that he could know within 2 minutes of meeting Putin whether the progress was possible. Also said that there would be some swapping or changes in land between Russia and Ukraine.
The death is incredible. It's the worst thing that's happened, by far the worst that's happened since World War II. So I'm going in to speak to Vladimir Putin, and I'm going to be telling him, you got to end this war, you got to end it. And he wasn't going to mess with me. This war would have never happened. You know, we had a discussion about it one time, and we never had that discussion again. Would have never happened. There'll be some land swapping going on. I know that through Russia and through conversations with everybody, to the good, for the good of Ukraine. Good stuff, not bad stuff. Also, some bad stuff for both.
And let's see what's happened in the U.S. market as well, right? Wall Street, that ended low across major indices as White House officials said that Donald Trump is extending pause of tariffs on China by another 90 days. Now, Dow was down 201 points. S&P 500 fell around 16 points in yesterday's trading session, while Nasdaq was down 65 points. We have CNBC's Bertha Coombs, who's joining in with us to give us a wrap on what happened on Wall Street. Bertha.
U.S. markets were down across the major indexes in Monday trading as White House officials say President Trump is extending the deadline on China tariffs by another 90 days. The Dow tumbling 201 points. The S&P 500 was down 16, while the tech-heavy Nasdaq fell 65 points. American chip-making giants Nvidia and Advanced Micro Devices have agreed to pay the U.S. government a cut of the revenue they earn from selling AI chips in China. President Trump confirmed the unprecedented agreement on Monday. The two chip makers will receive export licenses to sell certain chips in China in exchange for 15% of their revenue from the sales. The agreement came days after the president said he would implement a 100% tariff on imports of semiconductors and chips unless a company was building in the U.S. And automaker Ford announcing a $5 billion investment today to bring affordable electric vehicles to the market. Ford says the funds will create or secure nearly 4,000 jobs at plants in Louisville, Kentucky and in Michigan. Calling it its next Model T moment, Ford says the first vehicle will be a four-door midsize electric pickup that will launch in 2027, starting at around $30,000. That's what's happening here in the U.S. Back over to you in Mumbai.
Thank you so much for that. Now shifting focus as the search for new Federal Reserve Chairman heats up, former Fed Vice Chairman Roger Ferguson says that the candidates under consideration understand how FOMC works and adds each candidate will approach the job differently. Listen in.
I find interesting is, with all the talk of change, 4 of the 5 candidates at least understand something about how the FOMC works. And I think it's hard in each case to discern exactly how they're going to perform. The other thing to recognize is, based on some interpretations from the Supreme Court recently, the president's ability to fire any member of the board is limited. There has to be cause, a little different from people who are actually part of the executive branch. And so I think each one of these individuals will approach the job differently. But 4 of them have been in the room before and know a little bit about the culture and the institution. So we'll have to wait and see what happens.
Okay, on that note, we're going to slip into a very short break. But up next, we'll get you what's happening in the world of commodities. Stay tuned in for that. Welcome back to Power Breakfast on CNBC-TV18. Now we have Manisha Gupta joining with us to give us those updates from the world of commodities. Good morning, Manisha. And a lot that's happened overnight in terms of truce between US and China and some clarification that came in for the gold front as well in terms of tariff.
Oh, well, absolutely. And both of these factors clearly have led to some stability come back into the markets. I'll start with gold first because we did see an all-time high on Friday. And then on Monday, we heard that there is clarity coming in from the U.S. administration, and the U.S. president has tweeted that gold will not be tariffed. And we've seen further decline coming for the prices. Then 33.50 or thereabouts is how it's trading right now. The easing fears of sharp rise in gold import costs clearly have been done away with, and we're looking at some profit taking. Profit taking also coming in as the U.S. has signed an executive order extending pause on the U.S. tariffs for China for another 90 days. And that's exactly the reason that you have seen support come in for many of the industrial commodities. So the gold prices seems to be stabilizing. We've seen metal prices also gain overnight. Steel is trading near 7-month highs. Iron ore futures at around 4-week highs. Aluminum prices have been supportive. And copper, after that very sharp correction from its all-time highs, also seem to be stabilizing right now. So barring gold and silver, which has seen a decline because there is no need for safe haven buying, most of the other commodities are doing well.
Okay, Manisha, thank you so much for that. So that's the latest coming in for, the world of commodities, gold prices, crude and copper is what we're keeping an eye out on as well. But that's all the time we have on this edition of Our Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, to Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 MotoCorp studios. The hope is, after a good start yesterday, there is more to come. I'm Prashant. With me, my colleagues Nigel and Surbi. Guys, good morning.
Hi, good morning, folks. A little bit of, sprinkling of rain here and there once again in Mumbai, which is a relief because otherwise it would have gone away way too fast. So, not bad.
Well, that's right. In a couple of sessions more, it'll be the end of earnings season, which has been pretty okay. But it's a long weekend as well. So let's get straight to the action. We've had a good start to the week.
Long weekend mode.
Indeed.
Already.
Indeed.
3 days to go, but yeah, I mean, so US equities, just to take it from the top in terms of where we are, no real big indication one way or the other in terms of cues as you start today's session. I mean, at least from the US market. Friday, remember, the market was up 1%. We ended 3% higher week on week in US. And there was underperformance here in India. And we kind of sort of participated decently well across the board. But last night, nothing very much. S&P down about 0.25%. The NASDAQ down about 0.3% or so. As I said, neither here nor there, largely. Macro markets are largely quiet as well. The US 10-year yield was down about 1 basis point, nothing actually, 4.2. Dollar index, though, made a move higher to about 98.5. That's about 0.26% up. And oil prices are actually almost flat and unchanged at around $66.5 a barrel. In terms of news flow, again, it is very, very thin. So President Trump has signed an executive order extending US-China trade tariff truce by another 90 days. This was widely advertised, expected, etc., etc. So, basically, it's just happened. There was a press conference which President Trump addressed from the White House and took questions, etc. It was about, of course, Washington, D.C. and what he wants to do there with regards to policing and sort of, getting federal forces as far as Washington, D.C. goes. But, of course, there were questions about tariffs and actually there was one about India, but nothing really new in that sense. On Russia-Ukraine war, and this is the big cue that I sort of highlighted right in the top yesterday morning as well, which is the meeting between President Trump and President Putin, and he confirmed that the meeting is going to take place on Friday. He said that he will talk, President Trump said he'll talk with Ukraine and Europe after he talks with Putin on Friday. So, a lot was said about it, but can you really take away a strong, solid thread from it? This or that? Not really. But the meeting is taking place, so that kind of sort of keeps hopes higher. I'll just quickly come to the levels because there's not very much else sort of noteworthy with regards to global markets. So yesterday, both the Nifty and the Nifty Bank had a decent move, and we've managed to close above the 40-hourly exponential moving average. Nigel will talk more about this, but I looked at the positioning data, which is nothing but FIIs in index futures. Short positions have not meaningfully moved. I think there were about 1.82 lakh contracts short as of Friday's close. That number has moved a little bit to about 1.78 or so. But there's other stuff there which we will address. So there is, FIs are still heavily short. That's the point. And there is room as you go into that Friday event, perhaps for a little bit more covering. Hopefully, that was what I sort of thought yesterday morning. I didn't expect it'll be, a big move yesterday itself. I thought over the next couple of days, because Friday is a market holiday, you get a bit of a lift. Nifty resistance on the way up now, 24,634. And then the 24,847 mark, which is nothing but the 20-day moving average, which is the 24,847 level. Support for the Nifty comes in at the low, which is 24,337. For the Nifty Bank, it needs to close above the high of 55,652, which is nothing like but the Nifty at the recent high. And then the 20-day moving average comes into view if we get past that, which is 56,213. So, that's the overall broad setup that we're working with. GIFT Nifty, I don't think, has got very much by way of a cue, an indication, inclination. It's done about 27, 30 odd points lower with regards to the indicative open that it is telling us. Survi.
Yeah, absolutely. Actually, cues are thin, global as well as local. So not starting with too much of heavy news flow, which could be actually a good thing for the market. If you're looking at the Asian region, obviously, markets are reacting to the fact that China has indeed scored this 90-day extension. It was widely expected. So therefore, you're not seeing any dramatic moves. Minor gains on the Hong Kong Hang Seng. Actually, it's very flat now, not even 1 point higher. The mainland Chinese market is doing better. Shanghai Composite is up about 0.5%. Taiwan is seeing some gains for the time being. The big rally this morning in Asia is in the Nikkei, the Japanese market, 2% higher. Japanese stocks are ripping ahead, led by names like SoftBank. SoftBank has been on a 5-day tear. and that is continuing. Then, a bunch of other stocks, Mitsui, etc., all of them are looking very, very good. The Australian market also hit a record high today. It's anticipating a rate cut from the Reserve Bank of Australia, so rate action and focus over there. So generally speaking, Asia is looking quite okay, which is not what the implied open is suggesting for us. So let's see what actually happens. Yesterday, the bulls finally got a reprieve, a breather after many, many, many sessions with a rebound from largely oversold levels. Now, can the Nifty build on to an advance above 24,500? We'll see. The flows picture. Domestic institutions, as usual, on the buying side, almost 6,000 crores of buying came in. Obviously, there was, large blocks as well that skew the data. But net 6,000 crores of buying from the local institutional side. FPIs, again, after being buyers on Friday, Monday, yesterday, again, they were on the sell side. Sold off cash equities of worth almost 1,200 crores. As I said, not too much of local news flow. We'll talk about, of course, the ending earnings. And many of them are, still lackluster. Bata, for instance, just an example. Soft. Once again, the top line has been weak, but there is some margin expansion year on year, so we'll see how the market reads into it. Tilak Nagar continues to be a very solid set. Clearly, no consumption issues over here. 30% kind of growth, and the stock's done well. That acquisition has been the big talking point as well. So watch out for some of these names. And aside of earnings, Indian Hotels has announced, a small acquisition, buying 51% stake in A&K Hotels for 110 crores and 94 crores for a stake in Pride Hospitality. Now, these are companies that run the Clark's group of hotels and resorts. So we'll see. Largely, the stock has done really, really well, and the market is positive on hospitality as a space in any case. So this remains a watch point as well. But Nigel, you tell us, what are you tracking?
Well, the Nifty yesterday, as we had hinted, that it bounced from oversold levels. Whether you looked at the PCR, you looked at the shorts, you looked at the RSI as well. That was calling for a bit of a bounce, and that's precisely what happened in yesterday's trading session. Follow through, though, is going to be extremely important. Remember, last week as well, we had a bit of a bounce, but we didn't see follow through. Now, this time around, let's see whether or not the bulls actually can drive home the advantage, because we've got a shortened week and you have big global cues as well that are lined up. Now, moving to for the markets on the whole, yes, there was a bit of a short covering bounce. The Nifty Bank ended higher. And for the market on the whole, there was some covering because the open interest was lower. But you look at the FIs, well, very, very mild short covering is what we saw. If the markets can get a hold of themselves, if we can get some kind of positive news flow, imagine if we see a bigger short covering bounce, because yesterday it was only around 2,800 contracts that were covered on the short side, while even on stock futures, well, there was some long addition and there was very, very mild short covering. The short point is yesterday's bounce was not entirely short covering, because the FI shorts, they're pretty much still holding on to their ground. And as you see in percentage terms as well, it's around 91.5%, which is at a very, very elevated level. In absolute terms, the clients as well as the FIs, they have been on opposite ends, and that continues to be the case. 1.2 lakh contracts on the long side for clients, while FIs, they are short at around 1.8 lakh contracts. Moving to the PCR, we had highlighted this yesterday. At around 0.65 odd, you do see a bit of a bounce. That happened. But now the PCR has moved back towards the midpoint, which is at around 1. That's because yesterday's trading session, you had two strikes that were very active. 24,500 put, 24,400 put. Between them, they added close to around a crore shares, with the premium as well coming down. So these put writers, they feel they're back in the game. Which brings us to the levels that we're looking at. On the downside, the 24,350 mark, that's extremely important support. I'll tell you in further detail in just a bit. Resistance comes in. First level of resistance, 24,750, and then all eyes are on the 20 DMA. But the reason I say that 24,350 level is extremely important on the downside, because the last few trading sessions, the lows of the day are in that vicinity itself. So that's the important mark. You don't want these levels to get violated on the downside. One other positive in yesterday's trading session was after many trading sessions, the Nifty made a higher high, very mildly so, but that was good because for 7 straight sessions, we had lower highs that were being made. Which brings us to the Nifty Bank. Yesterday, it did bounce off that 55,000 odd mark. It saw a bit of a bounce, but now we have the 20 and the 50 DMA. That's the resistance mark, which is close to around 600 points away from current levels. So you'll want the Nifty Bank to gradually move towards that level. And since Donald Trump has given a bit of an extension to China, well, I'll keep an eye out on the metal stocks, because normally it has a bit of a positive rub-off since he's extended that for close to around 90 days. So short point being, yesterday was a good trading session from extremely oversold levels. You want to see some follow-through level. You want to see the Nifty go ahead and conquer the 24,750 odd mark.
All right, Nigel, thanks very much for that. So that's the setup as things stand right now. James Knightley is with us, Chief International Economist at ING. He's with us. James, good morning. Great to have you with us on the program. Thanks for joining us. Just a quick word, James, on what can we expect? I mean, I think trade and non-trade stuff, geopolitics, it's all kind of sort of mixed in. If you want to sort of identify this one big dominant driver for markets, I don't know if it is really trade and tariffs or if it is it geopolitics on Friday. What's your sense, James, if I can sort of ask you a slightly open-ended question?
Yeah, it's there's lots of things in play right now, aren't there? As you say, geopolitics, trade, and of course also we're looking at the Federal Reserve. I think there is a lot of hope and expectation in the United States markets that the Federal Reserve will be able to come in, offer several rate cuts, get some stimulus into the economy, get the economy firing, get corporate profits firing again as well. So I think those are the three factors that we're all really looking at, and that's why I think today's inflation numbers are so important.
Okay, James, hi. Good morning to you. For the US market itself, I mean, so far data has been extremely strong and buoyant, right? Now, as the tariff collection has finally begun, what do you forecast going into the towards the end of the year? What sort of an inflation increase would you expect in the US?
Yeah, well, I think, when we look at the growth backdrop and the inflation backdrop, I mean, at the start of the year, there's a lot of optimism about the US economy, the expectation that it would grow about 2.5% this year. Expectations were that Donald Trump would focus on tax cuts, focus on deregulation. And of course, he hasn't done that. Instead, he's focused on immigration controls, he's focused on tariffs, and he's focused on government spending cuts as well. So very different policy mixes. And that's why we've seen the consensus growth forecast for this year really be cut quite significantly from that 2.5% at the start of the year down to about 1.5% right now. Now, also, inflation has gone the other way. Inflation was expected to converge on target, but now, as you say, these tariff-induced price hikes that we're anticipating, some early evidence of that in June. We're expecting more of that in today's July data. Well, we think that can push inflation probably close to 4%. But that's not going to be a sustained story. We're in a very different economic environment to 2021, 2022, when a similar sort of goods supply shock, i.e., the COVID pandemic supply chain strains. Today, we've got the tariffs. Well, that was really amplified back then by a tripling of the oil price, by a red-hot jobs market pushing up wages, and of course, house prices in the United States rising 50%, driving rents higher. We don't have any of those factors this time around. So I think, we'll get inflation a little bit higher, perhaps close to 4%, but we'll certainly be falling again before the end of the year, and I think falling quite quickly through next year, and that will allow the Federal Reserve to come in and cut rates pretty hard.
All right, James, the last time we spoke, you were a little bit hesitant with regard to the Fed cutting rates. But now going by the softest data and going by what we're seeing on ground, you believe that, maybe 2 or 3 rate cuts could be done in this year itself?
Yeah, we've got to remember that the Federal Reserve is different to most other central banks. Most central banks in developed markets target inflation at 2%, and that's their one job. The Federal Reserve has that, but it's also got to maximise employment as well. And of course, the jobs numbers that we got in the most recent report were subdued, were pretty weak, but it was those 250,000 downward revisions to the previous 2 months of data that really jolted the Federal Reserve, I think. The narrative from Jerome Powell, the Fed chair, had been that the jobs market was pretty solid, the economy was pretty solid. Well, when you've had 250,000 downward revisions to 2 months, and the subsequent story tells us that hiring is concentrated in just three sectors of the economy, private healthcare, leisure and hospitality, and government, well, that doesn't signify a robust, solid economy to me, and certainly not to the market, and certainly not now to most people on the Fed. So I think that change in story on the US jobs market really does open the door to those interest rate cuts from the Federal Reserve.
I think, and later today, we have the CPI numbers, right, James?
Yep.
Yeah, so we'll see if that is important. So, it'll be a good question.
Yeah, I was just wanted to sort of round it off and ask James for a view on how you're seeing India amidst this tariff turmoil. And very clearly, I mean, we've got one of the worst deals along with Brazil, but then we're not an exporting economy. But a lot of people are talking about second-order potential effects, James, with whether it's fund flows, FDI flows, business confusion, etc. What is your assessment of India, given this tariff standoff as of now?
Yeah, I mean, we've got to remember, I mean, most countries, and India is no exception, do not rely on exports to the US for their growth. Even in Europe, where it is seen as more vulnerable, exports to the US account for barely 4% of total, economic activity. And this is all really quite manageable stuff, especially if you've got offsetting growth from elsewhere. So, yes, it's a hit to sentiment. It's a creation of uncertainty. But it can also be a trigger for opportunity. And certainly in Europe's case, for example, we have seen government politicians look to take advantage of that and are driving and striving for their own economic policy away from the United States as well. So it may well help India in terms of diverging and looking for alternative trade partners as well.
And that's exactly what our colleagues in Delhi are picking up. Those overtures have already begun. In fact, yesterday we did report that, for instance, there's a greater cooperation that will be now forged with a lot of other markets, including Africa and the Middle East as well. So let's see how these alignments shape up. Thank you very much, James. Great conversation with you this morning. Thank you for joining in today. Well, let's tell you what else we have lined up for you over the course of the next 2 odd hours. At 8:35, the management of Awfis Space Solutions will be joining in to discuss their quarterly performance with us. At 9 a.m., we'll have Praveen Sahai of PL Capital to talk about the sharp fall in AC stocks, the road ahead for the consumer durables sector. At 9:20, Amish Shah of Bank of America Securities joins in. He's our market master of the day, so we'll get their house views. At 9:30 a.m., we'll be speaking with the management of BSE, talk about BSE's quarterly performance and the path ahead, considering lots of regulations are still being spoken about. After that, we'll have A. Balasubramaniam of Aditya Birla Sun Life AMC joining in to talk about the stellar equity inflows that we saw the mutual fund industry draw in July. And towards the end of the show, in our special segment, It's the Economy, Lada will be in conversation with former Deputy Governor S.S. Mundra and Bernstein's BFSI expert Pranav Gundapalli on the impact of ICICI's sharp hike in minimum balance in its savings accounts.
We'll take a short break. We come back, we go full throttle on stocks that we're tracking for you in our special Top 10 segment. For the time being, I'll run you through the list. Indian Hotels and Tilak Nagar Industries will react to positive news flow, while we have way more number of stocks that are part of our top 10 that will be reacting to negative news flow. Hindalco, Dr. Reddy's, Auto Pharma, MediAssist, Bata, Astral, Praj, and Titagar Rail Systems. All of them will be reacting to negative news flow. We take that break, come back, get into further detail on all of these names.
Welcome back. Well, it's quiet cues as far as the implied open is concerned, though Asia is looking at a pretty decent rally, but it doesn't seem to be rubbing off on us here. I mean, the other markets I'm talking about, mainland China, Japan doing really well today. Implied open about 7 points lower. Let's see if the bulls can actually build on their good form from yesterday. There are plenty of stocks to go over as well. Last of the earnings coming through and an acquisition by Indian Hotels. So let's straight away get to our list of top stocks to watch. Nigel, kick it off. Hindalco, how do the numbers look?
Well, Hindalco, will be in focus because Novelis came out with its set of numbers. So we'll analyze that. And later during the day, we'll get the India business numbers. Now, Novelis's numbers were softer than expected. The EBITDA per ton came in at around $430 per ton. The street was bracing for a number of around $450 per ton. Why is that? Scrap prices were elevated. That's point number one. That's the input cost for them. The product mix itself was not that great because the demand for cans was good, but unfortunately for specialized products wasn't that great, as well as auto. And also the tariff impact is clearly showing up. So the shipments were up by close to 100%, adjusted EBITDA was down 17%, and on a per ton basis, it was down by close to around 19%. The tariff impact they've quantified for the past quarter, it was around $28 million. And since we don't have a breakthrough, they're bracing for a $60 million impact in quarter two itself. And the chart should come up for you. The EBITDA per ton, well, it's come down to close to $430 per ton. That's down from around $490 per ton. Even in absolute terms, well, it's down to around $416 million. So the EBITDA performance, both on a per ton basis as well as on a absolute number, that did dip. But management is sounding optimistic about things improving from here on. They're calling for a bottom on EBITDA in the first quarter itself. They're saying because of the cost-focused measures, things will improve, particularly in the second half of the year. And in terms of the cost saving, they are now guiding for $100 million. What adds to the pain is that the net debt number as well has moved up marginally, and it's at the highest we've seen in the last 19 quarters. So weak set of numbers coming from Novelis. The only solace is that the management is calling out for bottoming out of the EBITDA number. So expect a tinge of red on that particular stock. Moving to Ekta, she's here to tell us about Dr. Reddy's as well as Oro Pharma. Ekta?
Well, yes, a couple of these pharma stocks, in fact, are going to be in focus because the US drug regulator, the US FDA, has approved 2 generic versions of the drug iron sucrose, and it is approved by Viatris and Amphstar. So those are the companies which will be able to sell the generic version of iron sucrose in the US market, and both may be eligible for 180-day exclusivity. Now, iron sucrose, remember, is an important pipeline product for the likes of Dr. Reddy's, Aurobindo, Sun Pharma, Gland. All of them were vying for this particular product, but now 2 other companies have entered the market. The market is around $500 million. What this means is because no Indian company has received approval for it, then maybe it could be a dwindling opportunity, a lost opportunity if in case the approvals do get delayed, and hence we could probably see these stocks a bit in the red on account of this.
All right. Thanks very much, Ekta, for that. So keep an eye out on those names. Indian Hotels is the next one. Vinny's got details here. Vinny, morning.
Good morning. So yes, keeping an eye out on Indian Hotels, we're expecting green coming in for the stock today after the company has acquired 51% stake in ANK Hotels as well as Pride Hospitality. This is for around 204 crore rupees. Now, what this will do is this will add mid-scale hotels to Indian Hotels' overall portfolio, and this is expected to be completed by November 2025. In terms of overall strategy, also strengthening its presence across geographies and mid-scale segments, expanding its portfolio by 135 hotels, as well as this is aligning with the strategy that Indian Hotels has of asset-light growth is what they want to focus on. So that is something interesting that is coming in there in terms for the acquisition from the company.
Okay, all right, got that. So Indian Hotels will be on our radar. Well, as usual, expecting some more blocks. We have Nimesh joining in with what the action today could be like. Nimesh?
Well, Surabhi, another day, another large block. So there is a clean-out trade in Medi-Assist. One of the promoter entity, Bessemer India, is looking to sell its entire 15.7% stake via block deal today. The floor price is 507, which indicates a 4% discount to yesterday's closing price. Interestingly, after this block deal, the total promoter holding will fall to below 5%, and the institutional holding can go up to as high as 75%. So a large block could open in the red if it's not in the block window. But the interesting point is that the promoter holding will fall below 5% after today's block.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's go to Vinny. She's here to tell us about Bata India. Vinny, it's not running away.
Yes, it's not running away. Soft quarter again that's come in for the company. Now, overall, EBITDA also this time has been a bit muted. Lower other expenses is what has come in for the company. Though optically you see and you'll feel like the profits are lower because there was an exceptional gain last time. But other than that, what you're seeing coming in, flattish revenue growth, 9th consecutive quarter of revenue growth that has been subdued for the company. The average selling price that we're looking for the company has also been very muted and declining for the 3rd consecutive quarter. So overall, demand hasn't been exciting. Weather was not something that was supporting overall Bata sales as well. And one more weak quarter and subdued quarter for the company is what we're seeing. We could expect red on the screen for the stock.
All right, Vinny, thanks very much for that. Astral is the next one we want to focus on. Ria has got details on this one. Ria, morning.
Well, good morning. Astral has reported quite a weak set of numbers in Q1 of FY26. Revenue lower by around 1.5%. The EBITDA and net profit have taken a hit of around 14% and 34% respectively on a year-on-year basis. Margins have also declined by around 191 basis points. Even if you look at the individual segments, the plumbing business and the paints and adhesives segment of the company, the margins have fallen quite a lot for each of these segments. Volumes for the plumbing business are largely stable at around 56,000 metric tons. Now, commenting on these results, the company has said that overall the demand scenario in the polymer industry was weak in this quarter, and that the PVC price volatility that we've seen over the last few months has resulted in inventory losses and also affected the realizations. But going forward, what they've said is that PVC prices have actually been seen settling down since the beginning of Q2 of FY26, and market conditions have also been seeing some improvement. So the outlook remains positive for the quarters ahead. And another bit of news flow to keep your eye out on, they've also approved the proposal for the acquisition of an 80% stake in a company called Nexalon Chem Private Limited, and this will be done to manufacture CPVC resin, which is a key raw material for the company, and it's expected to help in cost optimization for the company as well as a substantial margin improvement once the operations start from the second quarter of FY27.
Okay, all right. So positive commentary coming in from Astral there. Thanks for that, Ria. Let's move across and go to Vamakshi. Vamakshi is looking at Praj Industries numbers. Morning, Vamakshi.
Good morning, Survi. Not such a great set for Praj Industries. The revenue dipped by almost 8% on a year-on-year basis. The EBITDA margin contracted by almost 825 basis points, given that operating expenses actually rose this time around, and the EBITDA contracted by 66%. Take a look at the net profit as well. A 94% cut is what we're seeing as far as the net profit is concerned. But also keep in mind that this could also likely be because in Q1 of FY25, there was an exceptional gain of around 28 crores, which was on account of a profit of a sale of land. But even accounting for that, there is definitely a fall in the net profit. As far as segment-wise revenue is concerned, bioenergy, which is one of the largest segments for Praj, saw a dip of almost 24%. On the other hand, this was offset by a 29% jump in engineering and a 41% jump in high purity. Now, this time around, the performance was impacted on the back of a couple of factors. First off, the domestic ethanol business witnessed some delayed execution cycles as well as liquidity crunch. This was mainly on account of the problems at the customer's end. The GenX business incurred expenses with no corresponding revenues, and of course there was delayed execution of a couple of high-value engineering orders, which led to higher labor costs as well as infrastructure costs. The ordering activity too dipped by almost 11% this time around. So given those details, not such a great set coming in for Praj Industries.
Okay, all right. Thanks a lot for that, Vamakshi. Well, let's go back to Vinny. Very busy morning for you. You're tracking Titagarh Rail as well as Tilaknagar Industries. No slowdown there. People are tanking in the brandy.
Absolutely. But first, let's talk about Titagarh Rail. That stock, we're expecting a muted performance that we saw in Q1. So red is what we could see on the screens. Now, revenues are down by around 25%. EBITDA margins down by 27%. Margins have seen overall contraction as well of around 20 basis points, more than that. Now, what is impacting them this time is the weak performance that's coming in the freight railway system segment of theirs. That has seen a contraction of around 27%, and that is dragging the overall revenue growth of the company. Now, in terms of wagon dispatches, also that has been weak in the railway wheel factories, and that is the reason why we're seeing lower growth coming in for freight railway systems. So, company and management is saying that they're confident of recovering the loss in by the end of this year. Production has started normalizing by the end of this quarter quarter as well. So that will be interesting to watch out for. Wheelset supplies by the end of July have normalized, so not much of a concern that we could see coming in Q2 FY26. And they're expecting FY26 to see similar offtake in terms of wagons as we saw in FY25. Now, talking about Tilaknagar Industries, great set of numbers that's coming from the company, doubling in terms of profits. 88 crores is what the profit is at versus 40 crores last year. Good growth in terms of revenues. Margins are at a multi-year high as well, 23.1% versus just 16% last year. So clearly a good number that's coming from Tilaknagar, and green is what we could see today.
Absolutely. Starting the year on a high. That's the Tilaknagar Industries. Got it, Vinny. Thank you very much. So let's quickly recap our list of stocks to watch. The ones that have positive news flow around them this morning: Indian Hotels and Tilaknagar Industries. That's 8. And then you have 8 on the red side today, including Hindalco, Dr. Reddy's, Oro Pharma, MediAssist, Bata, Astral, Praj Industries, and Titagarh Rail Systems. So a mix of slightly weak earnings and some negative news flow from the US FDA for the pharma companies. Okay, so that's our top 10 list for the day. Let's look at what's happening in the world of commodities as well. Manisha is joining in as always. Morning, Manisha. So tariff, non-tariff, this whole gold business, finally it's not tariff, right? That's the final verdict from Mr. Trump.
Well, yes, a formal, proper notification is yet to come. But then U.S. President, when he tweets saying gold will not be tariff, you understand that. And that's the reason you've seen the gold prices decline so sharply. We did see an all-time high at 3,530 on Friday. It's trading at 3,350 right now. So we are down $250 an ounce from those kind of levels there. And overnight as well, it has been another 1.5% of a cut coming into the market. So this clearly is easing fears of sharp rise in gold import costs. And that is what the markets are working with. Also, apart from that, the U.S. signing an executive order extending pause on U.S. tariffs on China for another 90 days also has led to no more safe haven buying when it comes to gold and silver as well. Silver, by the way, fell nearly 2% overnight. So we're looking at huge profit taking in all these precious metal commodities. What is doing well actually has been the crude oil prices. After that 4.5% decline in the previous week, we're looking at some stability coming back. U.S. has signaled that there would be no new sanctions on Russia crude until the talks continue. So that is what the markets are reading in right now, and that is what has led to some support across metals as well. So copper, steel, iron ore, all trading in the positive.
Okay. All right. Got that. Thanks very much, Manisha, for the update. We'll take a quick break on that note. On the other side, we have the management of Awfis Space Solutions joining in to discuss their quarterly performance and, of course, the outlook for the rest of the year. And after that, we'll have Amnish Agarwal joining in for some fundamental stock ideas.
Well, Office Space Solutions is a stock on our radar. The company posted a strong performance actually in Q1. Strong revenue growth, improvement in margins. Let's talk in detail about the quarter gone by and the way ahead. Mr. Amit Ramani, the chairman and MD, joins us on the show. Hi, Amit. Good morning. You're walking the talk. Solid set of numbers. Give us a few details. What was the seat addition in the past quarter? Could you tell us for the year as well? What is it looking like? And how much of it, in the past quarter was via managed aggregation?
So, Nigel, the seat addition has been fairly strong. We today sit at about 232 centers. 155,000 seats is the total. And we have another LOI signed of another 10,000 seats, which takes it to about 165,000 seats and roughly about 13 additional centers. So 246 total centers is what we are targeting. The seat addition for this year, same as last year, we are targeting about 40,000 seats to be added. This year, we have clear visibility of about 30,000 right now, and another 10,000 we will add over the next 8 odd months.
Okay, all right. So by the end of this year, we'll be around 200,000.
No, so by end of this year, we'll be 175,000.
175
at 135. And
all right. So you've added already 15. Got it.
The ratio remains the same, which is 65-35 split. So 65% is managed aggregation, 35% is straight lease.
Okay. Mr. Ramani, so, can you tell us how the year is looking in terms of overall EBITDA margins, etc.? Are there any renewals coming up where you would hope to renegotiate those leases higher? And just give us an update on the GCC side of the portfolio as well.
So I think EBITDA improvement, as we had given the guidance earlier as well, I think will remain almost along similar lines. So if I look at the current quarter, we were at about 37%. So I think it would stay in that range for the remainder of the year. In terms of the GCC portfolio, the mid-tier GCCs, which is the first-time entrants, I think has seen a large growth out of the 50-odd GCCs that came to India over the last, I would say, 9 odd months. About 9 are with us. So I think a very, very strong part of our portfolio. These companies include Meltwater, ABC Fitness. So I think we feel that that is certainly an area where we see a great potential and large growth. If you look at last 20 years, there were some 1,500 odd GCCs. In the last almost 12 months itself, there's 200 plus GCCs that have been added. And I think the prediction is very strong to be about 2,600 GCCs in the next 4 years. And we obviously want to play a big part in that growth journey.
Amit, hi, morning. But the larger companies, American multinationals, etc., who come and set up their captives here, I mean, typically they'd want their own infrastructure. I mean, entire facility sort of leased out, kind of model. That's what we've heard from consultants, etc. Who've spoken on this.
Right. The larger GCCs that are already established in the country or already have a presence, they would like to do their own, obviously, leasing. But from our standpoint, as you are aware, we do a design build service, which is a fit out service. So they clearly engage us for those kinds of services. And that's already happening with a couple of our clients where they have done the lease, but we are doing the design and the build service for them. So clearly, I think we play a role there as well.
So you will, I mean, you do the fit out, etc., design, fit out, etc., and then you do the maintenance as well.
No, in many cases, they essentially hire us for doing the design and build. We do the build out and then we basically walk away. They do their own maintenance.
So it's like that would be like a one-time revenue stream in that situation, right?
That is true.
I just had one more question. Your business, I'm assuming, office space is linked to the economy, right? I mean, and whether the economy is the margin, it's all relative, of course. I mean, slows, picks up pace, etc. Over the time that you've operated the business, how sensitive is your business, the office business, to this? Because there seems to be a little downward pressure, not just here in India in terms of growth, but globally as well. How sensitive is it? Or you think the more important trend is, cost efficiency, cost savings, which corporates are looking for, and that move will more than offset any growth slowdown?
So if you look at the industry, in 2020, March of 2020, this industry was about sub 20 million square feet. Today, we are touching almost 80 million square feet. And the projection is in the next couple of years, we should cross 100 plus million square feet, right? The industry is growing at about 20% CAGR. It's almost 20% of the total commercial leasing. 80 million square feet was the total leasing last year. 16 million was flex, as we saw. So I think very, very strong trends. And I think it's a behavioral change that has happened. I think corporates, the large corporates look at it for flexibility and speed, and obviously distributed work where they want to set up maybe, sub 500 seater centers. But the mid-tier and obviously the SMEs for sub 250 seats, I think this is a behavioral shift. And this will continue, I think, for the long term.
Sure. Mr. Ramani, just to go back to that point, like you were explaining to us that you do provide these fit-out solutions for large GCCs, and that becomes a revenue stream in itself. Like that, you have a lot of other allied services as well. I think you're looking at cafeteria management, there's mobility. So give us a view on all of that. How much do they contribute to your overall revenue today? And where will that number be, say, a year or two down the line?
So last year, this contributed roughly about 11% of our co-working revenue, right? Because that's where this service is part of. So which was roughly about 100 odd crores out of the total 1,200. This year, the target is to be about 155 crores, which would be roughly about 15% of the co-working revenue. And we feel that this area has tremendous growth. We would like to make it grow, obviously, closer to about 20% over the next 2 to 3 years. And clearly, I think the offerings that we have added, which is food and beverage cafeteria management, which we do for third-party independent, the mobility solutions, which is day passes and virtual offices, and in addition, our office tech labs. And also, we are launching our furniture business as well this year. So I think all of this will start contributing a decent part of our overall revenue. As I said, roughly the target this year is to be about 15%.
Okay, and total revenue CAGR with all of this kicking in, I mean, the first quarter you've done really well, 30% growth. So just a CAGR over the next, say, 2-3 years, top line, what would it be?
I wouldn't comment on 2-3 years, but clearly the guidance for this year is we will do about 30-odd%. And I think we are well on track for that.
Okay. All right. We'll leave it on that note. Thank you very much for joining in, and good luck for the rest of the year. That's Awfis, and everybody is going to Awfis, and seems their business is doing well.
You have now what? In quick order, you have 3-4 listed businesses in this space, right? Smart Office is one. There's Office, of course, the older one. There's one more, which just came to the market, right? So I think at least 3 listed
and then we have
co-working businesses.
Yeah.
And I think there is one more coming, which is, I don't remember the name, but I think there's one more in the pipeline, which is going to, and that's the largest, by the way, which is...
Are you talking about, but that's the REIT, the Knowledge Realty Trust.
No. The next REIT is the
Knowledge Realty
Bangalore,
Trust, which is the Blackstone one.
Blackstone and the...
Yeah.
I think there's another co-working sort of company coming to the market.
We'll get into it. We'll look it up. But let's quickly bring in Amnish Agrawal into the conversation as well. Amnish, good morning. Lots of stocks to discuss. Plenty of numbers have come by. Most have been, weak to lackluster. Bata, Praj, Astral. Nobody's lighting up the charts. But you tell us it's all about looking forward, right? Now, this quarter is over and done. Among some of the names that I mentioned, which have all reported in the last 24 hours, would you look at buying anything? Would you look at buying into the weakness for either a Bata or a Praj, say?
Okay, hi. So I think we need to look at objectively that 1Q had few disturbances, like, for example, few days of sales were lost everywhere due to operations improved. Then we had early monsoons. And to that extent, I think 2Q in general should be better for the industry because we have early festival season starting this year. But having said that, I think one also needs to look at what happens on the, you can say, the tariff front with US. Because the inflation is already down, monsoons are normal. So if you look at broadly, the domestic part doesn't look bad unless and until due to some global geopolitical issues or something, there is some global impact on demand and there are some job losses due to that. So as far as these particular stocks are concerned, I think one can't paint them with one word, say, for example, Parag from last couple of quarters, it has not been doing well. Its new facility, I think they were hoping a lot to export to the US. So I think one needs to wait and watch that what sort of a ramp up which happened at the new facilities. Similarly, if you look at, say, Nestle, the demand in the plumbing side has not been that great. There is some sort of, I would say, a slowdown. And it is, pipes has been, you can say, average for them. But the stock definitely from the peak, it is significantly down. So maybe I think in the near term, the visibility on some of these names, it remains slightly hazy unless and until one takes slightly longer term view in this.
All right. Hi, Amnish. Good to see you. Prashant, by the way, another smaller company is EFC, which is into the similar space. It's been a big wealth creator as well. And now we have a lot of mutual fund participation as well in that counter. Amnish, any view on this space? Awfis, we just had the management. Any comment on that? What do you like?
You see, I can't give you any stocks for that, but nonetheless, I think with the GCCs growing well in India, and practically now the growth in GCC is far, far higher than IT services, which we had seen over the last couple of decades. And there is a trend that people want to go into co-working spaces because of the, I would say, the low capex involved and some of the other benefits which they are having. I think this space holds a lot of potential. But having said that, it will depend upon I would say, how the current situation around whether it is tariffs, whether it is around, you can say, doing multiple deals with, you can say, various countries on that. I think in the longer term, the space definitely holds a lot of potential. But one will also have to be cognizant of the valuation because some of these stocks today are trading at quite a good, I would say, premium over the general market.
Okay, all right. Let's talk about Hindalco. Novelis's numbers were expected to be weak. They were weaker than expected. But going by the management commentary, they are saying that they believe now the EBITDA has bottomed out. And that's taking into account that the tariff hit in the first quarter was around $28 million. For the second quarter, going by the current tariffs, it could be in the vicinity of close to around $60 million. What would your view be on the stock if it opens lower?
You see, in general, one has to look at that, you see, Novelis is an important part. And now US tariffs are actually a reality. Whatever one might think, whether they will go back to where they were earlier for any country, practically that is something which is very difficult to say at this point of time. So there could be, say, some sort of volatility due to that. But the practical thing also is that if you want some consumption industries to be there in your country because US has got very limited production of lot of stuff, then definitely you will have to make some adjustment. The prices have to go up. So after the knee-jerk correction, usually the stability comes, and that will also be reflected in the, you can say, the margins of some of the companies which are operating in US. Because in US, I think everyone who operates there, who manufactures there, so people have been passing on the costs to the consumers. So I think based purely on this economic logic, I think the margins definitely, I think they would have bottomed out or they will bottom out in most of the cases in another quarter. And I think after that, it should be more steadier than what we are witnessing or what we might witness in 2Q of this year.
Got it. All right. Amnish, I'll tell you what, I think we'll just take a short break. We'll come back. We'll continue our chat with Amnish and also we'll get in our technical experts. Mitesh and Sudarshan are waiting for you on the other side.
investing.
Welcome back. There's 9 minutes to go for the pre-open session. Sudarshan Chugani and Mitesh Thakkar are with us with what they want you to do. This is 0.6 point change on the as far as the implied open is concerned. So absolutely flat. So you know, can go in either direction. I think the Mediasis large deal has gone through. 1.1 crore shares have changed hands. And that's a deal worth nearly 600 crores at about 523 rupees per share in the block deal window. That's about 16% equity, which Bessemer has sold. And we'll, of course, later try and get a sense of who the buyers on the other side have been. But looks like it's gone through without a problem. Sudarshan and Mitesh are with us, as I said. Gentlemen, morning. Mitesh, you go first. How are things set up after yesterday's 200-point move?
So I think, it to me looks like a case of a strong bounce back, and we could see a bit of extension. The GIFT Nifty is of course indicating a mild gap up as well, but the level which I highlighted yesterday, that was also around 55,750 or thereabouts. So there could be another about 150, 160 odd points to go from here. That's where you need some moving averages on the charts, and therefore that should be the first target. We still haven't got a conclusive reversal sign on the daily charts. Some intraday charts have turned on the upside. So I think I would presume that around 24,750, 800 zones, you will see some good profit booking coming in. So if people have long positions, I think that is the zone people should look to take profits out.
Okay. All right, Mitesh, got that. Let's also ask Sudarshan whether he'll take a trade on the indices today. Sudarshan, what did you think of yesterday's 200-point rebound?
Yeah, good morning. Well, it was welcome. And the markets were oversold, and it was a question whether we would bounce back. We did. So the trade is very simple. If you are an intraday trader, today also you look for some dips to take an intraday trade. I would not suggest carrying any positions. The date when we want to carry positions is Thursday. When we have an extended weekend, there is a reasonable amount of risk and a very decent reward that would emerge that day. For today, take intraday trades on the long side. Do not carry any positions.
Okay, got it. Don't carry any positions. Sudarshan, what about stock specific though? You'll have a few ideas for us?
Well, yes, usually, the stocks are mainly on the buy side, and that happens today also. Zydus Life is a buy with a stop under 936. PFC is a buy with a stop under 411. ONGC is a buying opportunity with a stop under 229. And Supreme Industries is a buy with a stop under 4260. So there are 4 mid caps, all for buying.
Sudarshan, thanks for that. Mitesh, what about you? What are your trades?
I have buy calls too. A buy on L&T with a stop at 3640. And here I would look for targets of around 3730. Policy Bazaar is a buy as well. Keep a stop below 1838. Look for targets of around 1910. Buy on Biocon. Now the stock has corrected from 400 plus levels to about 335, 330 zones, and is bouncing back. So a short-term bounce back trade can take place here. Buy with a stop at 337, exit around 355, and Colgate-Palmolive is the final buy call. Buy with a stop below 2194 for targets of 2255.
All right, Mitesh, thanks. Sudarshan, thanks for that. We'll come back, speak with you at 9:10. Take a quick commercial break here. We're going to come back in just a bit from now. Praveen Sahai of PL Capital also joins in on the other side. We talk about the sharp-fallen AC stocks, Amber, Voltas, PG Electroplast, of course, and the road ahead for consumer durables in general as well. Stay tuned. Welcome back. There's 16 minutes, 15 minutes and 50 seconds to go as far as the market open is concerned, and about a minute to go as far as the pre-open session is concerned. We've been, of course, talking about what is explaining India's underperformance, right? I mean, earnings deceleration, of course, is a big one. Valuation still about one standard deviation above normal. Historical averages is another. But I think a lesser spoken about fact, which I alluded to, I think, last week was maybe is the lack of AI stocks. Surabhi, and I think we spoke about it last week, right?
Yeah.
India doesn't have AI stocks to offer.
And the world is obsessed with just AI and more AI.
Yeah. So, I just want to put out some data which kind of talks to this, right? And this is as of end of last week. Look at what the chase for AI exposure has done. Nvidia is now 8% of the S&P 500. It's the fattest weight for any stock in the S&P 500 since 1981. This is, S&P 500 is the largest index in the world. 500 stocks, 500 of the largest stocks in the world. And a single name, Nvidia, is 8% of the S&P 500. So actually, if you think about it, and I may be exaggerating to make a point, 5 or 7 stocks make up the US stock market right now, and all of them are AI stocks. So it's just absolutely incredible what is going on. Just some historical context in terms of where these things have peaked out. Apple has peaked at about 7% of the S&P 500 in 2023. The stock peaked out then. During the dot-com bubble, which is the year 2000, Microsoft and GE were made up about 4% of the market, of the S&P 500, right? IBM hit a high of 6% in 1984. But never before and this is data going back 1981, Nvidia, single name, 8%, beating all these names. And of course, we know the reason why Nvidia has done so well. It sells the chips, which enables the compute, which allows for all these AI advancements, large language models, et cetera, et cetera. So, I think it's just quite incredible. And, the US market narrative, by the way, also has been that tariffs, et cetera, may hurt, inflation may rise, growth may weaken. But because AI-led productivity gains are going to be so large, it doesn't matter. As I said, the US market right now is 5 stocks, 7 stocks for all practical purposes. So, things may go south, but as long as these 7 names are solid and continue to rise, that's it. Just look at this outperformance. The Bloomberg Magnificent 7 Index, which is basically nothing but 7 stocks, which Bloomberg has created an index of, has outperformed the MSCI All-World Index by 220% over the last 5 years. That's the outperformance. That's not the return. That's just, huge. Absolutely huge. On the contrary, if you look at India, right? Look at MSCI India. MSCI India has underperformed the MSCI World Index by about 20% since last October. And this is the underperformance in India that I was talking about. And hence the question. It's just a question. It's just food for thought. Just think about what are the AI stocks in India, right? Do you have can you make a list of 5 names, 10 names which offer core AI exposure? You can say, well, Indian IT stocks do it to some degree, and they're trying to get into the AI thing, etc. But in terms of core AI, I think it's lacking. You got it in Japan, you've got it in Taiwan, you got it in China, of course, you got it in US to some degree, you've got it in Europe as well. Lithography machines, etc. In some way or form, many countries around the world offer that exposure, but in India, that is missing. And I'm not saying this is the core reason why there is India's underperformed, but I think it is one of the important factors which is not talked about as much as the broader theme, which is earnings deceleration, valuations, etc.
Oh, absolutely. And then you look at the bare basic numbers here and now, and they hurt. 1-year return in India for multiple reasons, including the reasons that Prashant just alluded. Nifty is flat, 1% return over the last 12 months. S&P 500, 20% return. And NASDAQ, which has a better representation of all these AI themes, obviously, almost 28% return. It's been a tough last 12 months. But anyway, we've still got hope. At least the domestic institutional investors or the DIIs, the mutual funds, they're still using the spirit of consolidation to build positions in the market. And we'll talk about that a little later on the show. Right now, we're putting the spotlight on the consumer durable space. In fact, I think we'll have Praveen Sahai joining in the next couple of minutes as well. as I think we have him with us now. Okay, we'll get Praveen in a bit. But before we get to Praveen, let me take a question from Amnish on the space itself. Amnish, the concerns are very well documented. This first quarter has been a weak one for companies across the board. The question is, do you buy into this weakness? Would you buy, say, into a stock like PG Electroplast or even a Blue Star? Or would you remain cautious?
The kind of pressure which all the AC companies and durable companies have seen during the current quarter, so that is not something which happens every time. So we had very exceptional circumstances. It happened a couple of years back also. So some of these products are, I would say, highly seasonal. That is one. So if the season goes wrong, if there is, you can say, earlier rains or something else, then obviously you will get some pressure. But that is something which happens with the entire industry. But if, say, there could be players who gain share, there could be some players who are sitting on too high-end inventory, so then that becomes actually, you can say, an issue with the overall inventory situation and with those particular companies. And given the fact that summer season has already now passed, now offloading inventory in 2Q and 3Q is not going to be easy. So without going into any specific names, if any company is, you can say, holding too much of an inventory in the system, particularly in the AC industry, then for them liquidating them without any, I would say, your collateral cost is not going to be an easy. As far as your broader durables are concerned, we might see some sort of an uptick in demand because of the early festival season, which we are having this year.
Okay. Actually, Amnish, we have Praveen joining in exactly for further details on this. Thanks very much, Amnish, for your thoughts. Praveen, let me ask you this question. Straight away, first of all, I don't know if you have coverage specifically on PG Electroplast. If yes, please tell us what your assessment is of the situation. Whether this is a great opportunity because you've got a 30% cut, 35% cut on the stock, or is it still overvalued? Is it still very hazy in terms of when things start to recover?
Yeah, hi, good morning. So PG Electroplast is not under our coverage. But looking at how the inventory situation in the market, whether it's with a brand or a channel like a retailer or a dealers, and along with contract manufacturers like a PG or Amber, things are a bit difficult, I can say, in the coming quarters at least, because now our the BE norm change is also around the corner, and before that, everyone has to liquidate their inventory. So as a commentary from the contract manufacturers, overall inventory level has been doubled right now. So how that's going to liquidate way forward? A lot of promotional activity need to be done by the brands, which will hamper the margin. And so as for the entire system, whether if I look at the retailer like IML or Aditya Vision, they are also talking about promotional offer for liquidation of their inventory. So entire channel was filled with the inventory because of anticipation of the summer were very high. So right now I will be cautious on all the seasonal product companies because the major challenge is liquidation of their inventory in the system.
Hi, Praveen. Good to see you, Ben. But there were various reports over the weekend that indicated that there is some kind of a clawback. Is it too small, to get a little bit positive? And from the pack, what do you like? What would you be most optimistic on post the recent pullback?
Yes, so in the seasonal product, there is the two categories which has underperformed. The one is your cooling product in RSC or in the ECD, the fan category. So if you look at the quarter gone by, Blue Star has outperformed even in this declining scenario. That's an industry decline by around 15 to 30% company to company differ. Whereas Blue Star declined by around 13%, which is outperformance. Even in the margin contracted by around 500 basis points for industry, and for Blue Star is on the lower. So I believe they had a first one to realize that the summer were very tough, cut down their productions, maintain to some extent they had maintained their numbers. So I think Blue Star is well placed in the tough scenario given the good numbers. So I will prefer that. Secondly, on the ECD portfolio, if you look at around 10% of our corrections in the ECD portfolio, we had seen as an overall coverage companies. In that also, the Crompton has outperformed in tough time, around 8% of a decline. There also the correction in the margin were ranging from the 150 to 300 basis points. In that also, the contraction in the margin of the Crompton is quite a lower comparatively. So I think those who has outperformed in the tough scenario are a better placed to bet on.
One of the things is with this entire AC story, right? It almost as if it became so that ACs are kind of disconnected with how hot the summer is.
Yeah.
Right? It's going to be AC to bikega.
You need
if it's not
the whole year through.
hot, not hot.
Yeah.
Maybe in the longer run it's true.
Yeah.
But I think in the short run, in the last couple of years, the narrative became it's kind of delinked. I mean, the product from, of course, I mean,
the
need for it, which is the season. And I think as we've seen in this season, that is absolutely not the case. Praveen, do you agree with that?
Yeah, I totally agree with you that one of the lowest penetrated in this country is RSE, and because of one season we can't take a call, the entire sector. And 2 years back also we had seen the similar kind of situation where the anticipation of the summer were very high, the costs were increased, and the underperformance. So I think in the seasonal product, it's a part and parcel. But the way forward, I believe the long-term growth trajectory is quite a good. The only worry for me right now is the margin profile for the companies because they are within a higher inventory and the liquidation is one of the challenges. Maybe the volume will come, but with a certain price.
Okay. All right, we'll leave it on that note. Praveen, thank you very much for joining in and giving us your view on what we've seen, lots and lots of price damage in the last just 2-3 days alone on a lot of these AC stocks. But for the time being, let's move on and take stock of what's happening in the pre-open session as well. It's quiet. Nifty is down about 21 points. Hindalco is the biggest loser because of those Novelis numbers not going down too well with the market, 2% lower. Nigel's just going to talk about that. On the flip side, actually, we don't have too many polls on the upside.
I'll tell you the biggest stock in pre-open is Astral. The stock is gapped down. That seems to be the accident of the morning. Morgan Stanley note is saying that they have missed their estimates by close to around 10% because the pipes division out there, the volumes, were more or less flattish and they were factoring in 7% growth. And also in the plumbing segment, the margins have come in at 10.4%, which is the lowest in 10 quarters. So that seems to be a bit of an accident in the morning, down 5%.
Absolutely. So Astral we have on our radar and we have Praj on our radar as well. Praj is also down 5%. It was a really disappointing quarter for Praj. So watch out for these two large mid-cap companies. Let's quickly get to our stock experts then for the 9-10 calls. Sudarshan, which stock would you go with?
I would go with ONGC. Buy ONGC with a stop under 229.
Okay. And what about you, Mitesh?
I'll go with the buy on LNT for targets of 37.30.
Okay. All right. Got that, gentlemen. Thanks very much. By the way, since we're talking about stocks on the downside, guess who's starting on a high? Pretty obvious name. Tilaknagar Industries. Great set of numbers. 30% top line growth. Margins looking good. Stocks up 8.5% in pre-open. And this year, when the market struggled, Tilaknagar is already up about 22%. So some green on the screen should also be discussed. But Nigel, back to Hindalco.
Well, that's right. Hindalco, that stock is lower because Novelis came out with a set of numbers and the numbers are a little bit softer than what the street was working with. The street was working with an EBITDA per ton of around $450 per ton. It's coming at around $432 per ton. What went wrong? The cost of scrap was elevated, which hurts their margins. The tariff worries continue and the product mix as well was not very, very great. So that means that the higher amount of can sales and good demand for can, but that was totally offset because the specialized products didn't really sell. So that was the issue with them. The total shipments were up by close to 100%, but the adjusted EBITDA, the absolute number as well as the EBITDA per ton were down by around 17 to around 18%. The tariff impact is clearly coming into play because for the past quarter it was $28 million of a tariff impact in first quarter. But since tariffs have moved up for the second quarter, they're talking about $60 million of a tariff impact going by the current tariff rates. And a chart should come up for you. The EBITDA per ton, the absolute EBITDA number as well has come down drastically on a sequential basis. But the management is saying they're calling out of bottoming out of EBITDA from here on and they're believing that things will look up. You'll wonder how when there's going to be such a big tariff impact. They're focusing focusing on the cost side, and now they're guiding for cost measures which could protect close to around 100, which could save around $100 million odd. Earlier, they were talking about $75 million. So that's why the second half of the year, they're talking about things looking up, because they're looking at mitigating some part of this tariff hit. The net debt level as well has come at the highest we've seen in the last 19 quarters. That's perked up to around $5.5 billion. So put everything together, these numbers go down as a bit of a miss, though we'll have the standalone numbers that will come in by midday. Around 2 o'clock is when we'll get the India business numbers.
Absolutely. And, let's just take a quick look at what the market open is going to sort of start with. And then we'll get down to individual stocks, etc. But we've got movers, right? We've already got a fair number of moves. Astral, of course, is one. Praj is another one, and so on and so forth. Yesterday, of course, it was very positive. Broader markets did very, very well. And there was only one group of stocks which fell, which is, of course, there's all these AC-related names which came under pressure. What do we have? First rates coming through on the Nifty. And then we will, as I said, look at individual names. Absolutely flat for now. 0.14% lower on the Nifty to begin the session. Nifty Bank 50, just sort of, I think, finding its feet, about 0.4 lower, 55,300 on the Nifty Bank. Mid-cap index is flattish. The small-cap index will come up on your screen. I don't think there's very much there as well. Advanced decline, 800 higher and about 500 lower. That's the advanced decline ratio at this point. So this is what's coming through. 123 odd points change coming through. 250 points change on the lower on the Nifty Bank. Nifty heat map will come up, and it's more up than down actually. So Wipro and Tata Steel and Sun on one end, and Hindalco, Dr. Reddy's are some of the names which are coming through on the other side. Surabhi.
Yeah, absolutely. That's a mixed board as far as the large caps are concerned. By the way, I do want to point out Praj, though. Praj is a bigger accident than Astral. And for Praj, the EBITDA itself has fallen dramatically, a 60% drop in EBITDA. Their margin last year used to be over 13%. This quarter, the margin's fallen to 4.9%. Something's gone drastically wrong. We'll analyze the numbers in greater detail. But this is not a good-looking reaction. Anyway, let's talk about the large cap screen. And here, in terms of the downside, Hindalco obviously takes the cake, 1% lower. And there's some selling on large banks, ICICI Bank, HDFC Bank, Kotak Mahindra Bank. Banks are weak. The Bank Nifty is actually starting 0.5% lower. Axis is also down. So banks are really on the lower side. And then stocks like Reliance are not really helping. Reliance is flat, not really contributing too much to the upside. So what is up? Let's see. L&T is trying to offer some counter, 0.5% up on that stock. There's some buying in names like M&M and Hero Moto, even Maruti. So auto is seeing some accumulation, steady accumulation actually last couple of days. There's ONGC, which was Sudarshan's call, 910 call. It's 0.5% up as we speak. And then it starts fizzling out. Some buying on Tata Steel as well, by the way. Favorable commentary from China coming in, US, China, 90-day window extended. But all said, it's flat for the Nifty, but the Bank Nifty is a concern this morning.
Well, that's right, Surabhi, and that's why Hindalco has actually recovered from the day's low because of that deal between, China getting a bit of extension. So from being down 2.5%, it's cut its losses out there, and the management is saying that things will improve from here on. So for the time being, that's bounced up a little bit from the lows. But there are plenty of actually solid earnings reactions. Awfis, we had that management earlier today. They're sounding very, very optimistic about the time to come and about this year itself. Stock is flying away, up 7%. Yatra, it was up 20%. Guess what? Today it's up another 10%. So the street really likes those numbers. Actually, that stock, in fact, has put on more than 30% in a matter of 2 sessions. Tilaknagar Industries, all eyes on how they're going to be moving from a brandy to a whiskey player. But for the time being, the brandy itself is selling enough. So that's why that stock is up 7.5% after seeing a sharp 10% correction in the last few days. Shaili Engineering, that's another one that's actually been one of those big multi-baggers over the years. Then it went through a period of consolidation, but those numbers look quite good. So that stock as well has opened up well in the green. JM Financial, I recall Digantari, when he joined on Finding Alpha, he was talking about better prospects. They've delivered numbers. They've given optimistic guidance. So that is another big gainer this morning. Apex Food, another one that's doing well. And Nelco as well. That's another stock. So there are plenty of stocks actually that are reacting favorably to a good set of numbers. Pull up Nelco. That's another one. HLE Glasscoat, another stock that's actually reacting positively to the set of numbers. So you have various stocks in there that the market's taking note of. They like the numbers. And the stocks, in fact, are seeing a big run. Just add to the list of PG Electroplast. Finally, some kind of reprieve after the kind of selling that we're seeing. The stock has moved into the F&O ban. We told you about this, on closing bell, that there's a profitability. So fresh shorts cannot be added to the system.
Absolutely. I mean, the index is absolutely flat. 24,580 is where we are at on your screen now. So not really running away anywhere. The Nifty Bank was showing a little bit more in terms of pressure. So maybe we just take a quick look at it. About 1/3% lower on the Nifty Bank at this stage. PG Electroplast, by the way, is the #1 gainer, volume-led gainer on the NSE at this point in time. So keep an eye on that one. And of course, I think we mentioned the others, which is Tilaknagar and Shaili and Yatra, etc., which are all jumping up. Awfis, of course, as well, about 7.5% gain. Awfis, of course, corrected quite a bit from the highs. So there is that. And, of course, solid numbers. Medi Assist, the block happened this morning, about 5% higher on Medi Assist, 551. So the deal happened on the block window. So I guess institutions participated, and there is that comfort in terms of the clean-out trade, which has taken place. HLE Glass is up 6%. Hariom Pipes was a big mover yesterday, 2.5% higher. Some of these smaller names, by the way, is where bulk of the action is at. Market breadth, it's early, but out of the gates, market breadth is positive, 2:1 in favor of advances at this point of the day. I'm spotting a few of these defense names which are lower. I'm not sure if there's anything to it, but HAL is down 1.5, Mazgaon is down 1.5, Garden Reach is down 2, BDL is down 2. So keep an eye out in this pack as we begin the day. And all of them, by the way, coming up as within the top 5-6 names on the NSE with regards to volumes, but on the way down, price action. Well, let's welcome in Amish Shah, Head of India Research at Bank of America Securities. Amish, good morning. Great to have you back on the program. It's been a while. Thank you very much, and a lot has happened. We can say a lot has happened, and it's kind of 2 steps forward, 1 step back. Just a tremendous amount of news flow to deal with. But Amish, where are you at in terms of your thinking about what the market is likely to do from here? There is general slight amount of desperation which has crept in about earnings being a little slow. Although when you take stock, earnings performance delivery so far has been better than what the general perception has been. The hard numbers show that. What is your sense, Amish? How do the markets do from here over the next couple of months?
Thank you and good morning, Prashant. So look, I think the incremental news these days is obviously around trade tariffs. But even if you set that aside for a moment, I would continue to argue that the fair value for Nifty is 25,000 by the end of this year. We have stuck to that target for about 14-15 months now. I continue to believe in it. That basically means only about 2% upside from where we are, about 6% upside for a year as a whole. So if you're a long-term investor with a buy and hold strategy, I think this is not a great market for you. If you're a nimble investor, able to play the market volatility, if you can rotate sectors, I think then there is alpha to be made. So that's as far as Nifty is concerned, minus the trade talks. The moment you bring the trade talks, obviously that adds to some amount of risk, and therefore whether the tariffs will settle down at 15 to 20 or 25 or 50, the sensitivities vary. So if it indeed stays at 25 to 50%, I think there is a decent amount of downside to the market because markets have not priced that risk in. And that's our base case as well. We don't think that we can continue with a 50% tariff eventually. And as far as the mid caps and small caps are concerned, we continue to believe that they are very rich. They have underperformed this year. They will continue to underperform the Nifty through the year is our thinking as of now. On earnings, Prashant, you are right that they were slightly better, but it is just at the margin. So if you look at the ratio, 52% companies have delivered a beat, 48 have shown a miss. But the quantum of the earnings itself is not that very high. So we had 5.5% earnings growth in F25. On the top of that, we think there will be only 7% Nifty earnings growth this year. So to sum up, I think in between the earnings season, markets may have a rally on the hopes of an earnings recovery. But during the earnings season, I think markets will continue to correct as earnings continue to disappoint.
Okay. All right. Hi, Amish. Good to see you in. You're sounding a little bit cautious then in terms of the near-term view on the markets. But one sector I think you've gone ahead and you've upgraded is IT. You know, looking at a couple of data points out there, and if you compare IT valuations in comparison to the Nifty, that's only at a premium of close to around, I think, 14-15%. We have normally seen it bottom out here. And if you compare IT valuations with the Nasdaq, actually it's at a discount of close to around 20%. Normally, we have seen it base out at around 25 to around 30%. Tell us what is the rationale with regard to IT? Because growth is going to be very feeble, but now you have the dividend yield, you'll have the cash flow yield as well that could support the stocks. Tell us more.
Absolutely, Nigel. So you're spot on. All the reasons that you mentioned are actually valid, on the back of which we are looking to upgrade it. And it comes back to the point I was making, that if you are nimble as an investor and if you're able to rotate sectors, then there could be some alpha generation possibility. So IT, I guess everybody knows that the business outlook is subdued. It's priced it into the stocks. Incrementally, at least the negative news flow from here is unlikely. This, from a positioning perspective, heavily shorted sector. And in case if there is even if the companies just meet their guidance, they don't even have to beat it, I think there's a possibility of a short squeeze. So it's a tactical buy for a large cap sector that we are looking at.
Hi, Amish. Great to have you in. Yeah, sobering thought, right? It's been a tough year. I was just contrasting numbers a while back. Indian market 1% at the index level, whereas the US market is giving you 20% on the S&P 500, 27, 28% just on the Nasdaq. I mean, even if you're just an ETF investor, right? Forget picking any stocks. So since you're saying that sector rotation will be the key to making money in this market over the next couple of months, so IT is one. What else should you keep on your radar to be nimble when that opportunity arises? Because it's moving very fast. Look at these durable companies. They made great wealth and suddenly one knock and all of them got whacked out. So apart from IT, which other sector do you think can rotate on the upside quickly?
So, Subhi, two sectors that we have changed literally as of today. So utilities, and more particularly the power utilities. We were underweight on these names all this while. We now think that they're at least fairly priced. You may not be able to generate a lot of positive returns, but they're dividend-paying stocks, can be good defensive in a current volatile market. So utilities goes from underweight to neutral weight. And certain consumer discretionary segments. So we were generally bearish on consumer discretionary and consumption pack overall. But we've now, after the correction, we have now started liking consumer durables, building materials, some auto components, and then travel and tourism. So some pockets of consumer discretionary is what we've upgraded as well.
Interesting. So that's a call on consumer discretionary. You said auto components or also auto? Because large auto is seeing some accumulation. Even the forgotten, beaten down stocks like Maruti, etc. I mean, we're seeing some consistent buying come back over there.
So the auto components is the change that we have done. Within the large cap autos, we continue to like passenger vehicles and commercial vehicles. We are bearish on the two-wheelers, but that's not a change in call. We have that call for a while now.
Okay, Amish, just a quick word. I was putting this data out. Another reason for India's underperformance, and this is just kind of sort of, I'm wondering whether this is true, is the lack of AI exposure that investors can take here in India, foreign investors especially. Has that come up as a point of conversation, apart from everything else? Go on.
Well, Prashant, that's a very valid point, and the arguments on both sides. Even for the IT sector, the debate is obviously out there in terms of whether it will benefit these companies in the near term, like a cloud revolution had benefited these companies, or will it disrupt these companies? So there's a debate out there. We are still in the camp that at least as far as the next 2-3 years go, AI will first be an addition to the business for these companies and eventually perhaps a drag over time.
Okay. All right, Amish, good talking to you this morning. New ideas and perhaps a new approach to deal with a market that's been testing investors' patience as well. Thanks for joining in, and we look forward to more conversations through the course of the year. But now we're moving on to put the spotlight on BSE. BSE actually did pretty well in the first quarter. Numbers showed sequential improvement, whether you're looking at revenue, whether you're looking at margins. So very quick sequential recovery as the dust seems to be settling on a lot of policy changes that, of course, have gripped stock exchanges. So we have with us Mr. Sundaraman Ramamurthy, Managing Director and CEO at BSE. Mr. Ramamurthy, thank you so much for joining in. Good morning to you, sir. And I want to start right there. Investors are taking faith and, they want to believe that the worst of this policy action impact is over. However, we know that there is still a lot in the air in terms of looking at maybe moving the weekly product to a fortnightly product. I'm talking about the index expiry, options expiry. So tell us where you stand as of now with the sequential improvement. And if indeed we go to a fortnightly expiry, then would that be really disruptive for the business and volumes?
Good morning. Thanks for having me in your studio. As far as the regulatory policies in India has been a continuously evolving process. It's a co-created process with proper consultation across market participants. Objective is common. Objective is investor protection. So I think policies have been coming and been evolving and will continue to evolve. As far as the weekly expiry versus fortnightly expiry is concerned, I think SEBI chair has already clarified on this matter. So any question on this and any reply to it will be extremely speculative and an answer to a speculative question.
No, sir, no, I'm not asking you to predict, sir. No, sir, I'm not at all asking you to predict what SEBI will do or will not do. We also did a story. Our colleagues, had some inputs on why this is being considered, the move from weekly to fortnightly. We're just trying to understand that if such a shift does happen, what can the impact be? It may not happen, that's fine. But, as the business stands right now, will it simply halve the volume if it's fortnightly, or will it not impact the volume because people will simply trade that much more? Maybe not every week, they'll trade that much every once in 2 weeks. So just from a structural perspective, what the implications could be?
Well, I appreciate your eagerness. The starting point is still a speculative situation. That if it happens, so we have to deal with it as and when it happens. If it happens, what we all know is whatever is good in the interest of the market is what the regulators will do. So therefore, we need to wait for what the regulatory thought process is, more so because the regulators have clarified.
Mr. Ramamurthy,
if any reply were to be tried by me now, it is based on a speculative thought process.
Mr. Ramamurthy, good morning. Prashant here. The last time I spoke with you, good morning, I asked you about whether the regulator has asked for any information. This is, of course, I think it was in the month of June, right? Whether has asked for any information about trades by entities like Jane Street, etc. You said, well, you should ask the regulator. Early July, we got the order as far as Jane is concerned from the regulator. So, but anyway, I mean, you can't talk about what we don't know yet.
The order vindicates my stand. I gave a reply as well to that question while it is between, what I told was something slightly different.
Yeah.
I told you what conversations happen between regulator and regulated are confidential.
Yes.
Notwithstanding that, at this point of time, there is no investigation on BSE is what I have stated.
Yeah.
The order stands testimony to what I stated.
Absolutely. Let me just get you this, right? What is your own expectation, right? I mean, I think we last week spoke, you told me that you're increasing penetration with brokers. I mean, that's a big area of effort, right? Getting more players on board on the BSE platform, making their life easier for you to be able to trade, etc. And it's true. I mean, actually, since the first round of these, if I can call it options, derivative market reform in that sense, happened late last year, it should have hurt, but actually BSE's gained market share since then. You're at about 20% share. I think you're at about 25% of the market. What is your assessment, notwithstanding what may come from the regulator in terms of market share, that BSE will continue to, any endpoint, not endpoint, but any target in mind with regards to market share, Mr. Ramamurthy?
No, there are three targets which we have. all of them may result in good market share, but market share in itself is not a target. The first target is deepening and broadening of markets, which is very, very important for us. What I mean by that is, we today do not have as many number of participants as we would like to have. We started with 0. Today we have around 500 members. We feel we should increase it to 800 members in derivative segment. We started with almost 0 FPIs. Today we have around 330-340 FPIs. We are targeting at least 500 FPIs should come into India to trade. So at least with BSE to trade. They are already in India, but they are not with BSE. Also, in terms of products, we feel that it should be more monthly mix, more next week, next to next week, next month, long-term contracts, futures, they all should be there in place. So this is what we call as deepening and broadening of markets. And for that is the next goal, which is serving the economic purpose of a product. So the purpose of the product should not be just simply making people trade on expiry day. It should be much about a long-term view on the market and how to ensure that it helps in hedging or an arbitrage in bringing level playing field between the two segments. That's the second goal. Third is customer delight. What we can do in terms of products, services, feature, functionality to ensure that the people who are not there feel that they should come to BSE, and people who are in BSE find it more meaningful to be continuing to be stuck to BSE. These are the three goals. These are the basis on which we are working on. Every one of our action can be linked to any one of these objectives. Will this result in increase in market share? It may. Why? It's a catch-up game, right? We were 0. We had no product. Today we have a product. So the product starts growing slowly. When it grows, when you're comparing it with the market share, it happens as an increase. As I told, it's actually strictly speaking incorrect, because every product is 100% market share. You cannot take two different products, put them as a common denominator and consider a market share. Nevertheless, since most of people talk about market share, this is our path.
Mr. Ramurthy, like last time, nicely done, I must say. In every product of BSE has 100% share. But yeah, I mean, point taken. You're saying 3 goals which may lead to market share gains, but this is the effort at the exchange. Point taken.
All right. Hi, Mr. Ramurthy. Nigel on this side, and good to have you on the show as always. Let's talk about some things that are in your hands, like the clearing cost. Now, a higher proportion of trades are being cleared by ICCL, which in turn is reducing your clearing costs. So could you tell us, as a percentage, what is it at? And is there further scope of reduction?
I do not know what is the percentage that clearing corporation will be knowing, because it is who they are having as clearing members, and it is an independent entity with its own board. So I would not know what is the percentage market share that they have. But our efforts have been to help them in putting a system which is capable of surviving and growing and sustain itself. I'm not sure whether you are aware, when I joined, my clearing corporation had a capability to trade just 50 trades per second per broker. Today, at time, we'll be able to clear any trades. We have to increase our clearing capability. Today, on a rough basis, what I can tell you is, we can consistently manage 13,500 trades per second per broker throughout the day, and for longer bouts 25,000 trades per second per broker without any latency. A peak of around 72,500 trades per second per broker with a latency of around a second is possible. That is what is the system enhancement we have done. Any system enhancement of ICCL, as a person who have been in the market for a long time, I would certainly like to guide them and do whatever best I can. Market share and all is that entity's lookout.
You know, because you're focused on the clearing costs, sir, that's why I asked you about that. Because now I think the clearing cost would be as much as NSE, I'm guessing, because it's come down drastically, isn't it?
I wouldn't know, but what I can certainly vouchsafe is their capacity has significantly gone up.
Okay, all right. Okay, all right. Let's focus on the SGF contribution. In Q1, there was no contribution, but various brokerage notes are assuming 5 to 6% of the transaction value this year. Would that be a fair estimate?
So that is a fair estimate which the brokers are doing based on what has been the past. In fact, we have done an exercise where we have seen what is the complex algorithm of computing SGF is different. It is there in its place. Notwithstanding that, for an organization, if it has to avoid jolts of sudden debits to P&L, how do we go about? So when we make a rough estimate, we find around 5% to 6% is what gets into it. We may find a mechanism to periodically contribute to the SGF so that it is all not concentrated in a single quarter and gives very different impression about that quarter alone. That work is in the offing. We are taking approvals and then we will be doing the needful.
Sir, that brings me to where the operations have now stabilized with all the changes. I mean, now we're down to the one product per week expiry format, at least as of now. So if you could tell us, what that has meant in terms of volumes, I mean, overall traction in Sensex volumes, and BankX, it's not, because it's not a weekly product anymore, are you still seeing some build-up, or, what is your assessment there? And then, overall margins, because with all of this finally stabilizing and the SGF, the Settlement Guarantee Fund, those costs being where they are, you've come back to 65% margin. Is there scope for improvement?
So first let me talk about BankX and then I will come to margin. As far as BankX is concerned, you made a very important point. When it was a weekly product, it was seeing a lot of volume. When it is monthly product, it is not seeing as much volumes, and volumes have dwindled. What we find is there is interest in BankX in the expiring week. More the preference is towards a weekly expiry type of a BankX, which is exactly what we want to change. We feel that there is a lot of merit in the market participants looking at a slightly longer time horizon to trade this product. In fact, if we look at the Indian derivatives history, we started with monthly. Suddenly, somehow the focus has become short-term across the globe, and some of the developed markets trading more than 60% of their volume on the expiry day as 0 DTE. I think as market participants, we have a responsibility to go back to the market participants to bring out what are the importance of using a monthly product as it is, which is exactly what we are doing. We are planning to do more. That will help in the mix changing and more institutional participation coming in, and therefore a better economic purpose being served by the derivatives. That work is on, that we will do. As far as the margin is concerned, we are not looking at increasing margin or stabilizing margin. Instead, our focus has been on diversification of our revenue streams. What we would like to have is more of cash equities volume, because we are not growing greatly there. Our market share has not been there. I would certainly talk about market share because the products are same. There our market share has been small. I have always been thinking that if our market share goes up there, it will not be a cannibalization of the other exchange, but it actually by growth in the entire market pie. I have been proved right. When I went up from 5 to 7-8%, now what I am talking about, actually the market size in itself has grown, which I feel strongly about because of multiple economic reasons, which I can elaborate if you were to ask me a question there.
So sir, tell us, if you could give us, sir, if you could give us some sort of an aspirational path on both these fronts, market share, your aspirational market share, and what are the inroads you think you can make in the next 1 year on the cash equity side, and also say the BankX, where the volumes are right now languishing. I mean, what kind of monthly volumes would you aim for, say, by the end of this year, as your conversations with market participants and all of that starts bearing fruit?
In terms of BankX, I will not give any volume target because that has not been our approach. In terms of cash equities, we want to have consistent double-digit volumes. At least it should be 12%, 15%, 20%. I'm not aspiring for a 50-50. Then that would tantamount to cannibalization. Interest is not in cannibalization. Interest is in about growing the pie. The pie will grow large, very, very large. Why do we feel that? Because if we are talking about a 50 trillion market cap by 2047 and a 30 trillion GDP, it cannot be with this 5,500 companies listed at BSE. it has to be more number of companies coming in. Are we telling that this 5,500 companies will have such valuation? They themselves from 5 trillion will go to 50 trillion.
Yeah.
Cannot be.
So right now,
Mr. Ramamurthy, point taken. Point taken, sir. Sorry, we're jumping in and interrupting you. You know, on the derivative side, right, and without going into what the regulator may say or not, do you believe, and the concern has been that the volume of derivative volumes here in India as relative to the cash market has been absolutely disproportionate compared to any other market, I mean US or any other market in the world, and you know the stats very well. Do you think for the foreseeable future, that ratio has kind of completely peaked out and the direction of travel is more normalization? Would you agree with that statement, sir?
Unfortunately, I am not in a position to agree with you, Prashant, and I have been telling this multiple times in the marketplace.
Right.
When we are talking about US and you are telling cash to derivatives volumes, in US there are multiple exchanges, multiple dark pools, multiple trading platforms. All of those volumes are never measured. Neither the denominator, there are OTC products, there are internalization, neither the denominator nor the numerator is a number.
But sir, even if you add all the dark pools, etc., I'm not advocating for one or the other.
How
but
do
even
you
if you
add the dark pool? You may have the data, I don't have the data.
Okay.
The
So,
dark
but you're
pool
saying
per
you
se
can't.
does not publish you any data.
Correct. You're saying you cannot. It's not possible. You wouldn't say that ratio is peaked. I mean, you would not say that in that sense, right?
See, what I am not able to measure, based on a speculative thought process, it is more. I will not be able to do anything.
Okay.
I am only saying, with lot of dark pools and platforms, the numerator and denominator both are not known in US. How do I compare with it? What is visible to me is the option premium traded in India and the cash market volumes. If I were to compare that in India, it's a fraction of the total cash market volumes. What is visible to me is the number of investors in derivatives market versus number of derivatives in the cash market. That's a smaller volume. Is it true that retail investors are losing money? Honestly, yes. Does that mean the options have peaked out? Very difficult to say. No, the parameters do not indicate that. So it will not be possible for us to conclude that compared to US, we are doing more, we have a skewed ratio because of the point that I explained. The second, based on the Indian data, which is very clearly visible, we are not able to conclude that we have peaked out on volumes.
Okay, got it. Mr. Ramamurthy, getting ready for the NSE listing, sir?
No, this question has been asked to me by CNBC in the last 3 interviews. Always I have told it will be a matter of great pride for me, because I was one of the people who joined NSE in the initial days. It will be a matter of pride. NSE is a prestigious institution. To have it listed is a matter of pride. And BSE will feel honored, naturally.
And of course, I mean, it'll be a big event in terms of business as well. I mean, 5 lakh crore market cap, right? I mean, in terms of valuation of the NSE. So it's going to be a big one when it lists on the BSE. We'll, of course, track it.
I think as of now, one of the highest traded stocks on the NSE is the BSE. Yeah. And on the BSE, one of the highest traded stocks since the time of listing is NSDL in the last few days itself. Well, Mr. Ramamurthy, we appreciate you joining in and giving us all of those details. We look forward to having a chat with you rather soon. Thanks a lot for joining in. Well, time to slip into a short break, but on the other side, we have Mr. Balasubramaniam of Aditya Birla Sun Life AMC, who will be joining in to talk about the stellar inflows into the equity mutual funds for the month of July.
Welcome back. Well, we have a special guest with us in the studios, Mr. A. Balasubramaniam of Aditya Birla Sun Life AMC. And you probably saw in that shot on camera that it was all smiles here. And why not? Because in a phase where the market has been testing investors' patience, it's been challenging, returns haven't come in the last 1 year. Guess what? Domestic mutual fund investors have pumped in the highest ever equity inflow into local funds, crossing the inflow number of 42,000 crores in equity funds. In fact, I think in a bit we'll try and see if we can get Nilesh Shah on the phone line as well. I think Nilesh is traveling in a car. He said maybe he'll try and join on the phone, because he called this out. We had Nilesh last week. Balasar, we had Nilesh on the show last week, and that was the day the 25% tariff was announced. So it was all gloom and doom. And he said, in that gloom and doom, he said, watch for this number. July is going to be a record number. And it indeed was. It's NFOs that are driving it, sir. But is it sustainable? I mean, can we expect this trend to really rebound? Because, you know, the last couple of months were getting very weak, and now we've seen a big U-turn.
Yeah. I think July was a bit different from an investor's behavior point of view.
Okay.
So I think July is the one which is full of tariff-related discussions. There was a lot of uncertainty. Suddenly it came from global market. The market fell. And when the market fell, then whatever the concern that you've been having that from a valuation perspective, that also to some extent gave comfort to people actually pumping money. So this is the first time I saw, one is NFOs which came from mutual fund industries, roughly about 9,000 crores they collected. Rest of the money is come through the diversified equity funds. And the moment the market fell, the people actually got convinced that I think I should invest in the market when the market is falling. So that's why I saw participation levels increasing. And large money came through the HNIs and family offices, as well as an ETF flows that also has gone up. And I think there's a record inflow that has come purely on the base of the conviction that we have on the Indian economy. And domestic savings coming into the equity market continues. And lastly, the RBI policy.
Yeah.
Also, I think the whole stance of RBI policy is now changed towards growth. It's no more the inflation, no more about other stuff, liquidity. Yeah. It's more about getting back on the growth. Therefore, that confidence also gets boosted as a result of that.
No wonder, Bala, I was joking the other day that there are only 3 businesses in India right now with 15-20% growth visibility. AMC's is one.
Yeah, AMC of course will remain because of the role that they play.
Yeah.
Especially on financial savings coming into the capital market through the
tremendous.
Tremendous.
The family office route. Is there a way to measure what percentage of the money, discretionary money, which is coming in, XFSIP, is through the family office route? Because then we can kind of not draw a straight line, but a straight enough line to the promoter stake sales, etc., which are happening. I mean, every year we are seeing about 1 lakh odd crores of promoter stake sales, which are happening. This year also we are on track for that number. And the talk has been that bulk of that money finds its way back into the market through various ways, direct investments, mutual funds. From a monthly flow perspective, is there an estimate?
No, I think the way I look at it, about 27,000 crores roughly is the SIP flows. Largely is contributed to the retail investors. And maybe about 10 to 15% would have come from HNIs in the space. And family offices they come actually into the fixed income funds first. They come into the arbitrage fund. They come into they look at more like a safety. Because the money which is raised by promoters is not meant for investing in the market. It's meant for other purposes. So we're keeping that discipline in mind.
I'm not so sure. Investment bankers we've spoken to say that a lot of it comes back into the market.
No, it would come back, but it would also come back to the safety instrument, I'm saying. It will come back to the fixed income, come back to the AIF, come back to the arbitrage funds. So not necessarily everything comes to the direct.
Saying it's not that larger.
Not the large component. That in my will about 10 to 15% of the flows would come from the family offices into direct equity. Okay. The large component is also coming from the EPFO, basically the ETF, ETF flows come through the provident funds. They can invest up to 15% in equity.
Yes.
And that's the recurring flows. The recurring flows today, 10% can go to the ETF, 5% can go to the actively managed funds. Some bit of money comes to the actively managed fund also. The third category, which is of course is growing, is a fund of fund. So fund of fund used to be very, very small, and now fund of fund also now started becoming a larger component of the inflows. I think the fund of fund, when they start getting inflows, they need to invest in, of course, various schemes. Depending upon your outlook, the money manager have got an outlook on the segment of the market, various segment of the market. That's why I think the flows are coming. So the 48,000 crores that we saw, I think the month of 40,000 crores plus that we saw in the month of July, that I think largely is contributed, the regular flow that is coming in. Some bit of flows I think would have come from the family offices, where they took a call purely on the basis of the market fell, outlook is positive, narrative is positive for India, but market fell, so they used an opportunity actually for pumping. And NFO collection also is going up from what we saw in the month of April and May. The number for July is better than the April and May, June. There's also in some bit of convictions coming back for investing in equity when there is uncertainty. There's one thing which I've seen in the last so many number of years. The maturity levels of investors to invest in the market during the uncertain time actually is far higher than actually investing in the rising market. I think earlier there used to be euphoria, actually chase the market when there is a rising market, rising momentum.
Yeah.
But it's the first time I am seeing, not first time, I am seeing it for quite number of times, that the markets actually get more thumbs up from investors when the market falls.
But, Bala sir, also sort of tell us this, that yes, and the industry has done a great job in terms of mobilizing all the money and the new funds and product innovation. But at a level, you also feel a little jittery because insiders are selling, promoters are selling, PEs are selling, FPIs are selling, the whole world is selling. And we as investors are buying, which is fine. We all understand the long term. But looking at valuations, looking at some of these concerns on earnings, is there a risk also that investors will be tested even further? And then we don't want the experience to be soured, right?
Right.
They've already been patient. So your thoughts on this?
So I think interestingly, I was just doing some analysis on this. If you take market as a country, what is the risk that you're running? I think the risk is all about whether it is 6.5% or 6% or 5.5% or maybe 7.5%. If there is a derailment of the growth, then naturally will have an impact on the market and then valuation will get corrected. So today the flow is of course coming in. They're able to absorb all the flow is coming in. Therefore the market actually continues to remain very, very strong. And given the fact that we have seen a good rising market, also given the fact the next 1.5 years is going to be not as rosy as we can expect from the growth momentum point of view. I think it will take some time for the growth to come back to about 7.5-8%. Earnings growth, I think, will have to gain momentum. In this period, the market may go through a sideways. I think that frustration could come. I think we need to, of course, remember very clearly, there will be a period of market where you will not get a return. But staying invested during the period, I think, will become extremely important.
Yeah.
At the same time, if you start comparing that with any interest rate other component, then probably you'll see you would have been better off actually investing in fixed income instruments rather than coming to the equity market. That frustration would come.
Which we're seeing some of that. Like, look at hybrid funds, right? They are drawing in a lot more money now, multi-asset allocation funds, because people have realized that you need to be, diversified, which is good. Correct. But on equities in particular, what is the sense that you get when you speak to your CIO and others across the industry? Because it seems that now this is a market where you need to be very nimble. We just had a Bank of America securities view. Amit Shah was there, and he says you need to be swift and churn more, maybe, kind of trade in and out more quickly, because it's that kind of a market. You don't have the multi-year stories of large banks, IT, 2 years of great returns. So will the approach in terms of fund management need to be different?
Not necessarily. I think fundamental investing doesn't change. I think you invest in companies for a longer term investing point of view. And you go by the company's aspiration to grow the business and so on and so forth. Therefore, the fundamental of investing doesn't change. Momentum is actually part and parcel of the game. I think that's something what your money manager normally does it. It's a 50 to 60%, or maybe 68% is a core portfolio. 20 to 30% actually goes to the satellite kind of portfolio, where you actually play the momentum and play to the market, the trend that exists and so on and so forth. You look at the valuations and so on and so forth. That's something more of cyclical. I think structural story in India that's going to remain. Therefore, the construction portfolio with 100% core kind of portfolios will remain for longer term point of view. That's the only way the money is made. Money is made by money managers, not by just trading. And in the short term, you try and capture the opportunities. Money is always made only if you identify the good companies, good businesses, good business houses, stay invested for long term. That's the only way we make money. That's why if you look at the difference on the market. If you look at the large cap versus mid cap versus small cap, the difference generally is very high in the long term. But in the short term, actually, it can actually be completely the other way around. That always money is being made only in the long term. That's why we keep advocating all the investors, even the money managers. Generally, they tend to actually buy companies for long term point of view and stay invested. Except, of course, we have to pay attention on the emerging trend.
Yeah.
The emerging trend, of course, helps you in terms of capturing some of the trend that has got more bias towards short term performance coming in faster than the rest of the market.
Speaking of emerging trends, just a final point on emerging regulation also, right? Because we know that SIFs are coming. These special investment funds where the basic threshold is going to be 10 lakhs. So whether it is SIFs or any other newer products, do you think actually SIFs could pull in some of the money that's coming in to mutual funds right now? How do you see this evolving in terms of the next 2-3 months?
I think this is another product offering.
Yeah.
I think SIF is actually more targeted towards the people who go to the market and try to test the market, participating in the F&O market and the futures market. For them, actually, the product has been created where the money manager can take advantage of their own understanding of the market and create a product that can actually suit a certain segment of the market. That's why you put, if you look at the flows, the minimum tickets has to be 10 lakh rupees and above. It's actually for the people between 10 lakhs and 50 lakh rupees. It comes between a PMS and the mutual fund minimum of 500 rupees, 1,000 rupees kind of investment. It is meant for that. But this is an asset class that will pick up. The way other asset class got emerged, like hybrid, and within the hybrid, arbitrage fund got emerged. Therefore, this is another asset class will come. But I think the mutual fund industry will be dominantly driven by the large cap fund, flexi cap fund, multi cap funds. Almost 60 to 70% of the construction of the portfolio, the construction of mutual fund, would come from this segment of the market. And this kind of thing will coexist. The way I think ETF and index funds are coexisting, this will coexist.
So you don't see SIFs pulling money away from traditional equity funds.
Exactly.
Okay. All right, got it. Thank you, Bala, so much for joining us in the studios today and giving us a perspective. Thank you. Well, with that, we go to the market, and the market actually turned around quite well. And look at this, it's a 100-point gain. So after starting very soft, seeing some minor cuts, even the Bank Nifty, which was down about 0.5%, it's recovered very, very smartly. And we are at the morning highs right now. Lots and lots of stocks buzzing around. Titan, M&M, a lot of the IT names have been doing very well, TCS, etc. All of them tracking gains of in excess of 1% right now. Good time to bring in our technical experts. Mitesh is back with us. Mitesh, bulls are trying to seize control. What's your advice now in the trading calls?
I think, Subi, it is continuation of yesterday's bounce back. As I said, good chance that. And I was actually surprised when we got a soft opening in the morning. But still, looks like the Nifty will head towards this 750, 800 zone. And that is when, you could expect some profit booking coming. That's where the daily and the couple of intraday hours are placed. So till then, I think stay with the long side in the markets. We're about 100 points away from what the level which I'm mentioning. And on the stock side, I think, PFC has come by Power Finance Corporation. Recommend buying here with the stop below 414, target of 432 to about 434 can be looked at. And that about a good reversal is happening on the charts of Tata Steel. So we'll keep a very tight stop at 158.5 and look for targets for around 167.
Okay, all right. Thanks very much, Mitesh, for that. What we're going to do is take a quick commercial break here. Another one. Come back. Manisha Gupta on the other side with a focus on commodities. Stay tuned. Okay, welcome back. It's looking solid. 100 points, 110 points, 24,693. So much better week so far, although it's just the first hour of Tuesday. But I mean, a day and an hour so far this week, and 300 points in the Nifty is what we have. Well, let's just look at commodities and what's top of mind there. Manisha is here with what she's watching closely. Manisha, good morning.
Morning, Prashant. Thank you for that. Well, I'm talking about metals where you have the precious metals on a declining move. But when you look at the industrial metals, they seem to be doing well. I'll start with gold prices, which has fallen yet another 1.5% in the overnight markets towards 33.50. This is a stark price in comparison to where we were on Friday at 35.30. So it has been more than $200 of a decline coming in for the markets there. Well, this comes in after the U.S. president yesterday put on X that gold will not be tariffed. Remember, last week, Thursday and Friday, were a couple of days when it was complete confusion on whether or not gold is going to be tariffed by US. Remember, 230 or 250 tons of gold that US buys, 60 to 70% of that comes in from Switzerland, and that is tariffed by 39%. Industrial metals is a different deal, but when you talk about gold and silver, it clearly has been a stance that it would not be tariffed. So this really created confusion in the global markets where we saw $100 per ounce of a move happen in matter of hours, and that really seems to be easing right now. So when you look at the prices itself, well, we have seen a decline come in. Also, what is leading to decline in gold is U.S. signing an executive order extending pause on U.S. tariffs on China for another 90 days. There's no reason for safe haven buying, and that is the reason gold has declined. The other macro point that gold seems to be taking cues from is that U.S. has signaled that no new sanctions on Russia crude while talks continues. So that also tells you that there's no reason to buy gold and silver right now. So it's not just gold. We've seen silver also decline 2% in the overnight markets. The support, though, comes in for the industrial metals, especially steel prices trading near 7-month highs. The China steel industries may see capacity cuts because of pollution and overcapacity on construction input. That has been supportive. And then there is likelihood of capacity cuts as well. China steel exports have gained up by 11.5% in 2025 so far. Supportive factor there. And also, when you look at the iron ore markets, here as well, we are trading at around 4-week highs. Chinese imports have been at around 100 million tons for the month of July, which is up by nearly 2% on an year-on-year basis. And then also restocking activity in the Chinese mills has been supportive. The aluminum prices also have been on the higher side, trading at near 4-month highs at this point. The Chinese production is up 3.2% in the month of June on a month-on-month basis. But remember, China, for one, is going to cap its output at 45 million tons, and production between Jan to June, in the meanwhile, is up 3.3%. All eyes, though, on the U.S. inflation numbers today, and the further cues would come in from that one.
Yes, absolutely, and we'll look out for those numbers for sure. Manisha, thanks very much for the update. For now, we have to take a quick break. On the other side, our special segment, It's the Economy, coming up. Lata Ayan will be in conversation with former Deputy Governor of the Reserve Bank of India, S.S. Mundra, and Bernstein's BFSI expert, Pranav Gundapalli, on the impact of ICICI Bank's sharp hike in minimum balance requirements for its savings accounts.
Welcome back. ICICI Bank stunned the country over the weekend when it announced that it is raising the minimum required balance for its savings account to 50,000 rupees. That is 5 times the previous minimum balance requirement of 10,000 rupees. ICICI's hike in balance is seen as being prompted by a desire to serve only richer people who can bring more business to the bank. The Reserve Bank governor, however, when asked, reacted by saying that Reserve Bank has no regulations governing minimum balance. But a reading of the master circular shows that all charges have to be reasonable and commensurate with the cost of rendering a service. This is an overall grandfather clause. Importantly, most PSU banks have nil minimum balance requirement so that they can cater to all sections. So is the ICICI move starting a new elitist trend? Should such a decision be left only to banks with no Reserve Bank intervention? And anyway, how does this move help ICICI itself, since all banks seem to be actually crying for savings bank deposits? For all these questions, I'm joined by Mr. S.S. Mundra, former Reserve Bank of India Deputy Governor and also a former chairman of BOB. So he comes with 2 hats, really. I'm also joined by Pranav Gundalapalle, the senior analyst India for financials at Bernstein. Gentlemen, thank you very much indeed for joining us and sparing your time. Mr. Mundra, first question to you. Your first impressions. What do you make of this huge increase in minimum balance by ICICI?
Thanks, Lata. And absolutely right word used, huge increase. I would start with saying some increase over a period of time, inflation adjusted, income level adjusted is something which every bank would like to do. But by any standard, it is a huge increase. But let me tell you, if you look at the statutory viewpoint or the regulatory viewpoint, I think bank is very much within its right to do this kind of increase. They have not violated anything. You will also look that existing customers would continue to be, shielded from this increase. The Jan Dhan account or the basic saving bank account or the salary accounts are also excluded. So technically, purely technically, I mean to say they are within very much their right. But I would say from the messaging perspective, I would not use the word morally, but from optically, and also considering that, inclusive growth is something which is a kind of national mission. And banks, all said and done, they are commercial entities, they work for profit, but they are public utility, they are public goods in some sense. So to my mind, from that perspective, I think this increase, I would not say that it looks very good. Having said that, I would just like to, add 2-3 points to it. Let's say last revision they did in 2015. So from that till now, maybe the per capita income in the country has almost doubled. Had it been an increase from, let's say, 10,000 to 20,000, probably it would not have raised any eyebrows. It would have been in normal course of business. The second thing, today, if you look at their structure, so all the bottom of pyramid consumers in any case would continue to be, these bank services would be accessible to them because of the point which I mentioned earlier. People with good income to spare would also be able to maintain. But a large middle, self-employed, gig workers, that bracket is completely getting excluded. And where I think it comes as a big shock to the exclusion. Just a couple of points. Technology, now they have also revised their service charges together at the same time.
Yes.
If you look at the construct of service charges, there will be a huge deployment of technology to manage those kind of brackets and the combinations. So I think with the technology, one could have managed these accounts as well. I think the desire is rightly to save on their operating costs, maybe bring more operating efficiency. But I don't find it to be argument to be very, very acceptable in that.
Okay. Well, let me put some points which I got from the bank sources on the table. It is not applicable to existing accounts. Even for prospective accounts, salary accounts will be excluded. So CNBC's salary account is with them. Fresh people in the salary account or even new companies, if they give the salary account, will be excluded. They can continue to maintain. Pensioners will be allowed. And premium educational institution students are going to be allowed. I think they see them as prospective customers. As well, as you said, the basic savings is allowed. Pranav, I have two questions for you. The first one is, does it really help margins? It seems to be that kind of a move.
So I think my view, it is actually a very good move for 2 or 3 reasons, right? So one is that I see limited downside in terms of loss of deposits, just given the average balance sizes in savings accounts for private sector banks, or specifically for ICICI. I think you're talking about excluding a very small part of the balances. That's number one. Number two, I think it's also a good risk-reward trade-off, because we've seen that the risk of a huge increase in the number of accounts hasn't always been good. I mean, it's been actually quite bad for players like, Kota, Paytm, all those who had a huge influx of customers because of the lowered bar have actually suffered, actions from the regulator for falling on KYC norms or other reasons, right? So it's always not a great idea to just let in a large number of customers, because there is cost, there is compliance requirements that comes along with it. And the third one is also, I think, given the regulations that already exist, if you take a savings account savings account as a product, given a lot of the elements of it is regulated in terms of the fees, the number of ATM transactions, interest rates are also well deregulated. It doesn't really change a lot between banks. So this is in some sense a forced move as well, because this is probably the only lever a bank has in order to maintain the profitability of a savings account product. And I would not be surprised if some of their peers actually follow ICICI because the unique structure of the competitive environment will force the banks to actually go down this path.
Okay. No, actually, there was no problem of influx and a poor KYC in ICICI's part. This has come quite unprovoked, and it is clearly only probably cost and margin driven. That was what sources told us. I don't think the KYC argument, but I take your point. But really, will you increase the margin, Pranav? Just because of this, do you see a quarter, 2 quarters, a year down the line, margins improving?
So just to clarify, what I was referring to was adding a huge number of accounts without commensurate additional balances involves a cost. And if you fall short of investments on any of the KYC or the operations required, it could result in a big one-off costs, right? Regulatory actions, etc. Now, will it help the bank? I think the answer is yes, because if you look at the costs of providing a savings account, that largely remains same irrespective of the balances. So over a period of time, I think it does 2 things. One, it will lead to actually increase in the average balances, because I think today the cost of opening an incremental account is almost gone to 0. So now that you've set a 50,000 rupees bar, I would expect a lot of, and the minimum balance at some of the, almost all the PSUs are today at 0. I would expect some migration of balances from those accounts into an ICICI to maintain the minimum balance required. So that should be a positive.
No. It is not for existing accounts. So migration will not happen, no?
Let's say I'm opening a new account. I have a choice. Let's say I have a 30,000 rupees somewhere. And earlier I could get away by leaving 20,000 rupees now with ICICI that I open. Now I would bring in my 30,000 from another bank account and ensure that I maintain the 50,000. So you can't differentiate. I mean, see, given that you have fintechs being used for all the high frequency transaction, you can't persuade customers to move move completely to, let's say, banks that invest in technology. So the only way left is this, right? So I see that as...
No, I personally, I'm trying to wrap my head over why would I open an account with ICICI? I can't find any reason. I mean, 2.75 is not even attractive, and I have to keep 50,000. It is not making sense to me from a customer angle. But for the bank, yeah, maybe there is a saving in cost. But Mr. Mundra, I want to take this public interest angle that you're talking about. Yeah. If there is a set of banks which follow, at the moment it doesn't look like many banks will follow, because HDFC for the merger reasons is still dying to get as many deposits as possible. They perhaps will not join the queue now. And I guess Kotak also is not yet grown to that level. They will also not follow suit. Maybe Axis will. I'm not very sure about that either. So it may not become a trend, but if it does, like a year down the line, if HDFC Bank also joins, then do you think Reserve Bank has to sit up? I mean, you can't have two of the largest banks, two of the top 4 banks, refusing to serve people who cannot bring in 50,000. Then it will become public interest. You know, banking, in a way, is like electricity. Okay, electricity, only one person is allowed to serve in one area. But if there are 2 people and one person says, I will not serve any of the juggi jopnis, I will only serve the apartments, surely the government will step in. So do you think that at some point the Reserve Bank may have to step in?
See, Lata, that exactly is the point I mentioned in the beginning. I mentioned 2 things, that you are, you with this construct, you are serving 2 parts of the economy, but leaving out a very important middle part, who is become a very potent force in the economy and who have their aspirations. That is one point. The second, I don't agree with Pranav. See, banking, when you are in the business of banking, you are in the business of taking the risk. Because there is a risk in opening huge number of accounts, you run away from that risk. That is not the banking. You have to manage the risk. Today is the technology. If everyone else in the country is managing, you cannot say that I don't want to take the risk. I don't buy this argument. You mentioned something about Kotak. This is why I'm mentioning. It is very unusual for a competitor to mention on a public platform. And I have seen Mr. Jay Kotak commented on this on a public platform, which is very unusual. It shows that what is the general feeling. So I fully agree. I don't see this trend coming that everyone is going to follow this. I hope even ICICI Bank will have a reflection, introspection, and may do some changes in this. But I don't see this is going to be a trend. But where this to become a trend, I would say yes, RBI as the regulator and looking at the overall economy has to step in. Not only that, there is one part is RBI. There is another part, the government, the central government, state government, and they do a huge transaction with various banks. They keep an approved list. If there is a feeling at the political level that this is something which is not friendly for a common man, for the philosophy of inclusion, then governments also have their own, means and the relations which they can do. I agree, regulations cannot be suddenly changed, or it cannot be, but there are ways and means of conveying a message. And that is how I would look at it.
You think a moral suasion?
Lata, sorry, you rightly mentioned, then why should I, go and open an account? See, this revision in limit has come with a host of other charges. Some concessions are given with this fee, but at the same time, some other things are levied. Now, there are steep charges if you do at the cash transaction at the branches in the new construct. But at the same time, even bank's ATM, if you operate, after certain transaction charges are same, they would have charged when you operate on the other bank's ATM. So you say, don't come to the branch for doing the cost transaction. Don't go to the ATM for withdrawing the cash. I mean to say, one can argue that we are doing all this to promote the digital economy, but that is already happening in any case. So I think what I'm trying to say, optically, many things are looking so bad without really deriving a great advantage to the bank.
I assume, I think the optical impression has not been positive at all. But that is exactly why the investors like it, because they think that it's going to bring in margins. Just one sentence, Pranav. Do margins go up?
The balances would go up. So just a couple of data points. I think one is you have the average savings account balance for a private sector bank in a metro area is about 90,000 rupees, right? So bringing it to 50,000, I think is more like saying, I want to be the primary bank. So that's the statement that ICICI is making. So if you're moving to us, we want to be the primary bank. Otherwise, you can take the business elsewhere. Which I think is probably a right move because from a cost benefit point of view, a savings account bank today makes sense for a bank only if you are using it as a primary bank. And also this becomes the only way to compete against the public sector banks in some sense because the attrition of deposits has been slow. This will force it. So I think it's a positive move for the bank.
Okay. Well, that's a fair point that they only want primary accounts. That a source in ICICI actually told me that. But I am only saying it becomes a public interest issue if all banks were to say this, Pranav. I mean, would not the government of India be forced to move? Or if it becomes a divisive point between private and public sector banks, then again, the regulator and the government of India may have to sit up. So I think much will depend on whether it becomes a trend. Doesn't look like right now. Unfortunately, out of time. But thank you very much, Mr. Mundra and Pranav.
Could
Yes,
I
sir.
just one final sentence which you mentioned that investors would be happy. Banks don't exist only for the investor. There's a term like stakeholders. Depositors are major stakeholders in a bank. Let us keep it in mind.
Fair point, of course, and so is the regulator and the government when it is as vital an industry as banking. I take your point, and so would ICICI. We'll see how this goes. The governor's first statement has been very neutral, so it looks like at best the RBI may give a moral suasion nudge, but nothing else. That seems to be the present situation. Wrap up on Bazaar on that note. Thank you very much, Pranav and Mr. Mundra. After the break, Chartbusters.
Praj Industries slumps on a very weak showing in the first quarter. The profit slumps nearly 95%, while order intake has also fallen by 10% on a year-on-year basis. The stock is down 7%.
In another earnings accident, Astral 2 is lower by 7% following significant margin contraction and profit in the first quarter as demand remains weak. Brokerages are also largely cautious on the stock.
And Tata Rail reports a 54% decline in profit in the first quarter. The revenues also declined by 25%. The stock, however, rises as the management remains confident of a recovery in production as wheel set supplies normalize.
Office Space Solution rallies on a strong first quarter and bullish commentary. SJVN also surges following a strong set of first quarter numbers.
Media's surge is following a big block where around 15% worth of equity, around which was worth 580 crores, change hands at around 523 rupees a share. Sources tell us that the promoter, Bessemer India, is likely to have sold stake. Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and joining me today is Vamakshi. Hey, Vama, good to have you on the show and good to anchor with you. You know, I'm a big fan of your work and your research, and to anchor with you is special.
Well, thank you so much for that warm welcome, Nigel. You know, it's in fact, I think it's the other way around. I think it's a big jump for me to actually anchor with you. So thank you so much for that. But you know, what's not doing too well is the markets right now. It's a sharp fall.
Well, that's right, Vama. You know, if I look at the top two indices on top of, which are up there, they're in the red, while these two are in the green. And, you know, just a short while back, the Nifty was holding with a gain of around 100 points. That's the problem for this market. We've seen a bit of a short covering bounce, but those bounces will get sold into. The level you're looking at it in terms of an upside is 24,750. That's the resistance mark. We went closer to around 24,700 and we did see a bit of a pullback from there. So let's see whether or not the bulls have enough to fight back yet again. But let's turn our attention to our special segment where we get you a few ideas for profit from Money Control Pro. Khushbu joins us to help us out with what she's tracking. Khushbu?
In today's idea for profit, we have Godrej Consumer. The company is building a future-ready portfolio by handpicking high-growth and under-penetrated categories. The earnings growth trajectory of the company was the strongest among the peers, led by volume revival in the home care category in the previous quarter. And the momentum is expected to continue in the June quarter, backed by seasonal tailwinds. However, the soap business will see some margin pressure due to palm oil inflation, which has weighed down on the domestic margins. The global business simplification will continue to drive margin expansion in the consolidated business. The company is also working to expand addressable business market by deepening the rural play and expansion into niche segment. While the boost in consumption growth due to the tax relief could unlock new growth drivers, the strong domestic execution and international business expansion and also the focus on premium portfolio will help the company to post consistent earnings growth in the coming future.
Well, thank you so much for that, Khushbu. Keeping an eye out on Godrej Consumer. But let's slip into a very short break. We'll get you the management of Suprajit Engineering on the other side. So stay tuned.
Welcome back. You're tuned into Chartbusters. Well, let's focus on the first management. That's Suprajit Engineering. They reported a mixed set of numbers. And, the guidance as well looks a little bit challenging. But let's find out what's the way ahead. Mr. Ajit Kumar Rai, the founder and chairman, who joins us on the show. Hi, Mr. Rai. Thanks a lot for joining in. Well, a couple of quick details. Earlier you had said that you're looking at double-digit growth with double-digit margin going ahead. And consolidated margin should be in that vicinity of around 13 to 14%. Given that the revenue growth hasn't been that great in the first quarter, you think you can recover such that you grow in double digits for the year?
Good morning and thank you for having me on your channel. The first quarter is typically a slightly weak quarter always in the automotive industry. So I don't think we should worry too much about the first quarter revenue growth part of it. 3 quarters are a long way to go. The festival season is just about starting. And the global business, hopefully, at least in the second half of it, will be a lot more stable after the tariff issues are taken care of. So for us, the first quarter has been generally in line with our budget. So we are not much concerned as far as the overall year's numbers.
So double-digit revenue growth, sir, you can do?
Yeah, I think at the moment we are still talking about a double-digit growth without, the SCS business. With the SCS business, as you know, we already done 17% growth in the first quarter. So with the SCS, it will be much more. Yes.
Sure.
And in terms of the margin, I think we have said, without SCS, we'll be between 13 to 15%. And I think or 12 to 15%. We are already at 13%. In fact, our consolidated number without controls division is close to 13%. Without SCS is about 13%, which is a significant turnaround from the same time last year, which was at about 11%.
Hi, Mr. Rai. This is Vamakshi joining in. And, you said that Q1 is generally weak, but this time around, there was also a double whammy that came in from the tariffs. So can you quantify what was the impact in Q1? And, so far, we don't have a resolution. So in Q2 as well, would we see some impact coming in from the tariffs?
Tariff is a very uncertain situation at this moment. Hopefully, in the next month or so, we'll hope to see some resolution or at least some clarity and direction in which we are going. As far as we are concerned, let me put a little more larger number perspective to it. Our business with the North America is about 110 million US dollars, 100 plus million, of which 30% customers have already agreed, approved, and are paying the tariffs. Another 30-35% have agreed, but the processes are in place, needs to be put in place. And with another 30% or so, we are still under negotiation. So as far as the tariff impact is concerned, there could be some timing issues in terms of when we charge to customer and when actually customs charges us, because there will be typically a timing effect. Beyond that, we expect most of the tariffs will be passed on to the customers.
Okay,
and
all
also,
right.
let me also add a point here that of this 110 million, 70% of the business is USMCA compliant, which has got zero tariff. So most of our business are tariff, not really being charged on it.
Okay, all right. So approximately, sir, if I annualize these numbers, around 20% of your business has exposure to to America?
I said no, the total number is about 100 to 110 million.
So around 25% approximately.
Yeah.
25% approximately.
Yeah, agree, correct.
All right. Couple of quick questions, sir. Suprajit Controls Division, which is the largest part of your business. Well, you have been in that vicinity, 360 to 380 crores approximately. But you have been getting new orders globally as well. And for the last many quarters, it's in that vicinity of mid-single digit growth. What's the outlook, particularly for this division? Can you start doing gradually 400 crores per quarter?
In controls division, you must understand that certain businesses, when the project time is over, they go off the table and the new contracts come into picture.
Yes.
Globally, there is automotive is on a negative growth path. Despite that, we are growing about 6-7%. That itself shows when certain projects drop off and new projects come up, the net new projects are in double digits, more than double digits. To see that the projects that is going end of life are more than covered by the new contracts. I think that's a very important part as far as the controls division is concerned. Second part is, I think, again, controls division, you would see had a phenomenal turnaround in this quarter. From the last year's, I think, 8%, we have jumped to 12% EBITDA margin with that kind of a growth. So that means to say that underlying business is performing exceptionally well.
Okay, all right. Just one more question, sir. So you're saying the controls division, you're not too worried because you're outgrowing what the industry is growing. The industry itself is going through a lull period, but Suprajit is outperforming. Got that. A quick question on the domestic cables division. Out there, margins had come to around 15%. Earlier, you were doing high teens. What is the outlook on margins from here?
I think on the India's standalone business, particularly in domestic cable business, it also gets the overheads gets added on from both corporate as well as our Suprajit Technology Center. Suprajit Technology Center, as you know, we have got 100 plus engineers, which probably was just about 50 people last year at the same time. So those kind of overheads have added on here, which is getting accounted under the domestic cable division. But if you look at the standalone domestic cable division without these expenses, it is very much in the same pattern as it was in the last year. So we are looking at investing money in the long-term growth of the company, and that has been absorbed by the domestic cable division.
Sure, and one quick word on the lamps division then, because that continues to see order cancellations, that too for some of your high margin brands, which is the Trifa brand particularly. So, what are you hearing from the clients on this front, and, how do you assess the performance of the lamps division specifically going forward?
The Phoenix Lamps division had a muted quarter, largely because of the international business. We have fairly strong businesses in Middle East and Africa under Trifa brand, and that business was sort of under lull or a hold in the last quarter, and it will be under hold for this quarter also. So the growth for this quarter, Phoenix Lamps may also be more or less flat, but I think the margins will probably further consolidate. But I think these are all question of timing. And I think once the distributors exhaust their, products in their shelf, I think the order flow will come back in the second half, and we should be able to recover those margins and business in the next quarter or two.
Okay, all right. So final question from my end before I let you go. SES, that one you've been guiding that, you've taken various measures, and hopefully by the end of this fiscal, you can turn profitable. I want to ask you whether you stick to that. Can it break even? Because I think most of the revenue comes in from Europe, which is soft. And also, the other parts of the globe itself are in a bit of a tizzy. So do you think SES can turn profitable in the second half of this fiscal?
Yeah, we have guided that by Q4, we will be a bit operative on Suprajit Controls division. We still hold that guidance. In fact, if you see, in the first quarter from the last year's 30+% EBITDA loss, we are under 20%. That too with just 1 month's operation of our new part of the transaction, which is Canada and China, which is the profitable part. When the full quarter is into the baking of the quarterly result and the improvement that we are significantly doing at Morocco, we feel that this improvement will continue to grow as we go forward, and we continue to stand by our guidance.
All right. Thank you so much, Mr. Rai, for joining us and giving us your perspective on how the Q1 numbers were and what the company future growth trajectory would look like. Thank you so much. But on that note, let's slip into a very short break. We'll get you the management of Brigade Hotel Ventures after the break, so don't go anywhere. Welcome back. You're watching Chartbusters on CNBC TV18. Let's bring you an exclusive. Sources are telling us that there may be a top management change at Suzlon. My colleague Rachna is here with more details. Rachna?
Well, it is a big leadership shakeup at Suzlon Energy, where Chief Financial Officer Himanshu Modi is all set to step down and take up a role at Sammaan Capital, formerly known as India Bulls Housing. Now, Modi joined Suzlon in August 2021 and is known for turning the fate around of the company, because he joined at a time when the company was struggling, when wind energy major Suzlon was majorly dealing with difficult wins in the financials of the company. But in his 3 years of joining the company, he was quite instrumental in driving the complete turnaround, which was cutting debt to zero, boosting profitability, building a healthy order book. So his efforts have been widely credited in turning the fate around for Suzlon, and now he will be taking up the same role at Sammaan Capital, which also would mark a sectorial shift from him, going from renewable energy to financial services. Now, Sammaan Capital, speaking of it, formerly known as India Bulls Housing Finance, is an NBFC which has been focused on housing finance and has AUM of around 66,000 crores. This would mean a significant shift not only for Modi but also for Sammaan Capital. So we would be keeping a keen eye out for that.
Well, thank you so much for that, Rachna. Suzlon Energy on our radar for now. The stock is up almost 1%. But moving on then to another earnings conversation, Brigade Hotel Ventures posted a good June quarter with revenue and EBITDA growth. The company also turned to profit in Q1. And we are now being joined by Nirupa Shankar, who's the managing director, to break down the quarter and the road ahead. Well, good morning to you, Ms. Shankar. This is Vamakshi joining in. I'd first like to start off by asking you about the pipeline for hotel addition. You have around 9 hotels with 1,700 keys in the pipeline. So when would they come on stream in FY26 and in FY27? What would the trajectory look like?
Thank you. Good morning. Thanks so much for having me, Vamakshi. Happy to share the details of our past quarter. So you're right. In terms of the new hotels that are coming up, we do have 9 in the pipeline where we've tied up the land and the brand. Obviously, we are builders and real estate builders, so we build all our hotels greenfield as of now, and that's the plan. So most of the hotels will start coming in only by FY28, 29, and FY30. So that's how the massive growth plan will come in only in FY28 onwards. However, over the next couple of years, what we have in mind is we are launching a 45 key hotel, part of our mixed-use township in the World Trade Center, Chennai. So that the shell was created pre-COVID, and then then it was put on hold, obviously during COVID, and now we've decided that we will continue with the hotel. So that should take about a year to come up, but that will come up. It's still relatively small, but again, it's an addition to the portfolio. And apart from that, as part of our IPO proceeds, we had allocated about 90 odd crores for an unidentified acquisition. So right now our focus is to work on business development to figure out what is that asset that we plan to invest in. Because thus far, all our growth has been organic. We've done greenfield. We believe that's our USP, and we're able to build very cost effectively and efficiently. But hotels are asset classes that do take time to build. So this is the plan that we have in mind. 45 rooms will come up maybe in next fiscal, and then we are also on the lookout for an asset to buy.
All right. Hi, Nirupa. Good to see you in. So from around 1,600 keys that we have as of last count, where is that number headed with that addition plan that you're talking about? If you could help us out with that number. And also your ARR, how do you see it move up from here on as these 5-star hotels do get added to your kitty?
Yeah. So the 1,600 keys that we have operating now, with the addition of 1,700 that we have already tied up, will move to 3,300. But the ARR with the existing portfolio, because some of them have already been stabilized in the sense that they've been operating for a while, we are not projecting extremely, over-optimistic numbers. We've been fairly conservative in our projected ADR growth rate. We are looking at double-digit growth rate, but conservative, around 10%, 10 to 12% on good quarters. Some quarters it might be 1 or 2% lower. Some quarters it may be higher. But obviously, we are going to push for higher ADRs, but we don't want to really be over-optimistic. We want to take a conservative view on that. And in terms of once the portfolio changes, currently the portfolio, at least 50% of our portfolio are in tier 2 and tier 3 markets, be it Kochi, Gift City, Mysore. So these markets, the ADR is relatively low, and also we don't expect them to significantly grow. However, when we have our new hotels come up, and the positioning of those are 5-star deluxe hotels, one is, the Intercon in Hyderabad, one is the Grand Hyatt in Chennai, one is potentially another luxury island resort in Kochi. So then obviously we expect to see significant change in the portfolio. It would be too premature of me to give you, an exact number today, because these hotels will come up only in FY 28, 29. But the idea is that you will see a significant enhancement in the ADR just because of the positioning of the hotels.
Sure, and so how does this double-digit sort of ARR growth that you're factoring in, translate to the growth for the top line, number one, and number two is what is the kind of margin profile that you expect for FY26?
Yeah, so in terms of the overall ADR growth, generally the H1 of each fiscal is on the slower side. And we should see rather a better fiscal or rather better H2 in the latter part of the fiscal. Our portfolio is pretty well stabilized on the occupancy side. It has this quarter had about 75% average occupancy. Of course, we do believe that the occupancy has room to grow, but the 75% is a relatively good occupancy. So now the focus should be on enhancing ADR. Although some of the hotels perform in the mid-80s, as a portfolio level, we do have some hotels that have just launched. For instance, our Grand Mercure and Ibis styles. In the third quarter itself, it saw a good jump to about 68. So occupancy is, of course, one lever. ADR is the other lever. But, of course, ADR is always market-driven. Right now, our EBITDA margins are around 35%. And we do expect that we do expect an increase in that margin in the latter part of H2.
All right, Nirupa, it's good having you on the show. We enjoy our conversations with the Brigade Group itself, and we look forward to chatting up with you as business does evolve.
Thanks so much. Good seeing you as well. Bye-bye.
Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay with us, though. The team of Trading Arm is speeding by.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Reema Tendulkar and Hormis Fatakia. Well, when we started the day, it felt like, okay, we could continue some of the gains that we saw yesterday. The high today was 24,700, but now we are 120 points from the highs of the day as well. All the major indices in the red currently, and the PSU banks, which were supporting Nifty yesterday, they have come in for some profit booking. The bank Nifty is down 0.5%. We have the mid caps, which are struggling as well. Though Nifty PSU banking index saw some recovery from the lows as well. But Nifty Bank again at the day's low, mid-caps also not doing so well. So across the board, there is some pressure that has come by after yesterday's gain. Nifty Auto and Nifty IT, that is something which is supporting the Nifty from the lows. But realty, banks, talk about PSU banks, of course, we spoke about it. All of them are putting a lot of pressure. And we do have a lot of specific stocks which are making major moves in the broader markets. And that's something we'll discuss in greater detail on the show as well.
Indeed. In fact, now the Nifty is closer to 24,550. So this sell-off from the highs of 24,700 is picking up pace. And, as Sonal pointed out, it's only auto and IT which is holding up in the green. So the top 4 Nifty gainers are in these segments. So Maruti, Hero MotoCorp, M&M and Tech Mahindra. These are the 4 stocks on the winners list. But let's tell you what we have for you on our show today. Well, in our special segment, the big story, we put the spotlight on 2 stocks. One is Praj Industries and the other one is Astral Limited. Both of them, the accidents of the day, post their Q1 numbers. We'll decode the Q1 earnings, the valuation picture, how it compares versus peers. At 11:15 a.m. is our special offering, Crypto Corner. Manisha Gupta will be joined by Umesh Sharma to talk all things crypto. At 11:25, we'll be joined by the management of JM Financial to discuss their Q1 earnings, the way forward. 11:30, we'll chat with Subhi Throra from Smart Sun Capital to discuss the market fundamentals and put the spotlight on oil marketing companies in particular. All in all, it's a power-packed trading hour. And now Hormis has moved over to the big wall to tell us all the buzzing stocks at 11 o'clock.
There's some very interesting names in this list today, and most of them predominantly earnings reactions. We'll start off with Apex Frozen Foods first up, and that is an earnings reaction. The stock is up 10%. Of course, all of these shrimp makers, shrimp exporters have been in the spotlight because of Donald Trump's tariffs and so on. They've seen some selling pressure. But today the stock is up 10% after its results. The results were good as well. The strong EBITDA growth, margin expansion as well. But before the result move, the stock had gained only twice in the last 2 weeks, so showing that bit of selling pressure that has come in from the tariff related announcements. And despite this move, the stock has been a big value destroyer. The stock listed in 2017, and since then, every single year, the stock has given negative annual returns, barring last year, which was 2024. And even in this year, Y2D, the stock is down almost 10%. So Apex Frozen Foods, a value destroyer, but today trading with some bit of gains. The other one that I wanted to talk about in today's session is also an earnings reaction, and most of these names have traded with losses, but Sonata Software is an outperformer today, 10.5% higher. This stock has gained today after declining in 5 out of the last 6 trading sessions, so it's a strong move that the stock has seen. Almost 50 lakh shares have already changed hands today compared to a 20-day average of around 2.5 lakh. But again, despite this move today, the stock is down 40% year to date, which is likely to be the worst calendar year that the stock has had since 2011. Now the other one is VST Tillers. It came out with results yesterday, saw a big spike, ended 7% higher, is up another 7% today. The stock is up 15% as in the last 2 trading sessions. You already had 2 lakh shares that have traded in the first couple of hours compared to a 20-day average of just 8,000 shares. And lastly, Man Industries is the other one. This is an underperformer today. It's down around about 8% now. That's declined in 5 out of the last 6 sessions. Almost 13.5 lakh shares traded versus a 20-day average of 1.5 lakh. It has broken below the 50-day moving average with this 8% down move, but has been a good return, has delivered good returns in the last 5 out of the last 6 years. So earnings reactions predominantly, the tilt is for now towards the upside, but more towards the losing end are picking up pace as well.
Okay, all right. Thank you so much, Hormaz, for joining us. That's an interesting list, big buzzers that we are talking about. In fact, this is our time to go across to our special segment. This is the big story where we highlight key stocks with themes and deep dive into their financial and historical performances. We've been talking about a lot of stocks. Today, we will now be talking about a lot of other stocks. In fact, now I'll be going across and tossing to Vamakshi, joining in on Praj Industries. Vamakshi, let's first up start with how do the numbers look this time around?
Well, Sonal, a weak set coming in from Praj Industries. The revenues dipped by almost 8% on a year-on-year basis. The execution was quite weak. The EBITDA margins contracted by around 825 basis points, resulting in a nearly 66% fall in the EBITDA. And the net profit too saw a very sharp cut of almost 94%. And the net profit now is only at 5 crores. Now, keep in mind that in the first quarter of last year, there was an exceptional gain of around 28 crores on profit of sale of land. But keeping that aside as well, it's a very sharp fall as far as profitability is concerned. Apart from that, let's also take a look at how the different segments performed this time around. The bioenergy, which accounts for nearly 60% of the company's revenue, saw a sharp knock of almost 24% this time around. On the flip side, what did well was engineering, up 29%, and high purity, which was up 41%. Largely, the impact on performance came in from the domestic ethanol business. There was a delay in execution cycles here. There was liquidity crunch from the customers' end as well. The Genex business as well continued to incur expenses. However, there were no corresponding revenues that were incurred this time around. And apart from that, there was also delayed execution in a couple of high-value engineering orders, which led to high labor as well as infra costs. The ordering activity too, this time around, was lower by almost 11%, and quarter-on-quarter as well. It was down at only 795 crores. So weak set coming in from Praj Industries this time around.
And Vamakshi, clearly their core business, the biofuel, which you said is a majority of their revenues, was the only segment which was under pressure. So Q1 was weak. I mean, is this like a blip? I mean, was this the only weak quarter for them? I mean, just give us a sense of the historical picture in terms of financials.
So when we look at the trends, Reema, largely we've seen that the company has been posting weak numbers, quarter after quarter. Look at the, let's first look at how the company has done on the last 5 years. So revenue has grown at a CAGR of almost 24%. The net profit is up 23%, and the stock performance has also been quite phenomenal. But FY25 was particularly, a blip for the company. Revenues declined, the margins came under pressure, and the net profit also saw a very sharp cut. In fact, in the last couple of quarters, when you look at the revenue, in the last 5 quarters, we've seen actually 4 quarters of revenue degrowth coming in for the company. The margins also used to be in double digits, but now they're back into the single digits, and this time around at 4.9%, it's the lowest margins that we've seen in the last couple of quarters. Apart from that, the profitability has also declined consistently for the last 4 quarters. So, if you look at the trends as well, over the last couple of quarters, the company has not done very well.
Not delivering on the numbers front, Vamakshi. It must be showing up on the price as well, right? Because the stock has halved from its peak. Incidentally, the peak also happened on the 1st of January. Since then, the stock has halved. So what, in terms of the valuation picture, does Praj now throw up compared to what it was at its peak?
Well, Hormaz, in FY25, the PE ratio was at 55 times. This is the peak PE ratio that I'm talking about. Since then, the current PE ratio has now fallen to 35 times, which is a fall of almost 57%. So therefore, the valuations have corrected quite a fair bit for Praj Industries. But, in terms of what could be the next valuation re-rating triggers, number one would be the contribution from Genex. Keep in mind that in the previous con call, the management had highlighted that meaningful revenue from this particular, Genex could start coming in from the second half of FY26. Apart from that, a better operating environment. Keep in mind that the macro environment for Praj Industries has led to the kind of declines that we've seen, over the last couple of quarters. So if this improves, probably the earnings might also improve. And the third and most important is improvement in margins. Now, the first target for the management is bringing it into the double digits, is what they've been highlighting over the past couple of quarters as well. So let's see whether or not that happens, and that could be a big re-rating trigger for Praj. A con call is scheduled at 12 p.m. So we'll be watching out for the commentary that comes through the management as well.
Oh, yes, absolutely. We'll do that. Thank you so much, Vamakshi, for detailing those numbers for us and telling us what the future outlook is, and especially when it comes to valuations as well. That's our big story, but we'll slip into a short break. When we come back, we'll put focus on the crypto market with Manisha Gupta on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. This is our special offering, Crypto Corner, and I have with me technical analyst, expert Umesh Sharma. Umesh, hi, thank you so much for joining us here at CNBC-TV18. You've been following technical charts for a very long time, but many people ask, this is a question that has been asked for a very long time, on whether or not technical analysis works with cryptos, because they're very, very volatile. So does it really work?
Definitely it's work, because we trades on price.
Right.
So price are same. So we follow technical analysis like RSI, indicators, support and resistance. We can use in crypto as well. So it works very well.
And does it give you an indication on that the crypto prices or the Bitcoin prices are going to rise from here or fall from here? Does it give a quick indication on that?
Yes, there are some indicators because crypto has a different nature and it's a one-sided market. If you find the good rally on technical by the help of technical charts, so you can earn good money.
All right. What is it that, as a time frame, that you would advise crypto traders to get into? Should you hold for a medium term, a longer term, 1 to 3 years, how longer than that? What is it that you advise?
If you're using technical charts and if you are a trader, so if you're an intraday trader, so you can use 5 minutes or 10 minutes charts. And if you are short-term traders, so you can use daily chart. And if you're a long-term trader, so you can use weekly charts.
But what is the time frame that one can earn maximum profits in?
As about me, I'm using 5 minutes charts, and it's giving good returns because it's very much aggressive. So that's the only reason. So I made good money in intraday.
What is it that you would advise within cryptocurrencies to invest in? Is it going to be blue chips, or do you think some other altcoins also give equal kind of returns and are equally credible as well?
As about crypto market, so there's two currency like Ethereum and BTC. It's like a blue chip because it provides you stability, loyalty, trustworthy with the high liquidations. So you can consider as a blue chip. And there's some coins like Solana and Avi, and there's so much coins. So that is a sector analysis. Basically, that is a you can say that medium terms, and that will consider in 3 to 6 months. And some is coins like short term, that is a news-based coin and momentum. But I will advise as a beginner, you can avoid this.
All right. Also, what would you advise to have cryptocurrencies for a beginner to be part of your portfolio? Should it be 2%, 5%, 10%? What would you say?
I will say that 5 to 10%.
Okay.
Yes, that is a part of your portfolio.
And that is for beginners or people who have been investing for a long time?
For everyone.
All right. Umesh, also, this is a 24/7 market. It is awake at all times. So people who have their positions in cryptocurrency, suddenly they wake up in the morning and the whole market has changed. What would you advise them, and what is a better way of safeguarding yourself?
If you're a trader and you have a positions, so you try to stick on your stop loss because it's 24/7. So there is no gap up, no gap down. So you can consider as a stop loss in your trading, and that is the best chance. This is the best way to trade in crypto.
Umesh, a lot of people also tend to equate or in some sense look at equities vis-a-vis the cryptocurrencies as well. There are so many asset classes, and cryptocurrencies are a very new kid on the block kind of a thing. How would you look at cryptocurrencies vis-a-vis, let's say, currencies or equities for that matter?
Crypto is young. It is in adoption phase. And there is a good chance to, invest in some new currencies. They will provide you high returns and high growth. But there is a correlation between equity and crypto because equity gives you stability, long-term returns, compounding and dividend. Crypto provides high liquidity, high volume, high growth and high potentials.
So when you look at the overall market, for the Indians as well, it is going to be about very high taxes also, a 30% tax, an additional 4% of cess and sense of education, and then you have 1% TDS as well. In spite and despite of that, do you see India continuing to grow when it comes to cryptocurrencies?
Yeah, it's a growing phase. And if you talk about India, so India has a $120 billion crypto holding. With the 30% of tax, 1% of TDS, without government support and without any regulations.
So it is legal, but it is not regulated,
yes,
is how we have to look at crypto. How long have you been investing or looking at technical charts in cryptos?
I'm in this field since 2008, but in the stock market. But I'm using technical charts in crypto last 1 year.
Also, when it comes to investing, as you said, it can be a 5 to 10% of your portfolios as well. But the good thing about cryptocurrencies is that you can invest really less, 100 to 200 rupees as well in sense of tokenization.
Yes.
How would you look at that? And would you say that is the reason more and more people want to be part of this?
Because there's multiple coins. So you can invest in 100. You can start with 100 rupees as well. But there's some blue chip coins. There's some, low price.
There are 17,000 coins.
17,000 coins.
Yeah.
So that's the only reason you have lots of option in crypto. So you can invest with the low amount.
So Himesh, even as India is perhaps one of the fastest growing markets, we've seen more business actually come to Singapore and Dubai, and US of course seems to be leading it all. How far behind would you say will India take to catch up to these markets?
If we talk about India, so India is the #2 country in the crypto adoptions. So with the regulations, without any government support, and if we talk about Indians, so that is the money from the retail trader, not for big investor. So I think India is leading.
Of course, absolutely. Umesh, thank you so much for joining in today and making sense of all things cryptocurrencies. So, well, yes, as Umesh tells us, cryptocurrencies absolutely do follow technical charts. So, if you are one of those, you can absolutely look at charts and start trading in cryptos. 5 to 10% of your portfolio can go to cryptocurrencies, and you can invest as low as 100 rupees when you are buying your favorite coin there. Umesh, thank you so much for taking time out for us today. And with that, it's break time. More on the markets on the other side of this break.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. You're still tuned into Trading Hour. JM Financial is in focus after reporting their Q1 numbers. Net revenue surged 22.5%, but profit after tax more than doubled as compared to last year. Nishit Shah, who is the Group CFO at JM Financial, is joining us now to take a few questions. Mr. Shah, good morning. Thank you so much for joining in. Well, it's been a good set this time around, and this quarter, the profit was also supported by strong recoveries that we saw in the private market segment. That's where we've seen a 5 times jump in profits also on a YOY basis. Tell us what's the outlook on recovery in coming quarters. You had earlier indicated it will be around 300 crore rupees every year. Do you stick to that guidance?
Yeah, good morning. Thank you for having me on your show. So I'll just give you a background on the results. Apart from the recoveries, we've had a strong momentum in terms of net revenue growth as well. So it's up around 22%. Even the pre-provisioning profit is up 22% on a year-on-year basis. While there has been a recovery, there has been a strong performance all around, I would say. In terms of the recoveries, we've had a reversal of around 200 odd crores this quarter, which translates to a recovery of approximately 230 to 240 crores. So we are pretty much on target in terms of the recovery. As far as the next few years are concerned, the efforts are on. So we continue to stick with the guidance.
Can you just, for the benefit of our viewers, Nishit, can you tell us what the guidance is?
Yeah, so we had provided roughly around 900 crores over the last 2 years. And we've been stated that we'll recover one third in each of the 3 financial years, 26, 27 and 28. Some part of 26 is done with, and that is the reversal that has come through in the PNL.
Got that. So 900 crores of provisions will be recovered in the next 3 years. Also on private credit, what is the current book size? Because you had also given a guidance of achieving 10,000 crore in, I believe, by 2030, FY30. Tell us a little bit more about your private market syndicate book, because that seems to be clearly the growing market space for you.
Correct. So we are around roughly 6,000 odd crores. We had guided that we would hit 10,000 crores by in the next 3 years. We've seen very good momentum in terms of transactions, both on the syndication side as well as on the loan against share side. So that guidance is also pretty much on track.
Won't you beat the guidance if you're already at 6,000? 10,000 doesn't seem so far now.
Yeah, so there will be a mix of syndication. So as we say, as we have earlier guided, right, it's not focusing more on the loan book on the balance sheet. It's also having a syndication effort, which will really help us in terms of the ROEs, because you generate a lot of fee income on that. So that is kind of the business that we want to underwrite. So it's not necessarily loan book growth, but it's also an element of syndication which is involved here.
Nishit, firstly, thank you for joining in. The Amphi data that came out yesterday, it showed a lot of resilience. It was a multi-month high in terms of equity inflows. You've also gained market share for your asset management business at around 4.3% currently. Now, with the data that has come in, where do you see your asset management business being placed going forward? And is there an aspiration to take that market share from the current levels to past 4.5% and then maybe even go to 5%?
Yeah, that's a great question. So on the wealth and asset management side, we've had strong execution. If you really look at our strength of our relationship managers and sales employees, that has gone up by almost 45 odd %. If you look at really the recurring AUMs, that has gone up to almost 31,000 crores, which is up 37%. And that is actually now constituting 27% of our overall AUM. In terms of our mutual fund business, we've hit almost 12,000 crores in terms of non-liquid AUM. That has increased by almost 80% in the last 1 year or so. You are right in terms of the market share. There has been an uptick, and obviously with the kind of execution and the expansion that is going on, we will strive to keep improving on the market share.
Okay. Nishit, your affordable loans segment, that saw some margin compression this time around. What's the outlook on margins here? What's the target with the affordable housing segment? How do you plan to grow it? And the guidance that you have here?
Yeah, so affordable housing, the guidance is pretty clear. We are roughly around 3,000 crore of assets under management right now. We want to take it to 5,000 crores in the next 2 years by FY27 and eventually hit 10,000 crores by FY30. That's broadly the guidance that we have. In terms of your question with respect to the margin, it's a one-off. It's largely on account of some of the assignment transactions that we have done. But it's more like a one-off.
So, Nishit, how much of your book is LAP? Because some participants are seeing some pressure that has come by. Your gross NPAs have also increased. Is that also a one-off? If you can explain that in greater detail.
Yeah, so that's also kind of one-off because we have a strong collections team as well, which is focusing on the recovery part. And to be honest, these are like less than 10 lakh ticket size loans really. So the recovery does happen, and that is the trend that we have seen in the past. So I wouldn't read too much into a one-off spot in the gross NPAs.
All right, Nishit, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of JM Financial, the stock though, is off the highs of the day. But we take a short break. More on the markets on the other side. Stay tuned. Nearing the lows of the day is the index, the perfect time to get in what the FNO data is currently suggesting. Sudarshan is joining in with an update from the FNO desk. Sudarshan.
So it's a fight between bulls and bears. While bulls are trying to take Nifty to yesterday's high of around 24,700, bears are doing everything to keep Nifty below 24,600. And currently, market is at day's low. And it's reflecting in two important parameters. First, India Volatility Index, it remains flat around 12 level that if you see currently. And second, PCR. So yesterday we saw from the short of from 0.66, we saw short covering. It went to as high as 1.07 and currently it's back below 1. Currently it's at 0.96. So what's happening on the option front? In the put side, if you see two active options are 24,600 and 24,500. And on the call side, 24,700 and 24,650. So it tells you that immediate resistance for Nifty is around 24,700 and immediate support would be 24,514. That is also 100-day moving average. If we manage to cross 24,700, the next resistance comes around 20-day moving average. That will be 24,850. Two stocks that I have taken. First one is Astral, that is seeing fresh shorts after a weak set of earnings that company has reported in Q1. And one is fresh longs that one stock is seeing, that is SJVN, after a healthy set of earnings for Q1.
Okay, all right. So those are some FNO trends that we are tracking. Thank you so much, Sudarshan, for joining in. It's time to take a short break. Up next, we'll discuss the market fundamentals with Sumit Rohra from Smartsun Capital.
Welcome back. Let's get chatting about the markets and where the opportunity lies. Sumit Rora from Smart Sun Capital is now with us. Sumit, it's been such a range-bound market. In the last 1 year, we haven't seen any return for the large caps. The mid caps, in fact, are down. So in such a market, where is value emerging according to you? And how do you go about thinking about it?
Good morning, Rima, and thank you so much for having me on your show. So, Rima, I'll just give you a little perspective. If you see the total profit which corporate India made in FY25 was about 16.5 lakh crore. Now, of that, if we just digress and we see the profit of PSUs in India has been something like about 5.2 lakh crore for FY25. Now, this is in spite of the fact that, you've had, the oil marketing companies report lower profit because of, the LPG subsidy, which was not compensated, which has now been compensated. So the thing is that the PSUs in India contribute about 31% of PAT. Today, if you see the market cap of public sector in India is about 13 to 14% of the Indian space. So I clearly feel that, in the public sector space, there's a very compelling opportunity and investment theses have been there. And in fact, if you're well aware that, the public sector has had, one of the biggest bull markets in the last few years led by defense and railways. But however, Rima, now I think a space which is, getting pretty attractive, from almost every perspective, is the oil and gas space. And particularly in the oil and gas space, something which clearly stands out is the oil marketing companies. Now, there are so many reasons which I can, highlight to you is that why these basically companies, look good. Firstly, you see the overall backdrop, right? I mean, you have, President Trump, basically pushing for the end of the war. You have, OPEC unwinding cuts. So effectively, what you're basically seeing is that crude is now relatively going to settle in a lower range, somewhere between 65 to 75. Now, this is the sweetest spot for these companies because of the fact that, there's going to be, oil is going to be the biggest tailwind for them. As you're aware, the government has paid the LPG subsidy, it's absolutely staggering. It is 9% of the value of HPCL's market cap, 7% of the value of Indian Oil's market cap, and about 6% of BPCL's market cap. So these are big numbers for companies, which today have anyway got asset values sharply, which is basically not anywhere close to, their market cap. I mean, I'll just illustrate a few overall space, and then I'll come back to, one company in particular, which I think looks even more attractive. So, I mean, if you look at it today, Indian Oil has an asset value of 5 lakh crore. Okay. I mean, its market cap is 2 lakh. I mean, a company like Bharat Petroleum has about 2,20,000 crore asset value and its market cap is barely 140. HPCL is well about 2 lakh and its market cap is 85,000. So the thing is that, you've got very sharp, intrinsic companies of India today trading, at a sharp discount to intrinsic value, asset value, in spite of the fact that, the PSU space in India is completely re-rated, right? So the fact is that, I think that maybe its time has come in the sun and, it's probably time where, investors should, have a close look at them because, they actually contribute about 3.3% of profit to corporate India, whereas the OMC's market cap is just 0.9%. So, in every parameter, in terms of ROE profiles, in terms of dividend yields, I mean, the ROEs are about 22, 23%, which is as healthy as, private sector. Your dividend yields are about 4-5%, So I think that this space looks extremely compelling, Dima.
So, Sumit, just wanted to also understand whether you're invested in any of these stocks, and if yes, what are your preferences amongst the three oil marketing companies?
So absolutely. So Rima, yes, invested for sure. And what basically stands out, in my opinion, is HPCL followed by IOC. Two reasons. Firstly, if I can just spend about a couple of minutes talking about HP. It's basically a company who's now entering a payback period. It's finished its capex cycle. It's now basically commissioning all of its projects. In fact, this is the only company in India which is doing something called a residue upgradation project. So what does that technically mean? That basically means that every refinery has a fuel and oil component which is about 10%. So that will actually now get converted into middle distillates of ATF and diesel. So your distillate yields will now move up to about 83-84%. And that will ensure that it's on par with peers. It's fully integrated. It doesn't need to buy any products from other refiners. Integrated margins will pick up sharply, and that will basically lead to its EBITDA now being 2 times of capex. So I actually foresee that in the next year, a year and a half, maybe latest two, its EBITDA itself would be about $4.5 billion, which would be nearly 50% of market cap. So I really think that these companies, this company stands out in my mind because the payback period is now starting. Its capex is over. Free cash flow generation is going to be extremely high. ROEs are
Okay. I just have one question on this, Sumit, because you're talking about HPCL. It has the highest exposure to the marketing segment as well. Right now, it has worked in terms of LPG under recoveries, but marketing continues to be very volatile for the same reason that the cuts have not been passed on to the consumers as well, and that's why marketing margins have been high. But it was impacted the most as well because of LPG and no compensation coming in for LPG as well. We'll have state elections soon, and that is the time when oil marketing companies are the most volatile. So is it a short-term perspective in terms of investment, or is it long-term as well? Because even globally, refining capacities are coming in that could impact refining margins as well.
Rima, Sonal, I'm sorry, your point is very well said, but to that, I have a little bit of a different view. I mean, if you just see the actions of the government over the last maybe 2 years or more, it's been very prudent, right? I mean, the only thing they've done is that they had cut 2 rupees of fuel prices in March of 24, and they've just increased 2 rupees of excise in April, which is basically only to compensate the oil companies. So effectively, the government's focus is very clearly on energy security, and today these companies are very clearly on the forefront of providing energy security in the country. So I think there's a distinct change, the way the government is, perceiving this, particularly, of, the geopolitics in the world. So clearly, the LPG component re-emphasizes investor confidence in this space, and it clearly goes to show that the government is, interested in these financial metrics of these companies. So
Makes sense.
I really think that, this is the fuel price is more of noise because the companies earn well over normative margins.
Got it. Thank you so much for joining us today and giving us a sense of what's happening in the oil marketing company space. And of course, we'll have conversations about other sectors as well very soon. But the other big story for the day is Astral. Ria is joining us now. Tell us, how were the numbers this quarter, Ria?
Well, yes, this time a very weak set of numbers for Astral. The overall demand scenario in the polymer industry was quite weak, and which is why the revenue fell by around 1.6%. EBITDA and net profit also taking a hit of around 14% and 34%. Margins have also contracted by around 191 basis points this time around. Now, the company has said that during the quarter, because the PVC resin prices were so volatile, this volatility has resulted in inventory losses, and it has also affected realizations for the company. But they've also highlighted that PVC prices have now been settling down since the beginning of Q2 of FY26, and market conditions have also been seen improving since July.
So, Ria, roughly, Astral is a pipe manufacturer, right?
Yeah.
Where it would compare with the Phenolexes, Supremes of the world.
Yep.
So, tell us a little bit more about the company. Which segments does it operate in, and how did the segments perform, each of them? Was it one segment which was weak and that can recover? Tell us a little bit more.
Well, yes, so the plumbing business is the main segment for the company. The revenue this time around for the plumbing business fell by about almost 6% on a year-on-year basis. Margins also contracted by around 150 basis points, and volumes were flat for the plumbing business at about 56,000 metric tons. And the plumbing capacity has also been increased a little bit in this quarter. The other segment that they operate in is the paints and adhesives business. This is about 28% of the revenue of the company. Revenue actually went up by almost 10% for this segment, but margins again contracted by around 280 basis points.
Yeah, the company has also announced an acquisition, right? Along with their numbers, you tell us more about that. It's a 120 crore acquisition.
Well, yeah, that's right. So they are going to acquire an 80% stake in a company called Nexalon Chem Private Limited, and the reason that they're acquiring this company is that they will be able to manufacture CPVC resin, which is a key raw material of the company, and this is going to help in cost optimization for the company and also substantial margin improvement once the operations of this plant start in the second quarter of FY27.
Okay, all right. So that's about the acquisition. Let's wrap it up in terms of valuations. Where does it stand against its peers?
Well, in terms of the valuations for Astral, that currently trades well below its 3-year average PE. The peer Supreme Industries, that is actually slightly above its 3-year average. And smaller players like Phenolics Industries and Apollo Pipes, they are near their respective 3-year average PEs. And Prince Pipes, another small player, that is also significantly lower than its 3-year average PE.
So Astral is the most expensive amongst all the pipe manufacturers.
That's right.
It's always been, it still is, though it's trading at a discount. And how did the peers perform in terms of financials?
The peer performance was also quite weak. If you look at Supreme Industries, which is the true peer for Astral, very weak set for them as well. Net profit and EBITDA fell by around 26% and 18% for this one. But they did report a volume growth of about 5.7%. And they are expecting a 10 to 12% volume growth in FY26 as well. Even the other players reported quite a weak set of numbers. But the important point to highlight here is that all of these companies, Astral, Supreme and Prince Pipes, the commentary is quite positive. They are expecting a demand recovery from Q2 onwards, and they are saying that PVC resin prices have been seen bottoming out from July.
Yes, that's the major commentary. In fact, Supreme said it to us on CNBC-TV18 itself that they are expecting prices to bottom out from here on. Thank you, Ria, for making sense of what's happening with Astral and the market moves as well. For the markets, by the way, Nifty is down 40 points as we speak. We have the mid caps, which are down around 86 points. Bank Nifty is the one which is underperforming and putting that pressure on the Nifty at the day's low across the board. So we'll keep tracking markets for you. But for now, we'll wrap on this edition of Trading Hour. Stay tuned. Halftime report is up next.
D Street at day's low. Market turns cautious ahead of the crucial Trump-Putin meet later this week with implications for India. Auto and IT eke out gains while realty, industrials and financials drag.
Hindalco's US arm Novelis posts weaker than expected operating profit on elevated scrap prices and a higher net tariff impact than in the previous quarter. Analysts trim estimates after baking in the expected cost savings.
Indian Hotels is set to buy 51% stake in two entities with 135 mid-segment hotels across India and Sri Lanka for around 200 crores. The move will help the hospitality major expand in a new segment with a wide geographical footprint.
Astral and Praj Industries dip after posting disappointing numbers, but SJVN gains on a healthy show and a new solar unit starting up while Titagarh Rail climbs after declaring the production loss in Q1 will be made up. Hello, good afternoon, and thank you for tuning in to Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, with me is Ekta Batra as well. Ekta, good afternoon, but yesterday what we saw was really a good day coming in. Today a bit of a consolidation. The market did see recovery, but then again we came down again in today's trading session.
Hi, Vinny. Yes, it seems as though the headlines coming in from US and China also are probably deterring a little bit of sentiment at this point in time. And we do have that big Trump-Putin meet to watch out for. So that'll probably be very critical in terms of where the sentiment goes. But nonetheless, for the Nifty, currently just about lower by around 19 odd points. We have the Bank Nifty, which is underperforming with a cut of around 0.5% at this point in time. But nonetheless, let's begin the show, in fact, by focusing on Indian Hotels. The company is planning to acquire 51% stake in A&K Hotels for 110 crores and 51% stake in Pride Hospitality for 94 crores. Our colleague Prashant Nair spoke to Puneet Chatwal, who's the managing director and CEO of the company, and began by asking about the rationale behind the acquisition and what it means to the Taj portfolio of hotels. Listen into the conversation.
We are very pleased with this step that the organization has taken. And this positions Ginger brand, which was launched with a lot of elan 20 years ago. And this is a most important milestone in its journey to get to a portfolio of 250 hotels, makes it the market leader in the mid-market segment, and a brand that will address the needs and wants of the larger market in India of approximately 400 to 500 million people in a few years from now, and covering a lot of destinations, especially the tier 2, tier 3 markets. Taj obviously was, is, and will always remain the crown jewel of the group and of India, if I may say so, as the world's strongest hotel brand for 4 years now out of the last 5. And India's strongest brand across all sectors. But now, with the positioning and the reimagination of Ginger, we are very, very pleased with this development. And it takes us to not only 250 hotels portfolio, but it will take us to a brand that will, together with its all-day diner with Human, will start redefining the mid-market space and how this space will look like in the years to come.
So this acquisition takes you to 250 hotels in the mid-market segment. That's what you're saying?
Correct.
Okay.
That's correct.
Because
and 550 in all. So we crossed 55,000 rooms, 550 hotels, which we have given the guidance for 2030 under our Accelerate 2030 of 700 hotels with a ROCE of 20%.
700 hotels in total, 500 operational by 2030.
That is
correct. So, and this will sit where, sir? Between the, somewhere between the Ginger brand, below the Vivanta brand?
Below Gateway and Vivanta, but it will not, the whole endeavor and the aspiration is to convert the majority of the portfolio into Ginger. So A&K or Pride are the management companies which we have taken a majority stake into, but with the very clear goal of converting that portfolio into the Ginger branding.
Right. So there will be a rebranding exercise.
There'll be a rebranding exercise over the next 18 months. Some will take 18 months, some will take 3 to 6 months. The hotels under development can be easily changed. That's not an issue. Some may not fit in and might have to exit. So we'll do it case by case. A team has been appointed, which will start work early next week on this journey. We'll have a kind of a conference with all the owners, and it's a very normal process. Happens all over the world with the brands, and a journey that does not happen overnight. It's a process which will take up to 18 months. Not for all, but for some 18 months, for some, as I said, 3 months, for some 6 months. But that work will have to be done.
Got it. So just a quick point, there are the 135 hotels in total, right? The portfolio, and 80
That's
are
correct.
operational.
That's correct.
Okay. And this entire, so this is 135 plus what you operate currently gets you to 250.
That is absolutely right.
Okay. Could you talk to us about tariffs, where the Ginger hotels operate at, what they, the ARRs and where this portfolio operates at?
The majority of the Ginger hotels operate somewhere between 3,500 to 6,500 rate. There are certain outliers which could be below 3,500, like a Ginger in Chanakyapuri in Delhi is at around 9,000 plus. So those are like the outliers, but the majority of the portfolio, depending on a tier 1, tier 2, tier 3 city, is between 3,500 to 6,500. So our opening that we have often spoken about, Prashant, you and I, and on your channel, the Ginger Mumbai airport is exactly at 6,500. And our hotels in Goa are around 3,500 to 4,500. So I think that's the mid-market range. And obviously Mumbai achieves higher rates, so it is higher. Delhi NCR achieves higher rates, so it's higher. But there are other cities like Bhubaneswar, there are other cities like Pondicherry, Agartala. They are at a different rate positioning.
Yeah, absolutely. Would you, the total outlay for this is about 200 plus crores. Will you have to, does this include any upgrades, etc., that you may have to do?
Yes, it does, and we have kept money aside because obviously we want to stay true to the brand and the brand values, and that money will go in the company, and we will spend money on what we call a PIP, which stands for Property Improvement Plan.
Got it. So there is money within this, and does this change in any way, your guidance for the full year, Mr. Chatwal, for the overall business per se, or not really?
I always say we promise, we deliver, and what we have guided for, hopefully we deliver that a little early and a little more than the guidance that has been provided, which stands the way it is, and we'll keep guiding if something was to change in our quarterly results and reports.
Got that. Just one near-term question since I have you. How was, you said that Q2 momentum should sustain, even though, July was a high base. Is that panning out as we are in the quarter now? And is August turning out to be a strong month?
Yes, the second part, August is turning out to be a strong month. The outlook for September is also very strong, but it would be fair to say that the sector has been able to overcome the challenges posed by the unfortunate incident in Kashmir, followed by Operation Sindoor, then the airline accident, or the Middle East geopolitical tension between Iran and Israel. It did have an impact on the business, but we are seeing very strong recovery in the month of August and September. So our outlook and our guidance of double-digit growth stands. And I don't see, there'll be some headwinds which come every now and then. But post-COVID, I think all hospitality companies all over the world are very well equipped and positioned to navigate through these challenges.
Got that. And just one last question before we wrap up. How much more, we have a long-term sort of capex plan which you've guided to the market by 2030. You're spending 200 crores on this acquisition. Will we see more in FY26?
Well, I think our plan is to spend every year, which we have also guided for, around 5,000 to 6,000 crores in the next 3 to 5 years. That includes acquisitions, that includes renovations, your routine capex, but it also includes our greenfield and other investments, like we are building the 2 islands in Lakshadweep, which will get done. We'll be doing the hotel in Bandstand. We're doing the palace in Agartala in Tripura. So there are some selective investments which will keep happening on the capital heavy side. And the routine capex is around 3 to 4% of the revenue of the property. And all that adds up to more than 1,000 crores per annum.
Okay, so that's the management of Indian Hotels saying that they will maintain guidance as of now, and the portfolio of the 250 hotels will really make them a market leader in the mid-segment category. We need to take a short break on that note, but on the other side, we'll be connecting with the management of Rainbow Children's Medicare to talk about their new acquisition on the other side. Stay tuned. Welcome back. You're still tuned into Halftime Report on CNBC TV18. Well, let's talk about Rainbow Medicare. It has gone shopping as it's acquired a 150-bed hospital in Guwahati, Assam for an enterprise value of 171 crores with an aim to deepen their presence in the northeast. Dr. Ramesh Kanjarlia joins in for a quick take on this particular acquisition. Dr. Ramesh, thank you very much for taking the time out. If you could just brief us on this particular 150-bed hospital that you've bought, enterprise value is around 171 crores. What's the reason behind this particular acquisition? Is this now a foray into the northeast region of the country?
Yeah, thank you very much. So it's always been a kind of, perhaps our, the listing was is going to northeast as one of the important geographies, which we waited for a long time, and I think finally it happened. We evaluated northeast market, whether to go greenfield, or whether to go as a kind of acquisition or through the fresh entry. So it made up, this is a significant acquisition for us in the northeast because Pratiksha Hospital is a very popular women and children's health care, not only for Guwahati, for entire Assam and also neighboring states. So through the acquisition, Rainbow definitely would be able to kind of strengthen its capabilities further to establish hub and spoke model in the northeast.
Absolutely, Dr. Ramesh. Good afternoon. This is Vinny joining in the conversation as well. So obviously this is marking an important step, that foray that comes into the northeast region. From here on, what is your growth strategy? Will you be looking at more acquisitions, or are you going to be looking to expand Pratiksha Hospital in the northeast region further now?
We have acquired a 76% stake, and also that the 5 years the promoter is going to be with us, helping us to kind of expand further. And the 5 years we have a kind of a put and call options for the promoter. That's his wish. And we would like to kind of bring in our expertise to build a multi-specialty pediatrics, strengthen our pediatric tertiary and quaternary care in the northeast. So that's what is much required at the moment. So establish transport services, establish pediatric multi-specialty services, and also explore the northeastern markets for the hub and spoke model. The Pratiksha being the Rainbow Pratiksha is being a hub and spoke hub hospital, and we would like to establish some spoke hospitals in the neighboring states.
Okay, all right. Well, Doctor, you seem to have been on quite an M&A spree when it comes to expanding geographically. How much cash do you now have in your books post this particular acquisition? And what is the plan when it comes to further acquisitions?
I think we have about 730 crores on balance sheet, and we are using about 170 crores now. It's all internal accruals. So, and recently we did acquisition of a hospital in Warangal, which is about 30 crores. We still kind of left significant on the balance sheet to kind of support our the growth strategies like NCR, the Gurgaon projects, as well as Bangalore and Coimbatore and Rajahmundry projects.
Okay. Just a particular question with regards to Pratiksha Hospital. Give us a sense in terms of, what the operations are like. Is it making money on the EBITDA level? Is it making money on the bottom line? What are the occupancies, the average revenue per occupied bed? Are the blended margins or as a whole going to be lesser because of this particular integration?
It's pretty impressive. So they do about top line of 90 crores, and then they do EBITDA of about 23.5 crores EBITDA, and percentage-wise. And also they have about 1 lakh outpatients as footfalls, about 1,200 admissions in a year. They deliver about 1,200 babies, and they do significant IVF cycles, also about 700 plus IVF cycles in a year. So it's a 45,000 ARPOB is pretty impressive in that area.
45,000 plus is the ARPOB, right? Is what you're mentioning, and the margins are around 25%.
Yeah, about 23.5% margin.
Okay, 23 to 25%.
Yeah.
So this is a bit less than your margins, right? Because in Q1 you reported margins of around 29 to 30%. So would you want to aim, and what is your aim to bring, even Pratiksha Hospital in terms of margins to that level anytime in the next couple of years?
Ours is about 29% of the post-in days. We're talking about here is about pre-in days. Now, we have taken this the business acquisition. So therefore, there will be rental payout of 3 crores a month, 3 crores a year. So I think if you look at a kind of a post-in days, it may be a kind of somewhere around 27, 28%. But pre-in days, what I was talking about is 23.5 was the last year's one. Obviously, we're going to go and build this business much further. So I'm sure, and we will probably reach very close to our rainbow numbers.
Okay, you will reach to the rainbow numbers over there as well. And just in terms of overall expansion strategy coming in the southern region as well, where you dominate right now, anything on that front that you would like to highlight, given that you still have cash on your books?
Yeah. Now, I think we keep looking at acquisitions. That doesn't mean that we just go and acquire some hospitals, because it's very, very important for us. Philosophically, these acquisitions have to be aligned, and also where there is a possibility for us to kind of build a growth on top of what the existing acquisitions are. Most of the children's hospitals are very small in size. They're run by one doctor, so those acquisitions becomes difficult. For example, Pratiksha is actually run by a doctor entrepreneur, and he's got teams which have been staying with him for the last 15, 18 years time, very similar to Rainbow. So that's what attracted us to look at Pratiksha. Obviously, if there are any children's hospital group which is kind of is philosophically similar to closer to Rainbow, and also where we have a opportunity to grow the franchise, we will definitely look at it.
Okay, all right, Dr. Ramesh, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the management of Rainbow Medicare. It's an acquisition that they've made in Assam, and it has a top line of around 90 odd crores and an EBITDA of around 23.5 crores. They do IVF cycles, deliver around 1,200 babies per year. So a couple of stats coming in terms of their particular acquisition. Stock, as you can see, is up around 2%. We'll take a short break, but as we do that, here's a reminder for our viewers: unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back to Halftime Report on CNBC TV18. As of now, the Nifty's again moved back to the green. Slight bit of a gain coming in the last few minutes for the Nifty 50, as well as the broader end of the market as well is doing well. Look at the small cap index, that's holding on to gains of 0.3 to 0.4%, and mid cap is also trading in the green. But which are the stocks that are buzzing in trade today and moving around in today's trading session? We have Vivek joining in with us to give us those details.
Well, thank you so much for that. What's actually transpired, especially in the last couple of trading sessions, that as far as the broader end of the markets are concerned, the breadth has improved quite significantly. In fact, NSE 500 yesterday did see significant improvement in the breadth towards the end of the trading session. Today, again, what you're actually seeing is continuation, where you're actually seeing quite a bit of recovery and strong moves as far as the broader end of the markets are concerned. Shaily Engineering Plastic, remember yesterday this particular stock post results moved up almost 5 to 6%. Today, another up move. This is on the back of the fact that very strong Q1, and along with that, this company has given a strong outlook as far as the rest of FY26 is concerned. Sonata Software, now remember, whole host of stocks, especially as far as the mid-cap IT space is concerned, are doing very well in the session. This particular stock amongst one of the top NSE 500 gainers. SJVN, in the dying minutes of trade yesterday, it did see the company go ahead and deliver its results. A steady set of numbers, but the street is taking heart from the fact that the company has given strong capacity addition guidance for the rest of FY26. One of the key plans expected to commission in October 25. That is something that the street likes. The other stock, especially when you're looking at some of the laggards, in fact, like we mentioned in the mid-cap IT space, look at Coforge, Oracle Financial, Persistent, Emphasis, even a TechM for that matter, is doing quite well in the session today. On the other hand, quite a few laggards as well, especially if you look at a name like Astral, that particular stock all round with muted volume growth, stock lower by almost 7%. Praj Industries, again, this particular stock has been a significant underperformer, but even after that, the results have been quite muted. That stock lower by over 6%. KNR Construction, again, this particular stock, one from the infra pack, very muted set of results as far as Q1 was concerned. Profitability down over 25%. And Ace Construction, results came in a couple of days ago, but this stock, one of the top drags as far as the NSE 500 space is concerned today.
Okay, all right, Vivek, thanks very much for that. So that's all of the buzzing stocks today. Just watch out for Alchem, because that releases its numbers today and is holding up quite steadily ahead of that. So Alchem should come up for you. It's up around 2.5 to 3% at this point in time, doing well. Well, we do have the MRF numbers for you. The net profit is down around 14% on a year-on-year basis, but we have the revenue, which I think is up in single digits. So that should come up for you as well. Up around 7% for MRF at this point in terms of the Q1 FY26 revenue. More details coming in on terms of the EBITDA just soon enough. The stock is down around 2% reacting to its numbers. But Nigel is here now to tell us, to give us a daily update on what's taking place in the F&O space. Nigel, over to you.
Well, I think at around midday, the F&O data is not looking too bad, actually. And I say this because in the first hour of trade, there was some euphoria that played out, and there were aggressive long positions that got added. And suddenly those longs got stumped on the wrong side. However, we are seeing some kind of dips at lower levels. So that's why I'm saying the screen is not looking too bad. Remember, more than moving up, you don't want this market to stop falling. And yesterday we had a good bounce. Today, if you can end with some marginal green as well, the street will be pretty okay on that front. Now, the Nifty Bank, that's the one that's holding on to the 100 DMA. But the problem is the Nifty Bank is doing a relative underperformance. That needs to find its form. In yesterday's trading session as well, it protected the 100 DMA, and it showed some kind of strength that it was wanting to move towards the 56,000. That's missing today, and the Nifty Bank will have to find its form if we need to move up from here on. The India VIX, well, that continues to remain at depressed levels. So, that's indicating that, in fact, there's no big panic, at least as of now. There is more rotation of sectors that we are seeing. Moving to the PCR, yesterday we had highlighted it had moved to around 0.65, but it ended the day above 1. Now we are seeing the put writing that's coming back into play. And because that put writing is coming back into play, and you have some aggressive call addition as well, we have seen that the PCR has cooled off a little bit. It's come down to around 0.94 the last time I checked. Now, the 24,700 call, the premium has come down from around 55 rupees to around 45 rupees. As is the case with the 24,600 call as well, the premium from around 95 rupees, it's come down to around 80 rupees. But the reason I'm saying that this market is not looking extremely jittery, in fact, it is looking like the bulls want to fight back, is because when the markets were at the low point of the day, the 24,600 put, the premium out there didn't move up. So that's telling you there is some writing that we're seeing at those levels with the premium at around 100 rupees, which makes just in the near term, this 24,500 mark important for those that are writing that 24,600 put. So there's a lot of writing activity that we're seeing at that particular strike. Levels that we're looking at, today's high, 24,700, 24,750, that becomes a crucial resistance zone. The last 3 sessions, we have gone to 24,350 and we've bounced off that. So you don't want that level to get violated, otherwise you move to around the 200 DMA. Stocks that we're looking at, a couple of stocks have come in actually for a short covering bounce. SJVN, there is open interest down and you have the stock that's moved up. As is the case with Jindal Stainless as well. Remember, the stock posted its results, it did pop up and then it saw a correction. Now, there were shorts in the system. Today, there appears there is some short covering because the stock is up close to around 3%. And finally, Titagarh Rail, there's a good amount of open interest built up, even in the option side of things. And that could potentially be a stock that moves into the F&O band. So we'll have to keep an eye out on that one. The last time I checked, as a percentage of MWPL, it had moved to around 102%. So watch out for that name. Back to you.
Okay, Nigel, thank you so much for that. So F&O data not looking that bad in terms this afternoon. Maybe we could see the bulls coming back and some bit of that positive sign, hoping for that to close. That will be the close for today's trading session as well. But on that note, we're going to slip into a very short break. And on the other side, we'll be joined by Manisha Gupta, who's going to be joined by Peter McGuire as well, CEO of Trading.com, to talk about commodities. Stay tuned in for that.
Welcome back. Peter McGuire is CEO at Trading.com and he joins us live on the show now. Peter, hi. A complete U-turn coming in from US with the President Trump now tweeting saying that gold will not be tariffed, and we've seen all of that reaction come back in sense of prices there. Clearly, gold can't be your copper and aluminum and steel, which you can tariff by 39 or 50% for that matter. Would you say that this whole U-turn now is in the price?
Well, good afternoon, Manisha. I think, look, we saw that peak at 35, 34. I think that was the price on Friday. So that was obviously a lot of fear entering the market. That was probably the best way because they were worried about the kilo bars and, as you know, the 100-ounce bars, and if there was to be a tariff. President Trump quelled that, and then we saw a reversal as far as price. You're down near about 3,400. I'm looking on the screen at the moment, close enough to it. So that overall sell-off, understandable, but the overall momentum, I still believe Q3 and Q4 are going to be very strong points for the bullion market, and certainly the attractiveness from, you know, retail investors and, of course, you know, sovereign wealth and everyone else jumping in.
Peter, are you still on track, reiterating that you expect the gold prices to go higher from here? I remember we discussing 36, 3,800 and 4,000 as levels as well by the end of this year.
Yes, I do believe that, Manisha. I think that US dollar is going to come under continued pressure to the downside. We all understand rate cut in September. We want to get through. I want to see what happens as Jackson Hole. There are a lot of different components of where the US is going to play. So I see a lower dollar rolling into Q4, and I feel as though that people will be stacking positions long and continue to do so very much for silver and gold leading into Q4 and over that Q4 timeframe. So yes, I still believe its best days are ahead of it for this year, and it's been an almighty year so far, but I don't think it's over any time yet.
For silver as well, we've been holding around that 38 mark. I mean, it's been a pivot point really, 50 points down and 50 points higher really. How would you look at silver ending this year?
Well, I still believe it's going to be higher than where we are at the moment. It'll touch through 40. I think it's been sold off. It's back at that, as the screen's saying there, 37.80. It's incredibly volatile. It's, you know, big swings. And so that's opportunity as far as traders are concerned because there's plenty of momentum and plenty of volatility. So the overall theme, I think, Manisha, is going to be continued upside, and it's not going to disappoint. And from a percentage perspective, I think that'll be greater than gold over the calendar year of 2025. So, yeah, silver's got some really exciting times ahead of it over the next 4.5 months.
Peter, when you look at gold and silver on historical charts, really, it does tell you that there are periods of huge volatility, and that's exactly what we are seeing in this year as well. Yes. But once that happens, and that happens perhaps for a year and a two, and we see next couple of years or more kind of dead in a very, very consolidating range, are we looking at exactly that pattern this time too?
Oh, Manisha, that's a hard one because that's a long vision. And, you know, I understand from the Trump administration, they're looking at certain things to happen from a gold perspective. And there are a lot of, I think, water to pass under the bridge. I want to get through this year to see where we are from a timeline and naturally from a price perspective. And nothing will surprise me about this administration. So let's get through this year. And I think 26, I wouldn't be surprised to see again that bull market to continue. And that's all I'll say. I mean, I'm not prepared to go out to 27 yet because there's so many variables that fit in from every angle. There's just variables, and variables.
I agree to that. Peter, also, what is your sense now on the crude oil prices? 4.5% of a decline in the previous week, but we seem to be, coming out of that right now, especially with the US president saying that no sanctions on Russia until those conversations are on.
Exactly. You know, I want to see what the situation is naturally from Alaska and whether there's a deal to be done. And this could be the early phase of it. And I feel as though that's the ultimate strategy moving forward. So I still believe that crude prices will go lower from where we are at the moment over Q3 and certainly into Q4. That glut in the market, I think, will present itself. Inflation's looking better than in a lot of countries. It's edging lower. So that's a good sign. And that's going to be better for the consumer as far as more dollars in the purse and the wallet. So the overall theme, I think, is going to be cheaper energy prices and then naturally all of the extension running off there from supply chains to, you know, consumption and the overall cost of doing business. Inflation's going to be a little bit more manageable.
Okay, Peter, thank you so much for that. And thank you so much, Manisha, for joining in with us as well for this interesting conversation. The key will be after this extension also what finally comes in. That's what we'll be keeping an eye out on. But thank you so much, both of you all, for joining us. And with that, we're going to slip into a very short break. And after the break, we'll be joined by Nilesh Shah of Kotak Mahindra AMC. And we will be talking about the stellar inflows that we saw coming in for the equity mutual funds in July's AMFI data.
बताएं।
Welcome back to Halftime Report on CNBC TV18. Now, talking about the investments in the equity mutual funds that have surged by 81% to record highs of over 42,000 crore rupees, and this is in the month of July. To talk to us about these trends, we're joined by the market veteran who has predicted the record high mutual fund equity flows for the month of July. We have Nilesh Shah of Kotak Mahindra AMC joining in with us to talk to us about that. Nilesh sir, good afternoon and thank you so much for joining us on the show. You know, this is very interesting and very heartening to see such good numbers come in, and also in terms of NFOs, 30 new NFOs launched. Look at the number that came in there as well. Do you think this NFO rush is something that will sustain, because that was leading the growth this time for these equity funds as well?
As SEBI permits more and more mutual fund players, they are likely to launch various schemes as permitted under SEBI categorization. And hence, will we expect more NFOs? Answer is undoubtedly yes. It is directly linked to the number of new players entering the mutual fund industry.
Okay. Well, Nilesh, you predicted that despite all of the uncertainty in the month of July, you had said just watch out for the numbers this month, because that's probably going to be record breaking, and that's exactly what happened. So kudos to that. And but can you put on your hat again and look into the future and tell us, is this kind of momentum going to continue for the next couple of months, considering that we do live in uncertain times at this point?
So, as one famous Hindi movie dialogue said, "Kabhi kabhi galti se hum sahi ho jate hain." So these are all random luck. I don't think so we have predictive power. But we do foresee that SIP has now become a common language. It is the language spoken by millions of investors, and SIP flows is likely to continue. The other up and down move comes with NFOs. Sometimes NFOs gets bunched up, sometimes they are scattered. But one thing consistent among investor behavior is that whenever markets have become attractive, it is always SIP plus NFO plus lump sum purchases. And whenever markets have become expensive, it is normally SIP plus NFO minus redemptions. The behavior of investors have matured, and they are doing contra investing by buying on dips and selling on rise, which is fantastic.
Nilesh, what about the small and mid-cap funds as well, right? Like in the earlier part of the year, we had heard investors raise their concerns coming in that, should we stop our SIP, given that they were not performing that well. But this time, look at the flow that came in there as well, right? Mid, small cap funds, they are doing well. Do you think this is a trend now that will continue? And maybe investors are becoming more mature towards investing here, and maybe will wait out, to see these cycles that go up and down?
So I don't think so investors were as much worried about small and mid-cap SIP. I have been going and meeting investors physically as well as virtually and taking a poll. Did they stop their SIP in small and mid-cap fund? And by and large, 99% of audience answers negatively. They continued their SIP. I think thanks to all the mutual fund distributors, registered investment advisors, and media personalities like you, people have recognized and realized that SIP is something which you have to continue. There will be ups and downs in SIP returns, but if you continue with right investment horizon, eventually SIP will play out for you. They also probably combined SIP with asset allocation. And while their SIPs continue, they may be adjusting their portfolio on the ups and downs by lump sum investment or redemption. So the behavior of investors have matured. And I don't think so they are as worried about the market correction as probably some other people.
Okay, fair enough. Well, Nilesh, just hold on. We have a lot more questions, but we just need to take a mandatory break and we'll be back with more. Stay tuned. Welcome back. Well, we're still in conversation with Nilesh of Kotak KMC to discuss the record equity inflows that we saw for the month of July. Nilesh, I actually wanted to narrow down in terms of what we could see as a trend when it comes to debt mutual funds, because that's seen a resurgence in the month of July. Do you think that there will be more safe haven investing coming in the coming months as compared to what we have seen in the earlier months, simply because of the risk of sentiment, which is probably playing out a little bit?
So in the debt space, there are two categories. One which is more of a parking style, which is mainly used by corporate treasuries, HNIs and family offices. There is very little retail participation over there. Those inflows are linked directly to banking liquidity. If liquidity highs, we will receive flows. If liquidity is low, we will see redemption. On the other hand, there is one very interesting category called income and arbitrage fund of fund. In this, we are seeing retail as well as HNI participation. There, we are seeing more retail flows, and we believe that's sustainable. But now, with 12 lakh rupee tax exemption, clearly there is one category of investor which are not investing in debt mutual fund because they believe they can go and invest into other products. My recommendation to investors will be, please follow the dharma of asset allocation. As much as equity is needed for your portfolio, debt, gold, and real estate is also needed for your portfolio.
Absolutely, debt, gold is also needed for your portfolio as well. So that's important in terms of asset allocation, Nilesh. Just one word, what I wanted to understand is in terms of big cities versus tier 2 and tier 3 cities. How is the fund actually, the split going between these as well? Is there a further growth coming in these smaller towns?
Undoubtedly, B30 cities are witnessing much higher growth, albeit on a lower base, both in terms of volume as well as value. The bulk of the money lies in top 6-7 cities, but the growth, incremental growth is coming more in B30 cities. I think with the advent of digitization, we are able to spread financial literacy in B30 towns and cities. We are also able to provide execution, which is very, very simple. Combination of literacy and execution is ensuring that B30 towns are growing at a faster rate, albeit on a slower base, on both volume as well as value.
Okay, well, the market has shown a little bit of reversal now. So we have the Nifty, which is spiked up into the green, up around 14 odd points. But largely, you'd have to say, still consolidating in a tight range, flitting between red and green. But Nilesh, before we end this conversation, this week is going to be important because we do have the Trump-Putin meeting, which is taking place on the 15th of August. What is your sense in terms of how critical that could be in terms of a trigger for our markets?
Undoubtedly, we will be waiting for the outcome of those meetings. I hope Mr. Putin raises the question of tariff on customers which are buying Russian oil. Only India has been targeted at that. It's an unjust and unfair levy. If that summit has some successful outcome in removing that 25% tariff, to that extent, we will be still able to trade with US with just first 25% tariff standing. If the tariff continues to stay from 27th August onwards at 50%, then certainly it's more of an embargo and it will have detrimental impact on Indian economy, especially sectors like textiles, aquaculture, chemicals and auto components.
Absolutely, so that will be key to watch out for, in terms of discussions that come in as well. But Mr. Shah, thank you so much for joining us and giving us your time this afternoon, talking to us about the mutual fund industry. What are the trends that we could be expecting there, as well as in terms of the markets? But with that, we are absolutely out of time on this edition of Halftime Report on CNBC TV18. Some bit of a recovery that we've seen coming in the market. Thank you so much for tuning in. Up next, your Business Lunch.
The market bounces off the day's low as volatile trade continues ahead of a crucial Trump-Putin meet later this week with implications for India. Auto and IT gain while realty, industrials and financials drag.
Hindalco's US arm Novelis posts weaker than expected operating profit on elevated scrap prices and a higher net tariff impact than the previous quarter. Analysts trim estimates after baking in the expected cost savings.
Indian Hotels is set to buy 51% stake in two entities with 135 mid-segment hotels across India and Sri Lanka for about 200 crore rupees. The move will help the hospitality major expand in a new segment with a wide geographic footprint.
Astral and Praj Industries dip after posting disappointing numbers, but SJVN has gained on a healthy show and a new solar unit starting up, while Titagarh has climbed after declaring the production loss in Q1 will be made up in the subsequent quarters.
A CNBC-TV18 poll sees India's CPI for the month of July at 1.3%, lower from the 2.1% print seen in June, with food price inflation expected to remain benign. On the contrary, a Dow Jones poll sees US July CPI rising 0.2% sequentially.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormus Fatakia. With me as always is Vamakshi Dhoria. Vamakshi, good afternoon. Well, final few days of the earnings season, and possibly one of the last days when we have a slew of earnings lined up over the course of the day, but the market though has come off the highs.
Well, absolutely, Hormas. You know, the market since morning has been flip-flopping between the red and the green. For now, it's barely hanging in the green. We're in fact below the 24,600 mark. In fact, earlier in the day, we crossed the 24,700 mark as well, but so we've cooled off approximately 100 odd points from the day's highest point. The mid-cap end of the market too is not doing as well, although it's slightly doing better than what the benchmark indices are doing. The mid-cap index is up almost 0.2%. The small-cap index will also come up for you, and yesterday both of these indices slightly underperformed what the benchmark indices did. The small-cap index though is today outperforming the benchmark indices, up almost 0.5%. As far as some stock-specific action is concerned, take a look at some of the earnings reaction, especially from travel food services. That stock is up almost 8%. Awfis is another counter that is doing quite well. We were in fact joined by the management as well. That stock is up 7%, trading at almost 600 rupees per share. SJVN is one other counter that did very well, but what did not do well is Praj Industries. The stock has taken a very sharp knock in today's trading session. Astral is the other casualty in trade, Hormas.
Indeed. And there's some numbers on the bottom of your screen as well. Zydus Life numbers look very better than expectations. The EBITDA at 2,089 crore, margins at 31.8% compared to a poll of 29.6. So margins are better than expectations. The revenues, the top line figure also better than expectations at 6,574 compared to 6,350. So a positive result coming in from Zydus in the first quarter. The stock, well, so far hasn't done much. Has recovered from the lows of the day, yes, but still trading with gains of around 1%. It's been a fairly healthy performance. More details would come in from Ekta in just a bit. But for now, Zydus is the other one. And there you can see the Forex gain of 57 crore this quarter compared to a Forex loss that they had in the base quarter. So that is Zydus for you. Some of the other movers though in the small cap space in today's session, Yatra is the one. Yatra was up 20% yesterday, is up another 13% in today's trading session. So that is among the top gainers on the small cap index, still at 129. So despite this 30-35% move that you've seen on Yatra in the last two sessions, the stock still remains below its IPO price of 143. But to take a look at some of the other buzzing stocks on the day so far, Ria is here with all of those details. Ria.
Well, yes, let's take a look at the stocks that are moving in trade today. The first one is Astral, down about 7% after reporting a very weak set of numbers in this quarter. EBITDA and net profit seeing declines of around 14% and 34%. Margins have also contracted by 191 basis points, and plumbing volumes have been largely stable at around 56,000 metric tons in this quarter. And this time around, the PVC price volatility that we've seen over the last few months has resulted in inventory losses and has also affected realizations for the company. The other one is business. Praj Industries also down about 6.5% today. The order intake was down around 10.5% on a year-on-year basis for this one. EBITDA and net profit also seeing very sharp declines of 66% and 94%. And also remember the net profit of about 5 crores this time around included an exceptional gain of rupees 28 crores. Margins also very steep contraction of 825 basis points, and the domestic ethanol business in this quarter witnessed delayed execution cycles and liquidity crunches at the customers, and which also affected the performance for Praj Industries. On the flip side, SJVN is up over 5% today. They've reported a good set of numbers in quarter one. The power generation business rose about 5% on a year-on-year basis, and they've also said that the capacity addition target for FY30 is 25 gigawatts, and for FY40 it is 50 gigawatts. So very positive commentary for SJVN, on the back of which the stock is trading higher. Titagarh is the last one that we're keeping an eye out on, up over 2.5%. The numbers were quite weak for this one, but the outlook remains quite positive. The revenue growth declined almost by 25% this time around, and this was dragged by the freight railway segment. Wagon dispatches were also quite weak, and this was on the back of extremely poor supplies of wheel sets from the rail wheel factory. But going ahead, the management has said that the wheel set supplies for the rail wheel factory will be normalized by the end of July, and they're also expecting FY26 wagon offtake to be similar to FY25. So on the back of this positive commentary, the stock is up around 2.5%.
Well, thank you so much for that comprehensive, Ria. A whole host of counters in focus on the back of their numbers. But let's bring you an exclusive then. Sources are telling us that there may be a top management change at Suzlon. My colleague Rachna is here with more details. Rachna?
Right, it is a big shake-up at Suzlon Energy, as we learned from our sources that Chief Financial Officer Himanshu Modi is stepping down from his position at Suzlon Energy. What we're also learning from our sources is that he's likely to take up a leadership position at Sammaan Capital. Now, speaking of Himanshu Modi, he's a man credited for the turnaround that Suzlon Energy has seen. He joined the company in 2021, and since then, there's been a complete financial turnaround. This includes cutting down debts to zero, boosting profitability, and even increasing the order book significantly. Now, Sammaan Capital, formerly known as Indiabulls Housing Finance, is an NBFC with a focus on housing financing, with assets under management of about 66,000 crores. So this move is particularly interesting because Mr. Himanshu Modi will be changing sectors. He'll be coming from renewable to financial services, but also for Sammaan Capital, who will be onboarding a man like Himanshu Modi, known for turning companies around. So we will be keeping an eye out for that.
Keep an eye out on that indeed. Interesting, Rachna. Suzlon comes out with numbers today. Keep an eye out on that as well. Numbers should be out anytime from now, 0.7% higher. But on the flip side, look at Sammaan Capital. Sammaan Capital is up 8%. After this news break, the stock had opened higher, but since then has continued to build on to those gains, and there you can see the spike. And since then, at the highest point of the day is Sammaan Capital, 8% higher at 124. But BSE's weekly expiry now will be shifting to Thursday from Tuesday, starting the 1st of September. We spoke to Sundaraman Ramamurthy, who's the managing director and CEO at BSE, on this change in weekly expiry and the reports related to the curbs on the same. Listen to what he had to say.
The starting point is still a speculative situation, that if it happens, so we have to deal with it as and when it happens. If it happens, what we all know is whatever is good in the interest of the market is what the regulators will do. So therefore, we need to wait for what the regulatory thought process is, more so because the regulators have clarified. If any reply were to be tried by me now, it is based on a speculative thought process.
Well, we also spoke to Amish Shah, head of India research at BofA Securities, to understand the potential impact of tariffs on the Nifty's performance. Let's also listen into that.
The moment you bring the trade talks, obviously that adds to some amount of risk, and therefore whether the tariffs will settle down at 15 to 20 or 25 or 50, the sensitivities vary. So if it indeed stays at 25 to 50%, I think there is a decent amount of downside to the market because markets have not priced that risk in. And that's our base case as well. We don't think that we can continue with a 50% tariff eventually.
Well, on to the big event of the evening. The NSO, or the National Statistics Organization, will be announcing the July CPI number at 4 this evening. A CNBC-TV18 poll is expecting the July CPI to be at 1.3% compared to 2.1% that was reported in June. Lata is here with more expectations from the CPI. Lata.
Yes, 1.3% is what our poll threw up as the July CPI. And remember, even the year-ago number is not very big. The year-ago number is 3.6. which is also below the mandated number of the MPC, which is 4% CPI. On top of that, which means inflation is really running low. And by the way, there's a record. 1.3 is the lowest ever after the new CPI data series started in 2013. So this is really some kind of a huge record, but it's largely because of food. Food is going to be deflationary for a second month in a row. It was minus 1.06 in June. It's going to be minus 2 in July. Much of this is, of course, the base effect. But cereals and pulses are clearly falling even month on month. The good monsoon is, again, helping sentiment as well, keep the prices lower. Core CPI is expected to fall a bit. Here now the base effect is wearing off. Last month it was at 4.4%, that is June it was at 4.4 because the base was 3%, but now the base starts rising to 3.1, 3.2. So we are seeing some impact on the July CPI. The core CPI will be somewhat lower. While all these numbers look very good, 1.3 lowest ever in the series, it's not going to have any impact on the bond market for the simple reason that RBI brought down on August 6th its forecast for the full year to 3.1 and remained unmoved. It merely seemed to say that we are going to look at the year-end inflation, which is 4.5 according to their estimate or on their forecast. So it didn't look like a central bank looking to cut rates. So the bond market is going to largely ignore it. And they may, just after 1 hour, the CPI comes at 4 o'clock. By 6 p.m., the market will simply veer around to what? The US CPI number. The US CPI number, of course, I'm just quoting you Dow Jones Newswire's poll, expected to rise by 2% month on month and 2.8% year on year. The core CPI, of course, is more important from the Fed's point of view. And that's not looking good at all because it's going to rise by 0.3% month on month if the Dow Jones poll is correct, and by 3.1% year on year, which is a little worse than what it was in June. The June numbers will also come up for you. The June number was 2.9% year on year. So actually inflation would be seen inching up if it came at 3.1. That would be another good reason why the Indian bond markets will sulk. By the way, they've been sulking big time, okay? Bond yields after the RBI's hawkish tone had started rising. The 10-year bond yield today at 6.43 is 10 basis points higher than what it was the day before or even the 1 hour before the RBI announced its policy. It was 6.3. And more importantly, it is a full 25 basis points higher than what it was at its low in end May. It's almost as if a rate hike has been announced if you look at the 10-year bond yield. So whatever joy you're getting in the inflation number is getting wasted on the bond markets.
Well, thank you so much for that, Lata. We'll definitely be keeping an eye out on the CPI data from India as well as the US. Take a short break then. More news and updates follow after the break, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC TV18. Well, the United States and China extend their tariff truce for another 90 days, preventing triple-digit duties on Chinese exports to the United States. Trump announced on his Truth Social platform that he had signed an executive order suspending the imposition of higher tariffs until November 10th, with all other elements of the truce to remain in place, which means the current 10% reciprocal tariffs remain intact in effect during this suspension period. Trade talks will continue and both countries will remain committed to ongoing negotiations to resolve trade disputes and strengthen economic ties. Well, let's in fact listen into what President Donald Trump had to say on his relationship with China before signing the executive orders on trade truce extension.
China's been, we've been dealing very nicely with China, as you probably have heard. They have tremendous tariffs that they're paying to the United States of America. And we'll see what happens. They've been dealing quite nicely. The relationship is very good with President Xi and myself.
Now here's what experts had to say on Donald Trump extending his tariff pause on China for another 90 days. Listen in.
I think China indeed has a lot of leverage because they can reciprocate to the tune that nobody else can. It's interesting to me with the Nvidia and AMD deal, which I said in my note is essentially a reverse tariff, something unprecedented. I can't recall when this was ever done before, but of course our president lives in that world to keep everybody on their toes. But in that particular deal, Nvidia and AMD paid the price. So it goes to show you that the Chinese have a lot of leverage and they didn't necessarily succumb. Nvidia and AMD are so desperate for those revenues because it's such a big market, they are paying the price, which I think is pretty interesting.
The only thing that is sort of a question there is kind of different styles of negotiating in China and the US. So I think Trump's idea would be he would show up in Beijing and he would hammer out the last terms of the deal one-to-one with Xi Jinping. And of course, the Chinese will never accept that. They want everything to be set up completely before Trump shows up so they know exactly what's going to happen. So I think there's a little bit of choreography that needs to be done. But yeah, I think you're right that basically what they're going to do now is spend another month or two trying to work out whatever terms they can, and then have some kind of unveiling around some kind of meeting later in the fall with Trump. So they might not need the full 90 days. And I think Scott Bessent was on TV over the weekend saying that he thinks most of the trade deals will be wrapped up in October. And I think that was an indication of what he thinks is going to happen on the China side.
Well, Donald Trump is also slated to meet Russian president in Alaska at the end of the week. Speaking to reporters at the White House, he said that he could know within 2 minutes of meeting Putin whether progress was possible. He also said that there would be some swapping or changes in land between Russia and Ukraine. Let's listen in.
The death is incredible. It's the worst thing that's happened, by far the worst that's happened since World War II. So I'm going in to speak to Vladimir Putin, and I'm going to be telling him, you got to end this war, you got to end it. And he wasn't going to mess with me. This war would have never happened. You know, we had a discussion about it one time, and we never had that discussion again. Would have never happened. There'll be some land swapping going on. I know that through Russia and through conversations with everybody, to the good, for the good of Ukraine. Good stuff, not bad stuff. Also, some bad stuff for both. So there's good and there's bad. Next meeting will be with Zelensky and Putin, or Zelensky and Putin and me. I'll be there if they need, but I want to have a meeting set up between the two leaders.
Meanwhile, another news, Prime Minister Narendra Modi on Monday spoke with Ukrainian President Volodymyr Zelensky and reaffirmed New Delhi's consistent support for the peaceful settlement of the ongoing Russia-Ukraine conflict. In a post on X, Prime Minister Modi also reiterated India's commitment to extend all possible support to Ukraine for the restoration of peace. We'll take a short break. More news on the other side. Stay tuned. Welcome back. Some news from the Supreme Court then, which is currently hearing a batch of petitions challenging the Election Commission of India's order to conduct a special intensive revision of voter lists in poll-bound Bihar. The petitioners have criticized the SIR process as a form of quote-unquote citizenship screening. Now, the Association for Democratic Reforms, which has challenged the June 24 order on the SIR, has moved a fresh application seeking the poll panel to publish the names of the 65 lakh deleted voters along with the results, along with the reasons for the deletion.
Well, on to other news then. Protests erupted in Washington, D.C. after U.S. President Donald Trump deployed 800 National Guard troops and temporarily took over the police department in a bid to curb rampant crime in the city. Protesters took to the streets against Trump's alleged misuse of executive power, interfering with the law and order situation in the national capital. The Democrat mayor too slammed the move, adding that crime rates have fallen sharply in the last 1 year.
And with that, we take your leave on this edition of Business Lunch. We leave you with the markets extremely choppy with the Nifty back into the red. From Amakshi and me, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. We came off sharply from the highs, from those levels of 24,700, and we've now been consolidating at the 24,550 mark. And that continues to be the case. Very range-bound today. We'll see which way things go.
That's right, and we're coming to the end of the earnings season. A lot of numbers trickling in. It's been a very choppy trading session so far, like you mentioned, but we have a lot lined up on the show, an important corporate conversation as well. So let's start up with the top headlines. D Street off the day's low, but remains volatile as market trades cautious ahead of a crucial Trump-Putin meet later this week with implications for India. Auto and IT eke out gains while realty and financials drag. Mid-caps flat.
Office Space Solutions rallies on a strong first quarter and bullish commentary. Revenue is up 30%, EBITDA rises 60%. Company tells CNBC-TV18 they are aiming to reach 1.75 lakh seats by year-end.
Astral under pressure, posting disappointing numbers. EBITDA dips nearly 14%, while margin declines 191 basis points. Company says polymer prices were volatile during Q1. On the other hand, Praj Industries also under pressure after margin contracts over 800 basis points in the first quarter. Domestic ethanol business sees delayed execution cycles impacting their numbers.
Indian Hotels is set to buy 51% stake in two entities with 135 mid-segment hotels across India and Sri Lanka for about 200 crores. The move will help the hospitality major expand in a new segment with a wide geographical footprint.
MRF in focus after reporting their Q1 numbers. Net profit comes under pressure. However, revenue sees 7% uptick on a year-on-year basis.
All right, those are the top headlines that we are tracking for you. Alchem's numbers, by the way, at the bottom of your screen. The stock has surged 4.5% higher, and it was beat on all the parameters as well. There's a margin expansion of around 190 basis points. Profits have come in at 668 crore rupees versus 480 crore rupees, so almost a 180 crore rupee beat. We'll have to see whether it's a one-off or it's led by other income as well, but even revenues are higher, so it's not entirely that beat. Even revenues are higher by 200 crore rupees. EBITDA, so it's a top-down beat that has come by for Alchem Labs. No wonder the stock is surging from the lows of the day, up around 4.5% as we speak. But that's not only the mid-caps we'll be talking about. There are a lot of other names on our radar. Hormus is here to take us through that list.
Indeed, plenty of them. And Sonata Software, you start off with that. Then among the top gainers on the broader markets today, 12.5% higher. Look at Star Cement as well, almost 10% higher on that stock. Heranba Industries, Samman Capital, of course, after the CNBC-TV18 news break, has moved to the highs of the day, 7.5% higher here as well. Alchem Labs is a positive earnings reaction, but there are other positive reactions as well. Some of them that came out with numbers yesterday, some of those that are building on to those gains as well. VST Tillers is one of them, was up 7% in yesterday's session, is up another 6% in today's session. Yatra is up another 13% after the 20% circuit yesterday. SJVN is a positive earnings reaction, as is Awfis. It's 7% higher, although it's off the highs of the day. On the flip side, though, there are a lot of other negative earnings reactions as well that we are getting to see. Look at Man Industries. Praj Industries has recovered from the lows, but still trading with losses of around 7%. But Astral has now slumped to the lows of the day, 8% lower on that stock. We'll take a look at some of the movers on the volumes front, though, and those are some names that are like Himadri Specialty Chemicals, Biocon, Adani Total, and of course I was mentioning Alchem as a volume mover, but now it has moved to the highs of the day as well after its results. And lastly, a mid-cap IT rebound that we are seeing in today's session, just a bit though. We'll look at Oracle Financial, Emphasis, Persistent, even Coforge is trading with gains in today's session. So that is one pocket that has seen some bit of rebound from oversold levels. Back to you guys.
Thank you so much, Hormas, for taking us through the whole host of stocks, whole list of stocks that are doing the rounds and making all the moves as far as the broader end of the markets are concerned. Well, given the choppiness in the market, it's a very good time to welcome Srikanth Chauhan from Kotak Securities for a quick technical check on the market. Thank you so much, Srikanth, for joining us. Well, you know, it's been quite a choppy trading session. Where do you see markets headed from this point on?
Good afternoon, Vivek. Good afternoon, Sonal and everyone. Well, for Nifty, it is trading with a lot of caution. It is finding difficulties to sustain at higher levels, but at the same time, in last 3 days, it has rejected market. I'm to say the market has rejected the level of 24,450 on a closing basis. So most of the time, whenever the market fall into those levels, we saw quick recovery in the market, and I think that should be the final stop loss for creating any long position in this market. See, these markets are completely oversold in terms of if we go through with its option statistics. So broadly, I am of the view that 24,450 should be the final stop loss on a closing basis for holding any long position. And on intraday charts or on daily charts, we can very clearly see that the market is forming some reversal formation. So based on that, I am expecting market to move towards the levels of 24,900 or 950, which will take some time, maybe 1 or 2 days. But in the near term, I'm going to say in today's date, in case if there is any correction, then close to 24,500, we should look for adding some long positions.
Okay, all right. Thanks for that, Shrikant. What would your individual technical picks be?
Yeah, I would like to go with a few companies from the chemical basket. There we are seeing good amount of buying interest. In that, Acutaas chemical, that looks good. Here, if we consider its overall technical pattern, then it is forming some consolidation at between the levels of 1250 and 1350. At current levels, 1305, 1310, it looks quite steady, and it is forming some continuation formation. So based on that, I'm expecting stock to move towards the levels of 1500 or 1550. We can keep a stop loss around 1250 if there is any trading position. But I think if there is a medium to positional view, then certainly we should look for adding Acutaas Chemical at current levels. We also like Acme Solar, which is currently trading around 283, 285. And there also we feel it is in the specific narrow range, but broadly it is forming some continuation formation. And based on that, the stock can move towards 350 or 375. So Acme Solar as well as Acutaas Chemical should be on the watch list.
Thank you so much, Shrikant, for joining us and giving us your view on the markets as well as your individual trading calls. Before we slip into a short break, here's a reminder for our viewers. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Prime Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, along with curated lifestyle benefits. Welcome back to Midcap Radar. Well, a few minutes ago, you did see the numbers of Alkem Labs flashed across on the screen. It was a significant beat to what the CNBC poll was indicating, and that particular stock is now at the day's highest point, up over 6%. But an important corporate conversation is what we have lined up next for you. Garware Technical Fibers is the first management on our radar. The company posted a stable set of Q1 numbers with its profit growing 12%, but margins did see some weakness. To discuss the quarter gone by and the way forward, we are joined by Shujal Rahman, who's the CEO at Garware Technical Fibers. Thank you so much, Mr. Rahman, for joining us. Well, first up, take us through Q1, and more importantly, you have almost a 10% exposure when it comes to the US market. So what will be the impact of tariffs? Earlier, we were working with a 25% figure, but now it's 50%. So how exactly are you going to navigate that particular challenging landscape?
Thank you for having me on the show. First and foremost, on Q1, I think we had stable results, close to 13% growth in profit and 9% in top line. Some of the businesses in our company have done well. Geosynthetic, which is in the area of infrastructure in India, has done really well. Slow protection for railways and in the area of landfill mining, these segments have done well. We also done well in international fishing, which is the global fishing segment. We have done well. Also, we have done well in some segments in industrial product in India. So these segments have done well, and overall the stable results are there. Margin also we have been able to retain, I would say, at the broad level. Coming to your question, second part of the question about the tariffs. So we have about 10% exposure to USA. At this stage, we are discussing with our customers and trying to find a solution. Obviously, 50% is a very steep tariff. We all know that it's not going to be easy to resolve it. But some of the customers are supporting us. In some cases, we are discussing with them. At this stage, it's early for me to say, but then we are trying to resolve the problem to the extent possible. And we are also hoping that in the next few weeks or so, there will be some resolution from between the government of India and USA. We are hoping for that. So as of now, I think still work in progress, and it's going to be at least impact to us, around 10% or so, which we are trying to solve.
So 10% of the business, which will be impacted by 50% tariffs coming in from the US on Indian exports. Mr. Rahman, you have started the year with a high single-digit growth. That's 9% on the top line. What is the demand currently? You said it was led by geographies in different segments. So which are the geographies which are growing well for you? What is the target that you have for FY26 in terms of revenue growth and margins as well? Because that has fallen on a YOY basis.
So as I mentioned, we have done well in certain segments. International fishing has done well for us. Geocentric this business which has been doing well for us has obviously continued to grow well. Overall, the demand front, aquaculture, we don't see any impact on demand. There is some pressure on prices of salmon, but overall we don't expect demand to have any impact. Sports segment, which is very heavily dependent on USA, will have some impact, which I mentioned a while back. Other segments we are reasonably confident. In fact, some businesses business units in India are also doing well, and we're getting some results there, especially industrial product division in India.
So what is the guidance for FY26 in that case?
At this stage, it's very difficult for me to give guidance because 10% is definitely impacted. And some of the customers used to place orders around July, August time for arrival in, let's say, Christmas time, etc. for USA. So those orders are still in limbo, so to say. So we are trying to solve. So at this stage, difficult to give a guidance. Overall, you would understand the situation is not very normal for us to give a guidance.
Understood that. Mr. Rahman, a two-part question. Direct 10% impact, which is part of the top line. We also understand you have some exposure as far as the salmon part of the business is concerned, where, there are again tariffs to various other end markets. So would you be impacted in that case? And secondly, there were 2 Norway acquisitions that were announced. Q2 onwards, do we see that also, coming into the numbers?
First, on the tariff for the salmon. So Chile, which is a big market for us, the tariff is 10%. UK, which is Scotland, is also 10%. Canada is actually 0. One of the biggest market, Norway, has a 15% tariff. So this is the overall mix on tariff. So it's, I would say, on the lower side. As far as acquisition is concerned, we acquired a company called OTS, and the results from OTS will be a part of our results from Q2 onwards. So from July. In July, the acquisition is completed. So in Q2, we have results. And this will be ROC positive for us. It will also be overall, it's a good segment to be in. It's in the area of oil and gas, in the area of aquaculture. These segments we are obviously wanting to grow. The value-added rope segment, which is also focused for us, this also gives an entry into European markets in that segment. So it's an overall a good mix for us in terms of getting into segment where we're not there. And there's certain products which we can obviously import and sell in India. So it's a good synergy for us.
Right. Mr. Rahman, while 10% of the top line comes in from USA, we understand almost 60% revenues actually coming from exports. In that case, what is your current hedging policy? Do you benefit from weaker rupee?
Yeah, there's some marginal benefit if the rupee weakens. So, but there's also an import element of raw material. The raw material goes up. So overall, I would say it's positive. At this stage, our export contribution is 55% for this quarter. It used to be normally 60-40. So, but off late, due to better business in domestic, the ratio is now 55-40.
Okay. All right. Mr. Rahman, what is the percentage revenue coming in from value-added products? If you increase it, what kind of margin expansion would you see?
So at this stage, 80% of our products are value-added, operating value-added segment, and 20% is non-value-added. What we are doing is that the non-value-added segment is actually the rope segment, which we are trying to upgrade. I mentioned to you a while back, OTS is also in that direction, in the value-added rope segment. And even in global markets and in India, we're working in various segments, which are value-added rope segments. So overall, this 80-20 ratio will also change. And if it changes, then obviously there will be margin improvement. It takes some time to do it. So we are in the process of doing it.
Okay, thank you so much, Mr. Rahman, for joining us and fielding all of our questions. We hope to get you more often to get a sense of how exactly business is panning out and how the latest acquisition goes ahead and helps your financials going forward as well. But before we slip into a short break, we'd like to remind our viewers to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and for the Global Lens at 8:30 p.m.
Welcome back. You're still tuned into Mid-Cap Radar. Well, for the markets, as flat as it can be, but it is with a negative bias right now. It's been quite choppy for the last couple of hours, actually. Mid-caps are the ones which are outperforming, so 0.2% higher on that one. That index should come up for you on the screen. In terms of sectoral movers, Nifty, Pharma, Auto and IT, these three indices are doing well. So a lot of contribution coming in from the pharma space as well now. When we started the trading session, it was a lot coming from the auto and IT space. In terms of movers, SGBN, that is a stock which is doing really well in the broader markets, 5% higher there. We have Biocon, which is doing well. PG Electroplast, which was a big casualty yesterday after that guidance cut, has recovered some of the losses. 3% higher there. We have IGL, which is up 2.5%, Z Entertainment, which is up 1.7%. So a lot of these stocks in the broader markets which are on our radar as we speak. In fact, we are getting in earnings, and MRF is one of them. Reported numbers a while back. Sudarshan is here to decode the numbers. Sudarshan.
So MRF has reported earnings for Q1 of FY26, and it's not a bad set of earnings. If you compare against the peers, the company has reported a steady set of earnings because raw material costs have seen a sharp rise both on a sequential basis as well as year-on-year. But despite that, gross margin has just seen a decline of around 300 basis points, while its peers had seen a decline of almost 400 to 500 basis points. Talking about the headline numbers, profit was down 14%, revenue has seen an increase of 7%, and for peers, while companies have either seen a decline or revenue was almost flat. And EBITDA was down 9%, margin has come at 13.7% versus 16.1%. Now, going forward, what would be positive, because all the other tire companies have been talking about that in Q2, raw material costs are likely to be benign, and that may aid margins. So we'll have to see going forward how two major input cost act. One is crude and second is natural rubber. So over the last few weeks, prices have come down. So more than the Q1 earnings, what will be important is to track the input cost for Q2.
Thank you so much, Sudarshan, for joining us. Well, there was a brief intraday dip, post which MRF did recover, now trading near the flat line. Well, a few stocks, that are now trading near the day's highest points. Paytm at one point of time was down almost 1.5%, but there's been a sharp recovery as far as Paytm is concerned. That particular stock has now trading near the day's highest point. The other stock that's made quite a bit of sharp recovery is actually Granules. Remember, numbers came out an hour ago. The company has given some positive commentary coming in as far as remediation for the Gagillapur facility is concerned. That stock higher by 4%. Some of the pharma names, today, names like Dr. Reddy, even a Fortis Healthcare. Remember, numbers came earlier this week, a very strong set of numbers. That particular stock especially continues to do very well in today's trading session. But with that, it's all the time we have on this edition of Mid-Cap Radar, Mutual Fund Corner, when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always is Vinny Motiwala. And one of the major rules for investing is have goal-based investments. And we spoke about some goals that we can achieve via mutual fund investments. Last week it was education, travel as well. And today we are going to pick up one more, Vinny.
Absolutely. Today let's pick up on how we should build a dream of owning a home, and will mutual funds actually help us with that is something that we'll be watching out for. Now that's what we'll be talking about. Given that property prices are rising, there is increase in costs, savings for a down payment can be a hassle. But what if you can actually leverage mutual funds to make your dream and make that into a reality? That is important, right? Today's focus is going to be on how mutual funds can be a game changer to build your portfolio in a way that you could be buying a home, paying the down payment as well. To help us understand the right investment strategy that we should be following, what are the tax implications that come in as well, we have our experts joining with us today. We have Kshitij Mahajan, co-founder of Complete Circle Consultants, as well as Tarun Birani, founder and CEO at TBNG Capital Advisors, to talk to us about this. Tarun as well as Kshitij, good afternoon, and thank you so much for giving us your time this afternoon. Let's talk about the time horizon first, right? Goal-based investing, we know, like Sona was also mentioning, it's important, it's necessary. The time horizon and the type of mutual funds that we should be looking at for building our home, purchasing that corpus, that down payment that is there as well. The short-term, medium-term, as well as the long-term needs, how should we start with that? Kshitij, let me start with you first. Afternoon.
Good afternoon, Vanita. Good afternoon, Sachi. So yes, I think you have to define your goals, and the best way is to align your mutual fund investment as per the goal need. And let's say if you have time horizon defined, like if you have decided some time frame in which you want to start buying your home, let's say it's less than 3 years, then you should look at the parking in safer assets in terms of with less riskier mark-to-market element. So I think based on that, you can look at arbitrage, you can look at short-term debt funds, you can look at if you are expecting a rate cut, like what has happened in the past, then you can look at parking some allocation in gilt fund as well. But yes, I think more of shorter modified duration. If less than 1 year, then it's arbitrage and ultra short-term fund only. But less than 3 years, you can look at a mix of arbitrage, short-term funds, or maybe dynamic bond funds is what one should park. And if let's say it's a medium-term time horizon between 3 to 5 years, then it can be a good mix of your multi-asset fund. It can be a balanced advantage fund, balanced funds, and equity saving funds. Or maybe 5-10% you can keep in equity, in arbitrage funds also. So avoid 100% equity allocation for less than 5-year allocation, because sometimes it happens that market might give you a long gestation to perform. Plus 5 years, if you have time horizon, then depending on if you have 5 to 10 years, then you should look at a good mix of a flexi cap, multi cap, large and mid cap. Depending on a risk appetite, you can add a multi cap and these categories. And at the same time, if goal is more than 10 years, then you can add some portion of mid and small cap to it. At the same time, when you are approaching your goal, keep your expected return expectation very reasonable. I think in current market scenario, I think 12% is what one should look at from their mutual fund portfolio. Our nominal GDP is around 10. I think 10 or 12% is a reasonable good amount of return which you are expecting. But yes, if you are achieving it a little faster, it's good to switch your money from equity assets to safer assets.
Got it. Thank you for that, Kshitij. By the way, it's Winnie and Sonal here. So those are some of the points that we'll keep in mind, and our investors or viewers will keep in mind as well when it comes to investing for buying a home. Tarun, let me come to you. First up, your thoughts on what's the time horizon and type of mutual funds for building a home, the purchase corpus, it should be short-term, medium-term or long-term, and also how can we split those investments, say between equity, hybrid and debt mutual funds?
So good afternoon, and it's a brilliant topic and a topic I enjoy talking on, goal-based investing. I strongly believe that the purpose of an investment is not to achieve risk-adjusted return, which I think I can see a lot of noise around generating high returns, put money here, make more money. I think the objective of investment is to help us achieve our financial goals. I think that is how we should look at investing. And that is where the topic which we have selected today I think it resonate with that how can this investment can help you achieve that goal. I feel for home buying, especially under the today's uncertain environment and condition we are in right now, the calendar and not the market should determine your portfolio structure. Mind you, the word is calendar. So money behaves differently over time, and the shorter your time frame, the less room for error. That is something we need to be cognizant of. So that is where I feel we need to divide our buckets for 3-4 time frames. So let's say between 1 to 3 year horizon, the focus should be more on preservation of capital. So for preservation of capital, right from liquid funds to arbitrage funds to your short-term funds or money market funds, all these things can be used for that. Anything which is 3 to 5 year horizon, they are so again it depends when are you planning to buy that property. If you have 3 to 5 year horizon, you can look at asset allocation categories. There are a lot of new structures in fund of fund structures which are available in the market, which I feel are brilliant to achieve these kind of goals, because they give you access to a lot of asset classes which can be built if you have a 3 to 5 year horizon. Some mix of hybrid kind of structures also can be looked at, and if you have a 5 year plus horizon, definitely you can look at some 60 to 70% equity allocation in your portfolio, again heavily tilted towards blue chip category, because I feel for a goal like home, I think we should not look at dabbling into high risk category like small and mid caps.
Okay, and Tarun, Sona was also asking in terms of a breakup. What should we do in terms of the breakup between equity, hybrid, and debt mutual fund? How should we be dividing that?
So again, it depends purely on the risk profile and the time horizon, right? So as I mentioned that if you have a 5 year plus horizon, it is good to have a 70% plus equity structure. If you have a 5 year plus horizon, if your horizon is say between 3 to 5 years, then maybe anywhere between 30 to 50% equity structure could be looked at. And if your horizon is less than 3 year, I feel you should be largely into debt oriented assets.
Okay, all right. Kshitij, your take on this? How should one split investments between equity, hybrid, and debt mutual funds? Of course, you said not 100% should be in equity. Is there a specific split that you would like to talk about?
So again, it depends on what's the time horizon when you are buying you are planning to buy your home, and what type of amount you are looking at as a down payment. Let's say because you are not only planning for your home buying only, you have other plans also. I think if it's specific to home buying, I think it should be 5 to 10% in arbitrage. If it's more than 5 years, I'm saying you have time frame. And broadly should be flexi cap and multi cap equity that one should look at. Small or mid cap can be little risky because for that home loan goal, because they can be much more volatile than flexi cap and other categories. And then you should keep 20%, so 10% arbitrage, 25% your hybrid category. That includes multi-asset, hybrid, BAF, and remaining 60-70% pure flexi cap, multi cap category funds. That's one should look at while aligning their goals or aligning their steps for home buying.
Okay. Tarun, what's your view just coming in, given that real estate, the inflation also is something that we're seeing. But how should one be managing this with mutual fund? Is it possible to beat that inflation and manage that risk?
Yes. I think real estate, if I look at, and I'm dividing real estate in 2-3 different sub-markets. So talking about urban areas or the metros, talking about tier 2 cities, and maybe third could be more, let's say, towns we are talking about. So these, I have seen the growth rate of real estate in all these 3 sub-markets are very different. Markets like metro markets have not seen the growth, the real estate growth had been lesser compared to tier 2 cities. So I think depending on the location where you are planning to pick up real estate, you need to align your investment accordingly. Yeah. So when you are looking at, let's say, beating the inflation, and I have seen largely the rate of inflation is the rate of growth of real estate in these metro markets at least. So maybe if you want to beat the inflation, you need to definitely look at a higher equity tilt in your portfolio, because as we have seen in last 10, 15 years, the equity returns have been say around 12% and above, right, on a long-term basis. So that could be one asset one can look at. But the real growth can outpace the property price appreciation, provided you have a long runway enough. I think it all depends on the runway, the time horizon you have. Based on that, you can select the asset allocation in the portfolio.
Got it. Tarun and Shritish, this is very helpful, but we have to get into a quick commercial break. When we come back, we'll discuss more on how to use mutual fund investments to fund your residential house.
Welcome back to MF Corner on CNBC TV18. We still have Kshitij Mahajan as well as Tarun Parani, and today we're discussing how mutual funds can actually help fund your dream to build your home, buy a home as well. Kshitij, while we've spoken about, the time period, the approach that comes in, given the time period as well, what is better? Would one go for SIPs? Should one go for lump sum approach? Or is there a mix that one should be following to achieve this goal?
Well, really depends on what type of cash flows one is having while approaching his goal of buying a home. But yes, SIP always benefits you because there's a discipline through which you keep on putting money on a monthly basis. There is a process through which you keep on accumulating units. And then you certainly see after some time, if you go a little long, let's say 7, 8, 9, 10 years, that the multiplication and compounding effects coming very rightly in your investments. At the same time, if you ask me, if somebody is having a lump sum money and they want to keep this money aside to buy a property, then I think rather than just putting that money in one go, they should look at doing a STP in that, in the same fund in which you're doing a SIP. So let's not get into a lot of funds. Let's say if you decided to two funds to allocate towards your home loan goal, let's divide that money in two different corpus and half of corpus, and then deploy over a period of time. So equity actually gives you to combat with as you rightly said in the last question, with your real estate inflation also, because over a period of time it has delivered better return vis-a-vis real estate. So I think the right approach is doing a STP in a lump sum, but at the same time complementing it with a SIP strategy, which always helps to build a long-term corpus.
Got that. Tarun, then in case when we are approaching the purchase date, how and when should investors shift from, say, equity funds to, say, for debt funds and vice versa?
Correct. So I think this is one of the very critical things, and based on my experience, I have seen a lot of accidents which can happen if this is not planned in a proper way. So let's take, so what I'm talking about is rebalancing. The rebalancing of the portfolio need to be done correctly if you want to make sure that when you have to actually pay the money, you have the money available, right? So just to give you some context here, that equity allocation should reduce as the goal date approaches. So let's say if you are more than 7 years away for your goal, a higher equity allocation, say 60 to 80% based on the risk tolerance, can be maintained. If you are 3 to 5 years away, start gradually shifting a portion from equity to short-term debt or hybrid funds. If you are 2 years away, entire goal corpus should ideally be into low risk debt funds or a liquid fund, money market fund, or ultra short term duration. Again, why gradual rebalancing works, I think it avoids trying to time the market with one big shift. It gives you smooth out exit load and as well as taxation impacts also. Again, it helps you lock in gains progressively, protecting the purchasing power of your corpus. So my suggestion would be we should plan it in a very, very strategic way and not to let it come for the last day when you have to actually pay for your property.
Absolutely, gradual shifting will also be key and not a last-minute strategy that should be followed. Kshitij, are there any specific categories of funds or any specific fund right now that is looking attractive if someone is doing this or, moving or rebalancing their portfolio right now, whether it's a short-term or a long-term fund? Anything that you could give us on that front?
Yes. The reason when you are shifting, when you are pushing your goal towards a safer asset, I think one should look at the fund with the lowest volatility. Right now, the main purpose is preserving our wealth rather than just, getting that extra buck or extra kicker. The most important point is, let's say if your date is coming on 1st of January 2026 and you have, let's say 5 more months or 4 months to 4.5 months to go, then you should look at how you can save that asset. So I think one should park funds in overnight funds. They can look at parking in liquid funds. If you have 1 year plus time on your side, then I think arbitrage works really beautifully. But again, I will not ask everyone to look at just parking everything in arbitrage fund, because arbitrage has a tax advantage because 1 year plus it's 12.5% only. Other asset classes are been taxed as per your tax slab. So I think a mix of overnight fund, liquid fund, or let's say a short-term fund and arbitrage fund if you have funds over more than 1 year to buy your home. So that's how one can look at.
Got it. Let's talk about the tax implications, Tarun, because that's ultimately very important when you consider investments as well. So what are the tax implications someone should consider when redeeming mutual fund investments for buying a house?
The mutual funds are divided into, again, equity funds, fund of funds, debt mutual fund. What kind of funds you are picking up, based on that, taxation will be applicable. So for typically for equity funds, arbitrage funds, less than 1 year horizon, you have a 12.5% taxation. More than 1 year, less than 1 year, it is 20% taxation, and more than 1 year, it is 12.5%. Debt funds, again, if you have bought the debt funds after April 1st, 2023, all gains are taxed at your slab rate with no indexation. So they are at par with most of the fixed deposit taxation rates. So again, if you are holding any old debt investment, review their purchase date before redeeming. They could significantly affect your tax liability. spreading redemption across financial years can further help you minimize your tax burden. Again, one very important part is some of your capital gains, some part of your capital gains you can adjust with buying a property also. So that tax advantage also you need to be aware of, because these tax capital gains can be adjusted against the property purchase also.
Okay. Okay, Kshitij, a very quick one because we are almost out of time. But what is the SIP amount one should be looking at currently if they want a corpus of around 30-40 lakhs in the next couple of years?
So let's take, for example, a reasonable rate of return, 12% on the investment side. And at the same time, let's look at that, that you have inflation, which is real estate inflation at 5%, which is going. So what we are looking at is right now, if you have to do that, and let's say if you're looking at 30 lakh of investment right now, which will cost you around 40.2 lakh over a period of time, one should look at a corpus of around 38,550 rupees. If it's 20 lakh, you need to have, because with inflation, after 5 years, 26 lakh is something which is required with 5% of real estate inflation. Then you need to have close to about 25,700 rupees as a monthly SIP, which one has to do. We are assuming that your money will grow at 12%. So that's an assumption to take into account.
Got it. Of course, that is the assumption that we are going with. Thank you so much, Kshitij and Tarun, for joining us today and taking us through the points that we need to keep in mind, the viewers need to keep in mind when they have to use their mutual fund investments for buying a house. It was a pleasure speaking with the two of you. But with that, we have completely run out of time on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.
go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
US has signed an extension now that's come in for the tariffs. So that is what is keeping these markets a bit choked up in trade.
He wasn't going to mess with me. This war would have never happened.
The Nifty and the Nifty Bank had a decent move, and we've managed to close above the 40-hourly exponential moving average. It's absolutely flat for now. 0.14% lower on the Nifty.
That the tariffs will settle down at 15 to 20 or 25 or 50, the sensitivities vary.
I have always been thinking that if our market share goes up there, it will not be a cannibalization of the other exchange.
It is a big leadership shake-up at Suzlon Energy, where Chief Financial Officer Himanshu Mody is all set to step down.
The high today was 24,700, but now we are 120 points from the highs of the day as well.
We will spend money on what we call a PIP, which stands for Property Improvement Plan.
The year-ago number is 3.6, which is also below the mandated number of the MPC.
We came off sharply from the highs, from those levels of 24,700, and we've now been consolidating at the 24,550 mark.
Okay, well, consequential day yesterday, but today not so consequential. About 30 points lower on the Nifty is what you have with an hour to go. You saw the run-through as far as the day is concerned. Not very much by way of excitement on the indices at all. Stocks, though, is a different matter. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Rima here in the studios. And Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi, afternoon. A quiet consolidation session and no follow-through after yesterday's big buying. I think sectorally it's autos and IT where you are seeing some green, while banks continue to struggle. The Nifty Bank now down 400 points.
It's been struggling since the morning, actually, the Nifty Bank. That hasn't changed. And we've had a very quiet session. The good thing is, at least we're not falling again. But of course, some of the other regional markets, Japan, mainland China, Hong Kong, and even Australia, all other Asian markets have done better than us. So it's once again kind of a little feeling of being left out, so to speak. Nigel.
Well, that's right. Just looking at the Hindalco's numbers, actually, and Novelis was a bit of a disappointment. But, Novelis had guided that quarter, the past quarter, that's quarter one, was a bottoming out of the EBITDA. And they say that things will improve from here on because of their cost-conserving measures. And also today was a relatively better day for metals. So we saw Hindalco recover 2.5% from the day's low. And now there are two important numbers that we look at in terms of Hindalco. One is the aluminium business. We have the EBITDA that's coming at around 4,300 crores. That's better than the 4,000 crores that the street was estimating. And the second number is the copper business. It's coming at around 670 crores. The EBITDA number, the street was at around 600 crores. So the India numbers, yet again, I think for the last many quarters we've been talking about this, but the India business continues to beat, while the Novelis business, which was normally the bread and butter business, it's a converter business that's protected from LME price moves, that's been disappointing a little bit. So that explains why Hindalco has recovered from the low point of the day, because the India business, both the pieces, look quite good.
No, absolutely. And those numbers are coming in, and as we always do, we'll look at these numbers segment by segment. Nigel will do that a little later. For now, though, it is, a flattish to slightly sideways kind of market action overall speaking. Let me just quickly bring you up to date with what's lined up here in the next 1 hour or so of trade. So markets, of course, slumping to the day's low. Inflation prints, by the way, later tonight out of the US and before that out of India as well. We'll get you an expectation as far as both go. Remember, the last US data was pretty consequential, right? There was the jobs number that Friday evening, and then, of course, that Monday was the big one. Shares of Suzlon are in focus, and more important, the shares of Sammaan Capital, actually, is the one to watch out for. Suzlon's long-serving CFO, Himanshu Mody, who led the turnaround of the business, is joining Sammaan Capital. That's an exclusive source-based information. We'll go to that story in a bit. We'll have Astral, which is, of course, down sharply. We'll talk about this after, of course, the quarterly numbers. There's some downgrades, etc., which are coming through as well. Alchem Laboratories last I checked, was up over 5%. And, strong first quarter. So, actually, there's Marksons on the other side as far as pharma is concerned, 11% cut. And Ekta will be talking about those. Praj, of course, we've been addressing from the morning. Profits have plummeted some 90%. What's gone wrong with those numbers? Vamakshi will help us with that as well. Let's just quickly, take a quick look at what is happening as far as the overall screen is concerned. And then we can, bring in, I think Mitesh who's with us. Actually, I think Mitesh is with us. Mitesh, just a quick word on how the trade so far and whether there is any indication of what we've seen over the last few hours of trade or where we are headed near term.
Yeah. So, Prashant, I think, I've been maintaining that 24,750, 800 will be supply zone. We got a high of around 24,703. So I think, getting close to those levels, you will see supply emerge. And the only positive sign is that we have some oversold readings on the 2-hourly charts, 3-hourly charts. So I think, that's where you have a chance of a bounce back. But for a sign of a reversal, I think we are still some time away. We need to do some good base building, see some kind of a reversal pattern on the chart or some crossovers on the indicator and moving averages, which is not happening as yet. So for the timing, assuming that's just 24,350 holds, we could be possibly finding some kind of a consolidation between 24,350, 750 zones, and therefore, range trading would be a good approach here. On the stock side, Coal India is a buy for me, and so is DMart. So Coal India is a buy with a stop at about 381 for a target from 395. And DMart or Avenue Supermarts, that's a buy as well. Keep a stop just below levels of 4,200, look for targets of 4,340.
Okay, thank you very much for that. Hindustan Aeronautics numbers just flashed about some time back. On the bottom line, it appears to be a beat compared to CNBC-TV18 poll, 1,377 crore in terms of a net profit. The poll was for 1,218, so a beat on the bottom line, even though the profits have fallen 4%. EBITDA margins have come in at 26.7%. Again, ahead of the CNBC-TV18 poll, we thought margins would be flat on a year-on-year basis. Instead, the margins have expanded by nearly 400 basis points, and that stock is moving up. It was under pressure in the morning, and now it's flattened out. You can see that reaction coming through on Hindustan Aeronautics. And PN Gadgil is the other one reacting to numbers. I think the bottom line here has doubled, 96% increase in the profitability. The stock is now up close to about 7%. But let's get you an exclusive. Sources are saying that there may be a top management change at Suzlon. Rachna is here with the details.
Right, it is a big shake-up at Suzlon Energy as we learned from our sources that Chief Financial Officer Himanshu Mody is stepping down from his position at Suzlon Energy. What we're also learning from our sources is that he's likely to take up a leadership position at Sammaan Capital. Now, speaking of Himanshu Mody, he's a man credited for the turnaround that Suzlon Energy has seen. He joined the company in 2021, and since then, there's been a complete financial turnaround. This includes cutting down debts to zero, boosting profitability, and even increasing the order book significantly. Now, Sammaan Capital, formerly known as Indiabulls Housing Finance, is an NBFC with a focus on housing financing with assets under management of about 66,000 crores. So this move is particularly interesting because Mr. Himanshu Mody will be changing sectors. He'll be coming from renewable to financial services, but also for Sammaan Capital, who will be onboarding a man like Himanshu Mody, known for turning companies around. So we will be keeping an eye out for that.
Okay, all right. Thanks a lot for that, Rachna. Well, let's hop across to Dharmesh Kant, who joins us on the show. Hi, Dharmesh. Good to see you. When Suzlon a little bit under the weather because Mr. Himanshu is going to be moving. But Sammaan Capital, plenty of buzz in it. The stock has been quite volatile. I recall it went up to more than 150 odd. Then it pulled back to a great deal. What's your view on both these two names, if you have any view? What kind of a change does it bring to Suzlon? And will it be some kind of a flip to Sammaan Capital as well?
Yeah, good afternoon, Nigel. Thanks for having me on the show. I mean, it's very difficult to say because the domain expertise of Mr. Mody is quite different from what Sammaan Capital does. And both the companies were in quite trouble way back. Suzlon was into huge trouble, but it has climbed back. And I mean, giving that precedence that Mr. Mody turns around Sammaan Capital as well is difficult to say because going by the financials of Sammaan Capital, to my mind, it would be very difficult and tall order task for that company to come up, though the projects which they have financed in and around, new airport at Mumbai, so at Navi Mumbai, that may still work out in favor, but a long time has passed, and to my mind, I mean, we have given a miss to it completely. We are not recommending, any buy or neutral rating on Saman Capital.
Dharmesh, in 2 days, Yatra is up 35%, 38%. Is it a part of your portfolio or a stock that you're recommending?
We did have a track on Yatra, but I mean, it's more of a one-off reaction to the earnings which they have reported. And but again, the drift and the trajectory going forward has to be looked into. So to us, it was more of a 1 quarter, 2 quarter kind of a scenario rather than a consistent compounder going ahead forward. So it's more of a trading play, and as an investment buy, we are not into this space at all.
So not into the entire space, is it? Dharmesh, I'm just looking at some of the other stocks. Easy Trip Planners, for instance, up 4.5%. Travel Food Services, it's a different business, but important because a lot of their business comes from airport travel as well. They came out with numbers. That stock's been up as well, by the way. Travel Food Services, almost 6-7% as well. So you're giving a miss only to Yatra or to all of these stocks?
Yeah, Gautam, so we are giving to the entire space, we are giving a miss because it's highly competitive space. And going forward, the margins will definitely come down because of the competition which is there. And all these, I mean, Yatra is a slightly different model than the other online model portals which are there on the space. So to our mind, it's more to do with, I mean, if you have to cater to the travel and tourism industry, hotels are a better space to be in. Most of the numbers which came were in line in that type of expansion we are seeing, and the footfalls and the average room rate, how they are rising. So Indian hotels to us looks pretty attractive. So we are playing the straightforward, I mean, hotel segment, hospitality segment through the hotels directly rather than, all these online platforms.
Okay, all right, Dharmesh, got that. Let's talk about some stocks that are in the news today, and they're seeing big moves as well. And Astral is the other one. Stock has been down 6-7% since the morning. The numbers have clearly disappointed, but let's go across to Ria to really understand the details. Ria, what has gone so wrong with the Astral's numbers this time?
Well, yes, it would be very weak set coming in for Astral. As you said, revenue was lower just about 1.5%, but the EBITDA and net profit were down 14% and 34% respectively on a year-on-year basis. Even the margins have declined by around 191 basis points for the company. Taking a look at the segments as well, for the plumbing business as well as for the paints and adhesives business for the company, for both of these segments, margins have contracted quite a bit, and the volume for the plumbing business has been largely stable at around 56,000 metric tons in this quarter. Now, the company has said that the overall demand scenario has been weak in the polymer industry in Q1, and that the price volatility that we've seen in the PVC resin prices over the last few months has resulted in inventory losses for the company, and it has also affected the realizations for them. But going forward, they've said that PVC prices have been seen settling down since the beginning of the second quarter of FY26, and that market conditions are also seeing some improvement, so the outlook remains positive for the company. Apart from this, they've also approved a proposal for an acquisition of 80% stake in a company called Nexlon Chem, and the rationale for this investment is to manufacture CPVC resin, which is the key raw material for the company, and going forward this will lead to a substantial margin improvement for them once the operations start from the second quarter of FY27.
Thank you very much for that. Most of the brokerages have a hold call on the stock, and the target price broadly ranges around that 1,500. But as she points out, maybe things will improve from here on. Dharmesh, is the worst behind Astral? Q1 was a tough quarter, margin contraction. But from here on, is there value?
No, Rima, I think a couple of more quarters are there in the pipeline, which will be tough for all the CBPC pipes manufacturers, basically into the plumbing sector. Because we were talking to other competitors as well in the segment, the view was same. I mean, none of them sounded very comfortable on the deal pipeline, on the order pipeline kind of trajectory out there. So though the margin compression may still, stabilize in Q2 and going forward into Q3, but the volume pickup seems unlikely. But having said that, I mean, if you are playing a ductile pipe or alloy pipe kind of a segment, that's a much better play. CNBC-TV18 came out with a a very solid set of numbers, and there the robust, demand trajectory is being seen. So I think LI pipes and ductile iron pipes are a better segment for water, supply chain management rather than going into right now into, CBPC kind of a pipes, the companies which are catering to them.
By the way, while we're talking about some earnings disappointments today, and Astral is one, Praj is the other. The positive side is Alchem. Alchem has come out with actually really good numbers. We'll see if we can get Ekta in the next couple of minutes as well on this. But yeah, revenue growth of about 11%. EBITDA has moved higher by almost 30% year on year.
Yeah.
And the margin's looking good as well. Margin, in fact, is up to 23.5% as of Q1. I think Nigel's coming in on this. Nigel?
Yeah, just one more thing I wanted to spot out is on the BSE Jaiswal Nico, since we have been covering this, with regard to the big debt in the books and the possible refinancings that they could do, which could be a big trigger for the stock. They put out on the BSE that they're looking at possible early redemption of the debentures. Remember, the total debt was in the vicinity of around 2,500 to 3,000 crores. They have not specified how much of the repayment they'll do, but they're talking about early repayment. So that's why the street likes it. And also we have to see a possible refinancing because it appeared that they were paying close to 15% of interest costs. So since there's a big volume spike on that stock, just thought we'll highlight it. Our ticker team has just put out that they're going to be considering early repayment redemption of some of those debentures, and that's why the street likes it. Remember, 25% of the ARC got absorbed in the market, and now this piece of news has further excited the stock. Just thought I'll spot that, Surbhi.
No, absolutely. By the way, Jaiswal Nico is the number two is the number two spot in terms of volumes on the NSE. So it's not going up on small volumes. It's a small name, both price-wise and market cap-wise, but 9% on what are basically the second largest volumes. So it's a big one. 9 million shares, by the way, on that one. Let's talk about the pharma twins, Alchem and Marksans, one going up and the other going the other way. Ekta, tell us.
Well, yes, I'll start with the good news. Alchem, a good set of numbers which have come in. So the revenue is up around 11% on a year-on-year basis, better than estimates of around 4%. We had the margins come in at around 21% as compared to estimates of around 18%, and a profit of around 664 crores. So India, which is bulk of their sales, is up around 12% for the quarter. So it did well. It's around 68% of their sales. The international business totally was up around 9%. Within that, US was up around 8.8%, which is around 21% of the total sales. And non-US sales was up around 9.1%. In fact, the company has indicated that they will be accelerating in terms of the non-US business going forward. So overall, good performance which is coming for Alchem, and the US business, in fact, leading the way in terms of the international sales, and the focus will also be on the non-US business. Now, in terms of Marksans, interesting set of numbers because it's the operational numbers which really weighed down. So the revenue is up around 5%, but if you look at the margins, they've come in at 16% versus 22%, and a profit of around 58 odd crores. The US and North America was up around 30% year on year, but UK and Europe was down 19%. Australia and New Zealand was down around 13% this quarter, and that seems to be weighing down on the numbers.
Thank you very much for that. Stock is down today, but in the last 5 years, it's given a return of 1,500%. I think the CAGR has been astounding in the stock price, but just recently it seems to be underperforming a tad bit. That's Marksans Pharma. Dharmesh, Alchem Lab, Marksans Pharma.
I mean, Alchem's numbers are quite good. I mean, 50% of the pharma companies came out with a very strong set of numbers, the likes being like Eris Life Sciences, Mankind Pharma, Divi's Laboratories. All those numbers were pretty good. A couple of them were definitely a misses. On the large cap side, like Sun Pharma was a miss. But having said that, most of the pharma companies which are into CDMO, API kind of a business and less of a US-centric businesses, they have done pretty well this time around. Almost 20-25% kind of a growth has been there with stable set of margins. But the few companies, the view has been that most of the stocking has taken place in the US and European market because of the tariff-related issue, and that's why their numbers looked better in Q1. So Q2 and Q3 would be more of our testing out there because how long you will do the stocking kind of a business. Having said that, I think couple of pharma companies do look good to us, and one is Eris Life Sciences. It looks much better. And from the large cap place, Cipla, which came out with a decent and a modest set of numbers, looks pretty attractive on the valuation multiple metrics. So Divis and Mankind we have been liking, but the only concern has been the valuation has been far too ahead of the peer group multiples.
Okay, all right, Dharmesh, thank you very much for that. Good speaking with you, as always, here on CNBC-TV18. DCM Shriram numbers at the bottom of the screen, 9% versus 11% on a year-on-year basis. Profits, 17 versus 31. Both are year-on-year. There's a big dip which has come there. We'll take a quick commercial break here. Amit Gupta from Motilal Oswal Private Wealth will be joining us on the other side to take some questions. Stay with us.
Welcome back. Markets are slipping now down nearly 100 points on the Nifty, 350 lower on the Sensex. The 24,500 mark has been breached in the last 30 minutes. The selling pressure has accelerated. The recent low of 24,000, I think 333.34, that would be an important level for the markets to hold. For now, 24,500 is gone. Mid-caps, though, haven't seen aggravated selling pressure, still down close to about 0.1%. Let's drill it down to individual stocks. Hormus joins in. He puts the spotlight on the top movers in this market.
Well, earnings, reactions, and you would hear this word of earnings for the final few times in the next couple of days now, for the quarter at least. Start off with Tarson's Products, and this stock is now down almost 5% after its results. It has recovered from the lows of the day. At one point was down 12-13%, and it has now declined in 5 out of the last 6 trading sessions. You take a look at the volume volumes here, you've had 7 lakh shares traded compared to a 20-day average of 30,000, and the stock is now well below its IPO price, which was well over around about 600 odd rupees. Now, Marksans Pharma is the other major casualty after the results today. Now, 12% lower on that stock. This is the biggest single-day fall since March of 2020, and we've already had almost close to 65 lakh shares traded compared to a 20-day average of around 20 odd lakh, and the stock is down almost 40% on a year-to-date basis, and this has made it the worst year that it has had since 2019 for Marksans Pharma. Banco Products is the other one, that too is down around about 10% after its results, down in 3 out of the last 4 trading sessions, and it has declined 10% in the last 4 trading sessions as well. There was a bit of a gap in between where the stock had gone up 6-7%, but otherwise it's been on a downtrend. But between 2019 and till date, the stock is up almost 10x. So from levels of around 53, 54, the stock is now at around 540. And Sonata Software is the other one. It's gained today after declining in 5 out of the last 6 sessions. It's a big volume mover today. Take a look at the volumes here. 3 crore shares already traded here compared to a 20-day average of just 7 lakh. 11% higher on the stock. And this too is down 40% year to date. And this might just end up becoming the worst year that the stock has had since 2011. And Star Cement being the last one, another volume-led mover. And a 20% up move in the month of August already. We've had more than 1 crore shares change hands in today's session compared to a 20-day average of just around about 9 lakh, and with this up move that the stock has seen in August, it has turned positive on a year-to-date basis. Back to you guys.
All right, lots of interesting names there on the radar. Hormuz, thanks very much for that. Amit Gupta is head of equities at PMS Motilal Oswal Private Wealth. Amit, good to have you with us here back on the program. Thanks for joining us. So, you know, I was. This is just a theory and maybe just food for thought I wanted you to address. Apart from, so the market here in India, admittedly, over the last 6 months has underperformed the regional markets or global markets. So maybe that is correcting a previous era of outperformance. Earnings deceleration, valuations, all those factors are there. But do you think there is a new factor at the margin as well, which is the fact that what is, for the lack of a better term, in vogue right now is AI in a very large way, which is getting rewarded disproportionately around the world, right? You look at pretty much any large market, and that's the pack which is doing very well. Actually, as someone said, in the US, for example, it's 7 stocks in 3 sectors which make up the market. AI, defense, and banking. And AI, of course, is by far the larger theme there. In India, we have a lack of those kind of options, right? Large core AI themes. How much of that is a factor of the margin, Amit, as you think about what the market does from here?
No, I think you are right. So there are, some emerging themes. So artificial intelligence definitely across the businesses it is going to impact. So the bigger IT players, they are already seeing they have to move into more R&D. They have to come out with different AI modules for different customers. And what we have observed, the smaller organizations, where possibly the order book is not very, very substantially higher, they are moving into AI module actually very fast. And if suppose in any company you have 70-80% of AI already conversion happening, they will do much better in the market actually going forward. So there are companies, in the mobile advertising. Now, when we are seeing that 90 crore people in India are using internet, everyone is holding a smartphone actually nowadays, or at least a phone in hand. So in that case, there are various companies which are moving into targeted marketing now through the artificial intelligence. They are taking user data, they are putting up algorithms, and then the deep insight about the customer. In fact, there are companies which are going for conversion models. That means till the client is not getting acquired, they are not charging anything. So that is, to that extent, AI is used now even in the mobile advertising. And I think this is a big trend going forward. And these are asset-light models. So in your portfolio, when you look back,
it's using AI to make your business more efficient, targeted, etc. My question was different. If you wanted to get exposure to AI as a theme, what do you buy in India?
So mobile advertising is one theme, where artificial intelligence is used like anything. There is a company, Affle India, in that particular space. They are using this particular model of cost per user conversion. That means it is not that only with a single click. You are asking for the revenues. You are asking
advertising as a business. My point is core AI, right? I mean, the building AI. So you don't have those options, right? And at least global capital is hungry for those kind of ideas. And if it's very evident, the performance of some of these players. I'm not just talking about the Magnificent Seven in the US, other in Europe, in Japan, in Taiwan, etc., which is absent here. And maybe that is also a reason why the market has underperformed a little bit.
So it will take time.
Yeah.
I think it will take time, and that is where you have to put more R&D in India, which we have not done actually historically. So, but as what I'm saying, there are few businesses which may be small in size, they are emerging and they are taking some AI modules, whether they have done R&D of themselves or they are buying from outside. But we like those companies who are really doing R&D of themselves. And in small modules also, like as I discussed about mobile advertising, it's a big game going forward. And yes, from the big IT companies, we have to see how the structure pan out. But the mid-cap IT, some of them, they have already converted to 55-60% of their overall order book into the AI modules.
So Apple is one stock. Some of the mid-cap IT companies which are at the forefront of AI, would you like to name them? And is there any other play?
So in the small, if you look at in the mid-cap IT, there is a company, Gensa Technology, FL India, I already discussed. It has actually moved to almost 100% AI model of themselves. So slowly you will find the new game, the new players coming in. And all these fintechs, all these gaming companies, healthcare companies who have a large database with them, they are going to be the clients actually going forward. They will use their own modules and they will use the AI modules for target marketing also. So for example, Zomato of the world, they have a large base, 800 cities they are already in. Blinkit is now expanding forward. So you will see that they will also hire someone so that they can analyze the data. So how you will analyze the data? Ultimately, it is the artificial intelligence. So nowadays, previously you had only data centers. Now you have AI-driven data centers, right? Now you are going to have AI agents. So the game is changing, and obviously India will not remain isolated from it. India is also developing, and with the DeepSeek, which has come at a very low cost, I think it's a big opportunity for India. That when you are going to do R&D, possibly your cost may not be incurred higher, if that is one of the example. And I think this is where it's a good canvas for us, good opportunity amid all this volatility. And going forward, you will find some of the digital players doing really good, which are the asset-light models.
So AI, maybe not in its purest form, what US companies are doing, but in different aspects. And perhaps we'll see greater adoption and greater opportunities in the market as well. Take that point, Amit. Now let me pivot back to the big manufacturing opportunities. And I want to get your attention back to defense because of what we've just seen from Hindustan Aeronautics. It's so reassuring to see that finally one of the largest defense players, and at least decent numbers coming through, slightly above our poll as well. And even if I look at margins have actually expanded very smartly year on year. Now their margins are touching almost 26%. Let's get the stock up if we can. Hindustan Aeronautics. We'll get our colleague to give us more details on those numbers as well. But this is my question, Amit. I mean, on defense, what should one be doing? The stocks obviously rallied a lot. And Q1 was not good, and then the whole war specter also was fading away. So they've gone through a phase of profit taking as well. Would you be buying anything in defense on dips?
So yes, I think the direct answer is yes, because we feel this is a very strong theme. The only thing is it moves very fast. So after the Indo-Pak war, immediately we saw a very significant move in across the segment in the defense space. And then profit booking is also coming. So what we feel going forward, that the companies where order book increase is very fast, there you will see a better move going forward. See, execution happens later, but actually the stocks are moving with a percentage increase in the order book. So in Hindustan Aeronautics, previously we saw the stock became substantial mover because that time the order book was growing. Now there are portions of executions which may be sorted out, but eventually the stock has seen the major move with the order book surge, and it moved to almost 1,84,000 crores. There are companies like Bharat Dynamics, where the order book is hardly 22,000 crores. And there possibly, if the supply chain constraints are not there, eventually you will see a very higher order. In fact, with Armenia, when the order was done, it was almost $1.3 billion, where the major order came in Akash missile also. So we feel that this is a good segment, a growth segment, where volatility will be part of the game. whenever such kind of geopolitical scenario will come, where you will find the government is, trying to sort out the things outside, then the stocks also will see some profit booking, which we have seen now.
And so which are the ones that, as of now in your portfolio, Amit, which are the ones that you have and the ones where you think that there is it's a good story to back?
So we have a couple of stories from the PSU space. One is definitely Bharat Dynamics, which is part of our model portfolio. Then we have from the shipping, because the shipping, we feel, if you look at all the three companies right now, they have a combined, order book, and which is around 75,000 crores. And we feel it is going to be triple in the coming 3-4 years. And that is where the government focus is also there. And that's why I think in the shipping, we found opportunity. We found at a much lower level. And amid this profit booking, I think it is again throwing an opportunity now. So we have from these areas, and then from the private defense, because out of 1.4 lakh crores of total production in defense, now 32,000 crore is also coming from the private players. So you will find opportunities in those private players who have a long pedigree of operation, and they are giving ROE in excess of 30%. If you can get that with the increase in the order book, that is going to be a win-win situation actually for your portfolio.
Okay, thank you very much, Amit. Great discussion. Need to get into a break. On the other side, we'll get you a few BTST calls. We'll invite Mitesh back on the show.
invest.
Welcome back. It continues to be a fairly range-bound day of trade as far as the market is concerned. Let's look at what's happening within the F&O space, if there are any interesting cues there. Nigel's joining in from the F&O desk now. Nigel.
Well, that's right. Actually, we're seeing a lot of volatility, particularly in the last 60 minutes, which gives you a sense that maybe this has to do something with regard to the weekly expiry, because the Sensex actually, the contractor there is playing out the weekly expiry as of today. But this kind of a fall, nonetheless, is a little bit unnerving because the Nifty has fallen. And the problem today actually has been the Nifty Bank, because all through the trading session, that's been underperforming. The only solace, I think, is that at least by the time we wind up, the Nifty Bank would not have breached the 100 DMA, which is the crucial mark on the downside. So just keep that on your radar. The India VIX, even after the fall of around 100 points, is still very, very subdued, more or less flattish as we speak. So the India VIX still not indicating much panic, in terms of a big fall from here. Moving to the PCR, we started the day at around 1.04. But you're seeing the call writers, they're coming back into play. So the PCR has come down to around 0.87 as the last time I checked. Because the kind of call writing we have seen, 24,700, which we went in the first hour of trade, 24,700 call has seen a massive open interest build up and the premium has halved. As is the case with the 24,600 call as well, the premium out there as well has come down from 95 rupees to sub 50 rupees. But just keep this in mind. The Nifty is down close to 100 points right now. But the put buyers would not be making any money on a strike at around 24,550. Just take a look at the premium. It's moved up very, very marginally. So that's telling you there is some writing that we're seeing actually at that level as well. A mix of activity. So on the closing basis, this 24,450 level should not get violated. Going by that writing that we're seeing at around the 24,550 minus 100 points, that's what the put writers will be getting. Now, in terms of levels, you're looking at broad range. The recent low, 24,350, which we visited all of the last 3 sessions, and the higher end of the range. Today, we went to 24,700, 24,750. That's the crucial marker that you're looking at. Stocks that I'm looking at, PNB Housing Finance. The stock, remember, went into the F&O ban when it fell big time. Today, there is some unwinding of positions, and it's possible if we continue to see this sort of unwinding either today or tomorrow, it will move out of the F&O ban. So just keep that in mind. Last I checked, it was at around 83%. If it unwinds more, then in fact it moves out of the F&O band. It needs to come down to sub 80% of MWPL. And finally, possible entrant today will be Titagar. The numbers have looked pretty okay. The stock is up and volumes are massive, big open interest build up. So that's one of the stocks that should mostly get into the F&O band today. Back to you.
Oh, okay. All right. So we're going to keep an eye out on both of those. Nigel, thanks for that. By the way, I just want to pull up Bajaj Finance on the screen, because while the overall market has been volatile and we've got this 100-point drop, this is a slightly, unusually large fall for Bajaj Finance. It's 3% lower. Banks anyway have been weak right from the morning. I mean, for instance, HDFC Bank is the weakest bank right now. It's down 1.3%. ICICI is down 1%. But this is the biggest loser now on the Nifty, Bajaj Finance. Mitesh is joining in, so let's bring him in on this. Mitesh, just a specific comment on maybe Bajaj Finance and the overall bank weakness, and then final trades as well.
So Bajaj Finance, yes, I think there is very clearly, ever since we had that big gap down, which was on the 25th of July, the stock has been in downward trend, and in the last few days, it did a range of about 870 to about 895. Now it's breaking below that. So I think, it's a 25-point kind of range, so you expect 845, 840 to be tested. We're not very far away from there. And then, if it sustains below that, then I would look at even 800 being the well checked. So that's as I think the stock is clearly going through a corrective kind of movement. And on the stock side, Nigel was highlighting the banking index, and HDFC Bank is, looking like STBT. So keep a stop around 1980 here for a target of around 1950. And JSL, that's on the buying side. BTST here with a stop at about 708 and a target of 725.
Got that. Thank you very much for that, Mitesh. Let's revisit Praj Industries. That's been one of the accidents of the day, 7.5% lower today. The stock is halved in 2025. Amakshi is here to recap the numbers Q1 and the outlook going ahead.
Well, absolutely, Reema. Q1 wasn't as great for Praj Industries as has been the case over the last couple of quarters. The revenue has dipped by around 8%. The EBITDA margins have contracted by 825 basis points and the EBITDA has fallen sharply by 66%. The net profit, though, is seeing a very sharp fall, 94% lower on a year-on-year basis. And this is because in the base quarter, there was an exceptional gain of around 28 crores, which could be attributed to profit on sale of land. Now, even if we account for that and even if we remove that from the base quarter, it's still a very sharp fall in the net profit for Praj Industries. Now, what's actually impacting the numbers this time around? It's the bioenergy segment, which accounts for almost 60% of the company's revenue. That was down almost 24%. But on the other hand, the other two segments, which is energy engineering as well as high purity, they did quite well. Now, this time around, performance was largely impacted by their domestic ethanol business, which witnessed delay in execution cycles, as well as there was a liquidity crunch from the customers. And apart from that, the Genex business is still incurring expenses. However, there is no corresponding revenues yet, and the management is hopeful that in second half of FY26 is when the revenues from this particular segment will start coming in. Apart from that, there was also delayed execution of a couple of high-value engineering orders at Kandla, which led to higher infrastructure as well as labor expenses, thus denting the margins for the company. The ordering activity too, the order inflow stood at 795 crores, much lower as compared on a year-on-year basis, down almost 11%. So, an absolute weak set of numbers coming in from Praj this time around.
Thank you very much for that. And she was earlier telling us the PE of the company Praj Industries after the recent correction now stands at 35 times versus a peak of 55 times. So valuations too have corrected and margins 4.9%. Historically, the company used to enjoy double-digit margins, but in the last couple of quarters, we've seen it weaken. Thank you, Pamakshi. Jay Bala from Cash the Chaos is now joining in on the show. Jay, we started off the week well, but there is no follow-through. In fact, if anything, we're now down 100 points. Give us the trend and the setup right now.
Yeah, hi, Rima. Good to be on the show. See, the Nifty's decline from the July high of 25,000 and change may have possibly come to an end at 24,337 already. But if there was there to be another low, that low is unlikely to exceed 24,021. So we are very close to a bottom, or a bottom is already in. So watch out for Nifty to start moving up. If 24,955 were to get taken out, the decks are all clear for a much powerful move that will surprise a lot of people on the upside.
We're close to the bottom. The recent low should hold. But on the way up, you said it can surprise. What are the levels that we're looking at?
Yeah, I've been bullish on the markets since the second week of April, and I'm anticipating Nifty to hit 29,000 over the next 6 to 12 months. But we are very close to the market to complete this correction. There's about the all-time high is just about 7%, and if you look at the global picture, the U.S. markets, there's the main three indices: Dow Jones, Nasdaq, and S&P. They have about 5% upside left. So possibly we are looking at outperformance for the Nifty from here on, but it's very close to market confirmation. Wait for the confirmation. It'll probably be a day or two before this confirmation comes through.
Got it. And for the Nifty, you're essentially saying that if the bottom is in, we move up to 25,550, 25,660, right, on the Nifty?
That's right. I'm anticipating a move back to fresh all-time highs. It'll be in stages. For the DEX to be clear, I want to see markets first take out 24,702, today's high. Once that crosses, it completes an important price structure in the hourly time frame. Once that's crossed, the market will aim for taking out the July high. Once that's crossed, the market will aim for taking out the all-time highs. All-time high is not too far off; it's just 7%. And probably whatever the holdback for the markets, that's probably going to get cleared the next couple of sessions. Probably news will trigger it, but the price structure is
all this requires a little bit of help from the two presidents on Friday, Jay?
Yeah, possibly. Possibly. See that. I mean, if you look at the macros too, there is a big breakdown in crude. Crude is broken below 64 support, and you can see a big down move over the next few sessions, possibly testing 59. and 59 to 55, and then a bounce back, and then we are looking at 48 by the end of the year. So, probably that is signaling possible, peace talks coming to fruition. So let's see, market does what it does anyway.
Let's talk about individual sectors then. First up, banks. The price action has been a bit weak. Do you see it reversing?
It should reverse. I think it's a bit disappointing the way the banking stocks are moving. Nifty PSU banks is doing reasonably well. Needs some support from the Nifty private sector bank, but I think the support would come somewhere close to 53,480 for the Nifty banking index, the broad banking index. We need SBI to do the heavy lifting. It crossed the important level of 837 a few weeks ago. That we need a close about that. Once that happens, that will lift the sentiment for the whole sector. Coming to the other sector, I think autos are going to lead the markets from the front. Watching for 24,200 to get taken out. I think it's a matter of time. Already there are signs from a good performance from last week's pick of Hero Motors, and Tata Motors did reasonably well yesterday, and other names within the space are also showing some signs. So watch out for it. This leg of the next move is possibly going to be led by auto names.
Okay, all right. Jay, just hold on to that thought. I just want to pull up one stock, Piccadilly Agro. The stock fell with very, very large volumes. The numbers just came on the exchanges just in the last 20 minutes or so. And it had a very, very sharp reaction. And now it's seen a bit of a recovery. Just keep an eye out on that stock. Piccadilly Agro, I think in the last year or so, that the stock as it is was under some pressure. The last 5-year period actually has done very, very well. Sharp downtick is what we're seeing on Piccadilly Agro. We'll try to pull out those numbers as well. Jay, what about a couple of individual ideas? I think MCX as well as Max, they're on your radar. Tell us more.
That's right, Nigel. MCX looks more stronger than Max. MCX recent high that it registered in a few weeks ago, I think it was about July. That high went up with strong momentum, and the pullback from that has been a corrective structure, overlapping move, which is a classic corrective nature. And I'm anticipating a move somewhere close to about fresh 52-week highs, fresh record highest about 9,900. When it comes to Max Financial, again, similar setup, but it's slightly short term. A stop loss of about 1451, the price subject to about 1800. Fresh 52-week highs here to anticipation, but MCX could have further legs beyond what I'm projecting. But Max Financial is probably a short-term pick.
Okay, Jay, stay on. We have more questions for you coming up in just a bit. Market is still looking at a cut of about 100 points in the Nifty and less than that, 0.25% for the mid-cap index. We'll take a break and come back with some more stock ideas.
Welcome back. Well, it appears the Nifty will end in that vicinity of around 24,500. So it's a weak close, but it could have an element of expiry in it. The problem has been the Nifty Bank. I'll be interested to see the institutional numbers going by the kind of fall we have seen on the banks and financials. That said, we had a couple of earnings that have come in the last 60 minutes. So let's revise one. HAL. Ria joins in to help us out with a quick analysis. Ria?
Well, yes, very good set coming in for HAL in this quarter. And remember, Q1 is typically the weakest quarter for HAL in terms of execution, and margins are also usually the lowest in this quarter. But this time around, we've seen a revenue growth of around 11% for the company, which is slightly below estimates of 13% growth. But the EBITDA was up around 29% on a year-on-year basis. Margins have also expanded by around 279 basis points, coming in at 26.5%, well above the estimates that we were working with. Net profit has declined by 4% versus estimates of a 15% decline. Provisions have also declined substantially this time around by around 38%, and material cost has come down to 30% versus 35% in Q1 of last year. So that has largely aided the profitability this time around. Now, seeing as Q1 has seen such strong performance, it looks like the company is on track to achieve the guidance that they had set at the end of FY25. They had guided for revenue growth to be at around 8 to 10% in FY26, but they are going to revise this guidance after 6 months, and they may see double-digit growth in the revenue in this year itself versus what they were expecting since FY27, going forward from FY27. The adjusted EBITDA margins are expected to be maintained at around 31% over the next 3 to 4 years, and the FY26 order book target is at rupees 2.5 to 2.6 trillion. Now, some key things that we will be watching out for going forward in the earnings call: the timeline of order execution for the 12 LUH and the 97 LCA Mark 1A aircrafts, as well as the status of the Sukhoi 30 avionics upgrade project. And of course, we will be watching out for the order book and the order inflows for this quarter.
Okay, all right. Thanks a lot for that, Ria. Well, let's go back to Jay Bala, who's joining us on the show. Jay, a couple of other assets that we haven't discussed. What about the dollar index? Where is that one headed from here? You know, it's corrected more than 10% from the peak, but now it's not breaking that 97 mark. Where does it go?
It's dollar index has got a very short-term breakout. It's possibly heading to 103. It's dropped back to the previous range. That's telling us this is possibly a corrective move. It's probably a choppy move back to 103. As long as the index stays above 96, this is the opinion that I hold. There's a corrective bounce headed to about 103 to 104. We'll keep it, as conservative to 103.
Jay, since you have an overall positive view on the market, just give us an overview of large cap IT. I mean, large cap IT, if not rising, it needs to stop falling, right? For the index to eventually move higher. Did you see anything specific on the charts here you want to call out?
Yeah, see, the biggest drag on the IT index has been TCS, and TCS is very close to an important bottom. It needs just one more sequence of intraday move below the low that it registered last week. Once it does this, I think we can anticipate a reasonable counter-trend bounce to come through. It need not be even a reversal. And even the Nifty IT index 34,200 is a very important support. And barring TCS, most of the other names can put on a little bit of weight. Even a counter-trend move in the Nifty IT index can change the overall sentiment. If there were to be a reversal, it would be a very powerful move. I don't anticipate a reversal to come through for the Nifty IT index. I've been calling it a counter-trend bounce since April, but I want to be wrong. If I'm wrong, the move can develop even more powerfully. So I will keep the movement for the Nifty IT index as a counter-trend bounce to come through. But let's see how it unravels from here on.
TCS last week or earlier this week said that they will be giving hikes to 80% of their workforce effective 1st of September, and the range will be between 2 to 8%. So after the layoffs and delaying the hikes from 1st April, 1st September is the new date, but only 80% of the employees will be getting that. Jay, you said autos will be leading. That will be the leadership sector. Any particular stocks or trades?
Yeah, autos, we spoke about Hero Motors last week, and it's doing reasonably well, went up 5%, and it's up 2% even today. At least the last check, it was 2% up. Bajaj Autos is forming a very large base. Also, have a look at TVS Sri Chakra tires. TVS Motors has gone to record highs. Usually this follows where TVS Motors goes when the larger trend picks up. This is forming an interesting base here. Once the stock takes out 3100, 3200, this can lead to a very powerful rally. Watch out as a dark horse, TVS Street.
Got that. So that is those are specific trades, etc., which are coming through from Jay. Jay, stay with us. We're going to just quickly wrap up the market action here and then come back to you for more questions in just a bit from now. Do we have just I think we have 3 minutes to close. Do we have the inflation expectation numbers? If you can just quickly put the basics out, right? Both here in India and the US. India number should be out by, I think, what, 5:30?
4 o'clock, I think.
4, right after.
I think I read 4 o'clock.
We'll have those numbers come out, and of course later, that's the number. July 2025 expectation is 1.3%. That's the CNBC-TV18 poll compared to 2.1, the previous month and the year before, which is 3.6. So sharp deceleration is the India inflation picture. And of course, with regards to the US number, there is some sort of fear at the margin that maybe all these tariffs, average US tariff rates are now 15% or so, and there is some expectation that maybe that number will be closer to 3 or maybe tops 3. But the poll shows 2.8% on a year-on-year basis and 0.2% on a month-on-month basis. So those are the two big data points later today, which will be in focus as we come back tomorrow. Otherwise, I think we are ending pretty much at the day's lowest point. I think this is the day's low. And disappointing because it started on a pretty decent note. 24,465 is the low today, and we're at about 24,484 coming through. Market breadth, actually an NSE advanced decline also slipped. So by close, 1,550 stocks are down and about 1,400 stocks are higher. And this was, in favor of advances till at least 3 o'clock or so. So things did deteriorate quite a bit as far as broader markets go by the end of the session. Rima.
Well, banks were the biggest drags. HDFC Bank lower. In fact, the banking index down nearly 500 points. Bajaj Finance, Trent, HUL, Eternal, Nestle, a lot of the consumption names weakened trade. On the way up, IT, Auto dominated the gainers list. Tech Mahindra, top gainer, 2% higher. Maruti, Hero, M&M gaining 1.5% to 2%. A couple of pharma names, Cipla, Sun Pharma higher. And then metals too, little upbeat after the extension of the negotiations between US and China by 3 months. Tata Steel too gained about 1%.
Yeah, that was the large cap story. A disappointing day. Mid caps, even the mid cap index did end lower, 0.3% on the lower side. If I talk about the major losers, and you have, of course, the result casualties. Astral is topping that list. Praj Industries is close behind, 7% down there. Astral 8% lower. But even beyond, you had some of the railway names like RVNL, down 5.5%. Kajaria Ceramics 5% lower. Sirma lost about 6% as well. So plenty of weakness out here. But then, as always, you had the outliers. Good numbers from Alchem boosting that stock, for instance, 6% up. And the entire travel and hospitality space has done well today. Whether it is Elite, Travenews Tech, the company that runs Ixigo, whether it is Yatra itself once again. Lots of green for Yatra, over 30-35% rally in just 2-3 trading sessions, or easy trip planners as well. Look at that, Yatra, another 20% circuit today. Phenomenal move coming through. So travel and hospitality are themes that seem to be working well. Well, with that, it's a wrap on this edition of Closing Bell. But don't go anywhere because Markets Forward will take the action ahead. Indian equities end at the day's low after a largely range-bound session of trade. The Nifty slips below the 24,500 mark, losing almost 100 points. The Sensex is down about 350 points. Nifty Bank leads the underperformance.
Astral and Praj Industries fell after posting disappointing results, while SJVN gained on strong earnings and the launch of a new solar unit. Titagarh Rail also advanced after assuring investors it will recover the production loss from Q1.
MD and CEO of BSE addressed the buzz around curbing weekly expiry. Mr. Ramamurthy said that the exchange would look at the final views coming in from the regulator, but says it's a speculative scenario as of now.
Well, hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Amakshi Doria and with me is my colleague Surbhi Upadhyay. Surbhi, good afternoon to you. Not a good afternoon for the market.
Yeah, I know. We started the week, Amakshi, on such a promising note yesterday, but today that volatility was back and we ended up losing, all of our early morning excitement. So ending at the day's low never feels that good. Just to round this off, if you contrast India's performance with global markets today, then again, that's a weak spot because a lot of the Asian markets had a much better session. In fact, many markets were rallying quite a bit. The Japanese market, the Nikkei, for instance, was up 2%. It hit record highs. So we'll talk about that as we go forward. In fact, what was the big talking point in the morning was this 90-day extension that China has managed to secure in terms of the trade and tariffs with the US. So in general, the mood was fairly buoyant across Asia. The mainland Chinese market was up about 0.5%. Hong Kong managed a little bit of gain. Japan was running away, like I said. But none of this really rubbed off on India. And we ended low. Both the large cap screen and even mid cap swam, actually. So not too good a Tuesday.
Well, absolutely, Surbhi. And this continues from last week, wherein all the global indices were up for the week, but India, on the other hand, was not doing too well. Today, of course, the market had been flip-flopping between the red and the green. The Nifty briefly crossed the 24,700 mark as well, but we've cooled off almost 200 points from the day's highest point, and largely the fall is being driven by the banks. Take a look at HDFC Bank, ICICI Bank, as well as Kotak Bank. These three big companies were some of the top drags for the Nifty. Accompanying them was HUL as well as Reliance on the downside. Now, there were also a couple of stocks in the broader market that actually declined, especially in the last hour of trade, where they saw a very sharp fall. This list includes RVNL. Take a look. That stock has been down and out in trade today. It was doing fairly well in the morning, but, after just in the last couple of minutes, that stock has tanked. There you go. RVNL was down almost 4% today. Apart from that, Abbott was the other stock that took a very big knock in today's trading session, and so has GSK Pharma. But, I think we have a whole host of, action-packed, lineup on the show.
Absolutely. So let's talk about what we're covering over the course of the next 20-odd minutes. We'll start off with the movers and shakers of the day, and Vivek will give us the detailed account of how stocks moved around. We have a lot of mid-cap earnings to track, so we'll focus on the likes of Astral and Praj Industries, big drops coming in on some of these stocks. Then we'll talk about Suzlon Energy, where a change of management seems to be, at play. Last but not the least, we'll dive into all the events to watch out for tomorrow. But let's kick it off, as always, with the movers and shakers of the day. Vivek here with the details of the green, but a lot of red as well. Vivek.
Well, absolutely right. Very volatile trading session, red, green, and then back in the negative territory. Quite a few stocks in focus today. First on the list has to be Alkem Labs. This particular company came out with a very good set of numbers. Margins above what the guided range of the management itself was. On the back of that particular stock saw a strong up move higher today. The other set of stocks that managed to do quite well was the entire mid-cap IT space. That particular set of stocks did quite well. You did see names like Coforge, Oracle, all of these stocks doing very well. Even some of the other smaller names like Sonata Software did join in the rally, especially as far as the broader end of the markets were concerned. SJVN numbers came in the dying minutes of the session yesterday. Management commentary strong in terms of capacity addition. And on the back of that stock managed to end higher by over 5%. Samman Capital, our colleague earlier today, told us that, the CFO of Suzlon could be headed in that particular direction, to that particular company. Stock ended higher by almost 4%. And Granules, decent set of numbers in the quarter gone by. Some positive commentary coming in as far as the Gagillapur facility was concerned in terms of remediation. And Granules, that particular stock ended high by over 3%. But like you mentioned, quite a few laggards as well. First on the list has to be Astral, that particular number. Now, overall weak set of results, margins took a beating. Guidance too was quite muted. So Astral amongst the top laggards in the session today, over 8% lower. And very similarly, Praj Industries going into the results, that particular stock was very weak. But even after that, it was a big miss as far as what the street was anticipating. Very muted set of numbers as far as Q1 is concerned. So Praj Industries was the other stock that did see significant selling pressure throughout the trading session. KNR Construction, another stock from the broad end of the markets. The infra name, that particular stock, too, muted set of results. Top end miss, especially when you're seeing both the revenues as well as profitability lower by almost 25% on a year-on-year basis. And lastly, Action Construction or ACE, this particular stock, one of the top drags as far as the NSE 500 is concerned today, down on pretty sharp volumes as well.
Well, thank you so much for that comprehensive list of shakers and movers, Vivek. But moving on then, one casualty in trade was Astral. The company's shares slipped in trade today after the company reported a muted set of Q1 numbers. The net profit is down by over 30%. The margins also declined by nearly 200 basis points. Ria is here with more details on this. Ria?
Astral declined around 7% today after reporting a very weak set of numbers. Revenue was lower by around 1.5%. EBITDA and net profit down by 14% and 34% respectively on a year-on-year basis. Margins also seeing a steep contraction of around 191 basis points. Even if you look at the individual segments of the company, the plumbing business as well as the paints and adhesives business, both have seen a very sharp margin contraction, and the volumes for the plumbing business have remained largely flat at around 56,000 metric tons in this quarter. Now, the company has said that the overall demand scenario in the polymer industry remained quite weak for quarter one of FY26, and that the PVC price volatility that we've seen in the last few months has resulted in inventory losses and has also affected realizations for the company. But they've also highlighted that PVC prices have been settling down since the beginning of quarter two of this year, and market conditions are also seeing some improvement. So the outlook still remains positive, but nonetheless weak set of numbers, and the street reacted negatively to these numbers today.
Well, thank you so much for that, Ria. But the other casualty of the day was Praj Industries. The shares saw a dip of almost 8% today. The company reported a sharp year-on-year decline across all key parameters in the first quarter. Let me quickly take you through the numbers then. The revenue saw a dip of almost 8% year-on-year. The EBITDA margins contracted by over 800 basis points. The EBITDA saw a fall of almost 66%, and the net profit saw a very sharp fall of almost 94%. Now, keep in mind that this is because in the base quarter, the net profit did include an exceptional gain of around 28 crores. And even if we remove that sort of impact on the base quarter, it is still a very sharp dip as far as profitability is concerned for the company. Now, segment-wise, what did not do too well is the bioenergy, which accounts for almost 60% of the company's revenue. It was down 24%. On the other hand, engineering and high purity reported good double-digit growth. This time around, performance for Praj was impacted by the domestic ethanol business, where there was delay in execution cycle as well as liquidity crunch from the customers' end. Apart from that, the GenX business also incurred expenses with no corresponding revenues. The delayed execution of couple of high-value engineering orders also led to high labor costs as well as infrastructure costs, as well as the ordering activity was quite muted. The order inflow actually dipped by 11% this time around, and Subi, that actually explains why the stock was down and out in trade today.
Yeah, absolutely. Another disappointing quarter, and it's been happening repeatedly the last couple of quarters with Praj, like you said. So yes, not that great for investors, but let's discuss this and a lot more. Our guest on the show is Jay Bala of Cash the Chaos, and we also have Sudeep Bandopadhyay of IndiTrade Capital joining in. Let me, start with Jay with a quick market question. Jay, you've been keeping a positive view on the market throughout this period of consolidation. Just tell us, because people would be getting confused. They don't know what's working now. The market seems to be lacking momentum. So any specific, trading ideas or sectors to watch out for from a more positional view, since you are optimistic overall?
Outright, it's the Nifty Auto that's possibly going to lead the market higher. And the fact that markets have been going one day up, one day down, that itself is a positive sign from a positional medium-term a market that's finding difficulty going down, that tells us the ease of movement is not, the path of least resistance is not on the way down. The path of least resistance is on the way up. The market structure it's very nearly, completed the corrective structure, and 24,337 potentially has put in the corrective low. And if there was to be one more low below 24,337, it's very unlikely to exceed 24,021 because of this overlapping move. So this overlap, one day down, one day up, that's actually a positive thing to consider for the corrective structure. So when it comes to your sector, after autos, I think it will be metals which will join the rally. And I would consider Reliance itself as a sector. It's not yet showing signs, but I think that's very likely to come back to action. Also look at BSE Capital Goods. It's coming to a very important support.
Well, thank you so much for that, Jay. But moving on then, shares of Alkem Labs rallied after it beat street expectations in the June quarter. The company reported a volume growth of nearly 3% this time around, and the net profit also rose by 22%. On the other hand, Marksans, let's first focus in on Alkem Lab. Ekta is here with the report card. Ekta?
Well, yes, overall a good performance for Alkem. The revenue growth was around 11% better than estimates. The margins came in at around 21% and a profit of over 660 odd crores. India sales were good. It clocked double-digit growth of around 12%. International sales were up around 9% US did well within international sales. It was up around 8.8% and is around 21% of their total sales. Non-US sales, which is around 11% of the business, was up around 9.1% for the quarter, and the company said that they are accelerating the non-US segment. Marksans, it was a weak operational performance which weighed on the stock this time round. So the revenue was down up around 5% on a year-on-year basis. Margin 16% versus 21.7% year-on-year, and a profit which was down over 30% on a year-on-year as well as sequential basis. While the US and North America did well, the UK and European segments as well as Australia and New Zealand declined this quarter in double digits for Marksans, and that probably weighed on the stock this time.
Big moves there. Marksans down 11%. Actually, lot of big earnings moves. Like we've been telling you, Astral and Praj on the way down, Alkem up, and Marksans again down. So let me throw this open to Sudeep. Sudeep, hi. Great to have you on the show. Any of these stocks, I mean, all of them, some of them, the ones you track, and any comments to make, because investors would be wondering what to do, especially with the ones that have fallen, like Praj and also Astral.
Well, let me first comment on Alkem. I think I've been talking about this, Survi, for quite some time, that let's try and focus on pharma companies which have got a significant business in domestic market. Alkem is one of them, close to 70% business in India. So it's good to focus on these pharma companies because the growth is steady, and I think the focus is clear, non-US business. So Alkem definitely is a good buy, but from a long-term perspective. As far as the companies which posted negative or a subdued set of numbers, we do like the entire PV pipe industry, Astral Pipes, and this entire segment was a good segment to look at. Unfortunately, the numbers of Astral have been very disappointing, but I think this probably will throw up an interesting opportunity for acquiring from long-term perspective. I'm not recommending a buy in Astral immediately, but the space is worth watching. And let's see where the correction stops, and then it may be worthwhile looking at it for acquisition. I think a lot of factors went wrong for Astral in this the past quarter, but demand scenario remains strong. And I think the way the economy is poised, the way the spending in economy is happening, somewhere the consumption will pick up significantly. And I'm sure Astral also will pick up, maybe in Q2 itself. We will see a significantly better set of numbers.
All right. And Jai, if you can just come in on, Praj Industries, which was the other casualty of the day. The stock has corrected almost over 50% year to date. The valuations also are down almost 57% as compared to the peak that we saw in FY25. So at this level, is this an attractive buy, or would you still wait?
Thank you very much. The price structure, unfortunately, still doesn't look good. The momentum is still to the downside. It's fallen nearly 50% from its all-time highs, but I don't see a bottom formation for the stock yet. Similar structure for Astral too. Astral, as long as it must hold 1188 to 1100. there's a very two possible structure, potential in the long term. So as long as the stock can hold about 1188, there is still bullish potential for the long term. If 1180 to 1100 were to give way, I think that it signals a significant long-term top. But if 1188, 1100 were to hold, I think this is a short to medium term correction, and the Astral stock can try to recoup its recent losses and go back to 52-week highs.
Sure. And Sudeep, I'd just like to bring you in as well on NSDL, because this is one counter that has been doing quite well since its listing. Of course, yesterday was a blip, but I know it's a fairly short period of time for the counter on the bourses. But what is your view on this particular counter, given that the valuations for NSDL have now, surpassed those of CDSL as well?
Well, I've been positive on all these market infrastructure companies for the last 1.5 to 2 years. And I believe from a long-term perspective, financialization of saving is a reality. And this will definitely help all these companies to do well over the long period of time. But having said that, I think we need to be cognizant of the valuation. And I think, NSDL reaching CDSL-like valuation is, little fully priced, I would say. Because between the two, I definitely like CDSL because their revenue stream will be much more sticky, considering the almost 4 times the customer base which CDSL has, and the charges for the customer are on a folio basis, transaction basis. So it's not on value, it's not on So I think NSDL has a distinct disadvantage vis-a-vis CDSL in terms of revenue and profitability. It's very clear if you look at the numbers. So I think NSDL attracting the kind of valuation multiple which CDSL attracts, I think is little too full, and I will be a little careful in NSDL at current levels.
All right. Thank you so much, Jay, as well as Sudeep, for joining in with your take on some of these counters that were moving around in trade today. But with that, it's time for a short break. We'll get you the top corporate voices along with key market events to watch out for on the other side. So don't go anywhere.
Welcome back. You're with us on Markets Forward. Well, we had a very interesting corporate interaction with the management of BSE today. And of course, we did quiz Mr. Ramamurthy, the top boss of Bombay Stock Exchange, on whether the business is now stabilized, because we know that the capital market segment has been going through a lot of regulatory changes. Vamakshi has been on the top of all of this, right? I mean, a lot of these curbs that are coming in on the derivative segment, but this quarter the numbers actually were pretty decent for BSE, weren't they?
Well, absolutely, Subhi. This time around the quarter, the numbers were quite good, and there was no contribution that went into SGF, which is why the margins also looked slightly better, and the gap of the margins between BSE and NSE actually narrowed down. In fact, we were also joined by the management, and they have highlighted that gaining market share for them is not a target. They would like to first have 800 members, 500 FPIs, and more longer tenure contracts, and that that is something that may or may not result in market share gain. So that is something that they're focusing on. And apart from that, what they've also said is that, they are focused on diversification of the revenue streams. They're not focused on improving margins, but it could be a result of that. In fact, let's also listen in to what the management had to say.
The starting point is still a speculative situation, that if it happens, so we have to deal with it as and when it happens. If it happens, what we all know is whatever is good in the interest of the market is what the regulators will do. So therefore, we need to wait for what the regulatory thought process is, more so because the regulators have clarified. If any reply were to be tried by me now, it is based on a speculative thought process.
Okay, that was BSE on this whole business of what happens if at all weekly options expiry gets changed to a fortnightly expiry now. But he said it's speculative, so best not to comment. Let's move on. Indian Hotels is set to buy 51% stake in two entities with 135 mid-segment hotels across India and Sri Lanka. This would be at a value of about 200 crores. That's how much they're looking to spend for this acquisition. The move will help the hospitality major expand in a new segment with a wide geographical footprint. We caught up with the company's CEO, Puneet Chatwal, about this expansion.
There'll be a rebranding exercise over the next 18 months. Some will take 18 months, some will take 3 to 6 months. The hotels under development can be easily changed. That's not an issue. Some may not fit in and might have to exit. So we'll do it case by case. A team has been appointed. The majority of the Ginger hotels operate somewhere between 3,500 to 6,500 rate. There are certain outliers which could be below 3,500, like a Ginger in Chanakyapuri in Delhi is at around 9,000 plus. So those are like the outliers, but the majority of the portfolio, depending on a tier 1, tier 2, tier 3 city, is between 3,500 to 6,500. So our opening that we have often spoken about, Prashant, you and I, and on your channel, the Ginger Mumbai airport is exactly at 6,500.
Well, that was the management of Indian Hotels speaking on their expansion plans. And before we wrap, we bring you some key market events to watch out for. Upasana is here with more details. Upasana?
Well, first up, let us start with the global economic cues, starting with US first. IEA monthly report and even crude oil inventory data will be out tomorrow. And also the most important thing is the FOMC member Bostic speaks tomorrow on the economic outlook. Now, in terms of global earnings, we'll be closely watching out for Brinker International, Cisco Systems and Tencent Holdings. All these are the US-based companies. Now, let us look at the Indian markets. Now, as we come towards the end of the results season, we'll be watching out for some of the important earnings that will be reporting their numbers tomorrow, such as BPCL, Max Healthcare, United Spirits, Deepak Nitrite, IRCTC. All these counters will be reporting their Q1 FY26 numbers tomorrow. Now, stocks like Dredging Corp and MIRC Electronics will also be in focus on the back of corporate action, as their board meeting is scheduled to consider fundraising plans of these two companies. Now, Bluestone Jewelry IPO closes for subscription tomorrow as well. And lastly, trade unions, farmers to protest against US tariffs and India-UK deal effective from tomorrow. So all in all, looks like quite an eventful day tomorrow.
Okay, all right. Upasana, thanks very much. We will, of course, keep all of those events on our radar. And with that, it's a wrap on this edition of Markets Forward. Thanks so much for watching. We'll be back with more news and updates in just a bit.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. A late sell-off on Dalal Street as the Sensex and the Nifty end at the low point of the day. Financial stocks lead the decline. The Nifty drops below its 100-day moving average. The US and China avoid triple-digit tariffs on each other's goods, agree to extend the trade truce by another 90 days. US retailers get ready to ramp up inventories ahead of the holiday season at the end of the year. European leaders say Ukraine should have the freedom to decide its future ahead of the summit between President Trump and President Putin on the 15th of August. Trump appears to entertain the idea of giving away parts of Ukraine to Russia, sparking panic in Brussels. The Indian government considers a 4,000 crore rupee loan guarantee scheme for small businesses and exporters to cushion the blow from higher US tariffs. Banking sources say interest rates for MSMEs can be reduced if protected by government guarantees. Trump's tariffs dent Hindalco's US subsidiary Novelis in Q1. The company estimates a $60 million hit in Q2 as well. Hindalco's India business beats estimate as the company reduces its debt burden. Insurance regulator gets a whistleblower complaint alleging conflict of interest at Westbridge Capital. Sources say Westbridge is the promoter entity for both Star Health and Kiwi General Insurance. Current regulations do not permit one entity to be the promoter of two-stream insurers. That's an exclusive. Sam Altman hits back at Elon Musk after the Tesla CEO accuses Apple of favoring OpenAI on its App Store. Altman calls Musk's allegations remarkable and accuses him of promoting his own firms and ventures using his own social media platform, X. Israel's military continues to attack Gaza despite global outrage over the killing of 6 journalists. 5 more Palestinians, including 2 children, starved to death, raising the total number of hunger-related deaths to 227. Protests in Delhi and other parts of India after the Supreme Court ordered all stray dogs in the National Capital Region to be moved to shelters within 8 weeks. BJP leader and animal rights activist Maneka Gandhi says 70% of dog bites are caused by pet dogs and calls for a balanced approach to ensure safer streets. Well, let's go straight to the market action of the day. The Dalal Street failing to hold on to opening hour gains, ending at the low point of the day. In fact, the Sensex and the Nifty ended nearly 0.5% lower today. The Nifty Bank closing about 1% lower almost, and the Nifty Mid-Cap lost about 150 odd points, 368 or 0.5% lower on the Sensex and the Nifty. 30 stocks ended in the red as financials dragged the markets lower. Prashant is standing by with the details. Prashant, what happened in the markets today?
Well, a bit of a reversal after yesterday's very, very strong close. Yesterday, the Nifty was up about 200 points. Today, it gave about 50% of those gains back. No real specific reason per se, no real news flow, but just, a bit of a drift which became sharper towards the end, the last 1 hour or so. The Nifty, Bank Nifty, Mid-Cap Index, all three ending down, nothing large, 0.25%, 1/3%. The Small Cap Index managed, I think, a flattish kind of close, maybe even slightly higher. I'll start with what was down on the Nifty. Bajaj Finance, HUL and HDFC Bank were the 3 names which stood out with some profit booking. In terms of gains, you had Tech Mahindra, Hero MotoCorp and Maruti, which stood out. In the broader space, through the course of the day, there were more stocks higher than lower, but by close, it was almost exactly 1:1. And I'm talking about all NSE stocks here. In any case, I'll start with what was up. A lot of the smaller travel kind of names, Ixigo, Yatra, Travel Foods, these were all up sharply. Sonata Software was the #1 volume-led gainer today in the market. Again, no real reason per se, except the fact that the stock had corrected quite a bit. Jaiswal Neko came up with very large volume, small name again. Alchem, result reaction. Star Cement was higher sharply. Medi Assist cleared a block in the morning. And there was, of course, strong buying after that. And there was something like a car trade which stood out with some action as well. In terms of cuts, Astral reacting negatively to numbers. Marksons, something similar. Praj Industries, again, earnings reaction. You had Action Construction, 5% yesterday, 6% today. So it's taken a large knock. And by the way, the stock's not done anything for the last almost 2 years now. Sirma, sharply lower. Man Industries, Kajaria, Aether Energy, about 5.5% cut coming through as well. So a bit of a pause after what looked like a pretty good start to this week. 2 more days before, of course, we run into that Friday market holiday. Today is important because we get inflation numbers in India. And then, of course, out of the US, you get inflation numbers out of the US as well, which I reckon from a overall market perspective will be the bigger one to watch out for tomorrow.
Well, Prashant, on cue, the India numbers in retail inflation for the month of July easing to 1.55%. That's the lowest reading in 8 years. Food prices were contracted, hitting the lowest level in 6 years. Latha standing by to decode the inflation fine print for us. Latha, good news clearly on the inflation front.
Well, good news, but the surprising word I'm going to use is that it is higher than expected. Our own poll expected 1.3. So although 1.55 looks ridiculously low for an India inflation number, the poll had actually thrown up 1.3. But to be fair, there was a wide, there was quite a range. There were two people actually, SBI and Citi, two very prominent economists who were expecting as low as 1.1. So that dragged the average down. Even otherwise, my average would have been 1.4. So you will have to say that the July inflation number has come in slightly higher than what the street expected. There were some numbers floating around at 1.7, but those were few and far between. Almost everyone was at 1.4 at best. So this is a bit of a surprise, you will say. And food inflation perhaps is the one that surprised a bit. The number that I had was minus 2%. It's actually come in at minus 1.7%. So perhaps that's why the number is slightly higher. The headline number is slightly higher than what we thought. What's been dragging down food have been the two heavyweights, cereals and pulses. They're falling even month on month, mind you. Usually during the monsoon months, you start seeing these food prices rise because of dislocation of movement of goods, but nothing of that kind because of the excellent monsoon, early monsoon. We have actually had a salutary impact on food inflation expectations. That's also keeping food prices down. So you're seeing these two heavyweights, cereals and pulses, down month on month. Cereals is down 0.1% month on month, and pulses is down a whole 1% month on month. But let's look at the year-on-year figures, which is, the correct way of looking at it because this is a seasonally adjusted product. Cereals are up 3% on the year. But the most important point to note is that edible oils are up 19%. That's the carry forward of the higher tariffs that were imposed. Fruit and vegetables, again, are down 20% year on year. That's because last year we had very high prices for potatoes and onions. And that explains why the inflation numbers have been coming so much lower in year-on-year terms at 1.5%, as you just saw. The other important number I should point out is the non-food, non-fuel inflation, core inflation, has come in at 4.1% compared to 4.4 last month. Last month, in June, it was 4.4. This month, July, it's coming in at 4.1. That's also because the base effect is wearing out. The base was very low for core inflation in the first half of the year. That is, 2024 had 3% core inflation up until June, and then it starts picking up a bit. So that's why we are seeing core inflation come down. But there have also been global prices, Asian prices of some metals falling, and that could be having an impact, a mild impact on our core inflation as well. Core inflation is also services inflation in our case, and some of that is also going down. So all told, the inflation number at 1.5% is mildly higher than what we expected, but well in line with what the RBI is saying. RBI has brought down the full year forecast from the earlier 3.7 to 3.1. So this 1.55 gels very well with the RBI's expectation. This will perhaps push yields higher. It bolsters what the Reserve Bank told us on August 6th. It didn't give us much of a hope that there will be yet another rate cut. For the bond markets, bond yields have already picked up. They are now 10-year is at 6.46. I think we should pull up the 10-year yet again. It's reacting very harshly to the numbers because from the word go, from August 6th, when Reserve Bank indicated that it is not in any dovish mood, the yields have been picking up. A further reason why it's picking up is fiscal deficit. Because the nominal inflation, nominal GDP is expected to be low, there are fears that the fiscal deficit will be high. The fiscal deficit is expected to be higher than the 4.4 estimated by the budget. Also because tax collections may be lower given the uncertainty on the tariff front and the generally lower consumption and investment that is expected from the private sector. All told, bond markets in India are in the dumps, as you can see. 6.47 now as we speak. The lowest that the 10-year saw was, imagine, 6.17 in end May, when we were expecting, inflation to come down and a generally good tariff situation as well. No such luck. At the moment, it's 30 basis points higher than the low about 2 months back. So, well, not a very, it's a good inflation number, but not much cheer for the bond market. Even this good inflation number, we will celebrate for 2 hours. After that, we are going to focus on the US CPI numbers. That's ruling the roost.
All right, Lata, we'll take that 2-hour celebration for now. But thanks very much for joining us. In fact, Lata will be joined by economists in less than 30 minutes to analyze the numbers for us. But the big story that's moving the markets worldwide, President Trump has extended the trade truce with China till the middle of November, just hours before the previous truce deadline was set to expire. This, of course, was expected. Now, President Trump wrote on social media, and I quote, "I've just signed an executive order that will extend the tariff suspension on China for another 90 days. All other elements of the agreement will remain the same," end of quote. China's Commerce Ministry has also confirmed the extension, saying Beijing is suspending additional tariffs on US goods for another 90 days. It's also postponing its decision on restricting trade and investment with some American companies during this period. As per their previous agreement, Chinese goods will continue to face 30% tariffs in the US, while US goods will face 10% tariffs in China. The pause averts the triple-digit tariffs and buys time for the world's two largest economies to work out a trade deal. Now, China has urged local companies to avoid using Nvidia's H20 processors, this according to a Bloomberg report. Now, these are the semiconductors used largely by AI companies. The advisory from the Chinese government complicates the plan of Nvidia to maintain revenue growth in China. Now, Beijing's move also comes after an unprecedented agreement between chip makers and the White House, where both Nvidia and AMD agreed to pay a 15% cut to the US government from their sales in China. Both Nvidia and AMD have agreed to this deal. It's not clear if China has issued any advisory asking companies to avoid AMD semiconductors just yet. Now, President Trump has praised Intel CEO Lip-Bu Tan just days after publicly calling for his resignation over his alleged ties to Chinese chip companies. Now, President Trump's remarks come after he met Intel CEO along with Commerce Secretary Howard Lutnick and Treasury Secretary Scott Bessent. Trump wrote on social media, and I quote, "His success and rise is an amazing story. Mr. Tan and my cabinet members are going to spend time together and bring suggestions to me during the next week," end of quote. Intel officials said that CEO Tan had a constructive discussion with the president on Intel's commitment to strengthen US technology and manufacturing leadership. So another U-turn there by President Trump. The other big global story, 26 member states of the European Union have issued a joint statement in support of Ukraine ahead of the meeting between Presidents Trump and Putin on Friday. The statement welcomed President Trump's efforts towards ending the Ukraine war. However, the leader said that the path for peace cannot be decided without Ukraine. Putin's ally, Hungarian Prime Minister Viktor Orban, is the only leader who did not endorse the statement. Speaking to reporters at the White House, President Trump said he could know within 2 minutes of meeting Putin whether progress was possible or not. Trump also claimed they will discuss land swapping in the summit in Alaska, expressing frustration over Ukraine's President Zelensky's insistence that the country would need to hold a national referendum on any peace deal. Zelensky has also rejected the idea that Ukraine must commit to give up land to secure a ceasefire. And President Trump has also said the 50% tariff threat on India is a big blow to Moscow. Trump said that India is the second largest oil buyer from Russia and the higher tariffs will hurt both economies. Here's President Trump.
They have tremendous potential in Russia to do well. They're not doing well. Their economy is not doing well right now because it's been very well disturbed by this. It doesn't help when the President of the United States tells their largest or second largest oil buyer that we're putting a 50% tariff on you if you buy oil from Russia. That was a big blow. And then they say, gee, he wasn't so tough. Nobody else would have done that.
Well, that's President Trump. Now, back home, the government is considering a 4,000 crore rupee loan guarantee scheme for small businesses and exporters to cushion the blow from higher US tariffs. We learned from banking sources that interest rates on MSMEs can be reduced if protected by government guarantees. Abhimanyu standing by with the details. Abhimanyu, what is being discussed at this point in time? What could the likely proposal be?
even as the threat of around 50% duty on Indian exports of labor-intensive products in the footwear and textile segment looms large on India's exports to the United States. Industry sources have indicated that a relief package is in the works from the government side. It is expected that the government is going to allocate around rupees 4,000 crores to banks to provide relief to small exporters having a turnover of less than 500 crores. The proposal will involve 10 to 15% credit guarantee to banks to advance loans to small exporters to help them tide over the current situation, even as both the sides remain engaged in negotiations for a bilateral trade agreement. Now, currently, the Commerce Ministry has submitted before the Parliament that as of now, there is 25% duty which has been imposed on India's merchandise exports to the United States, which impact 55% of India's overall merchandise exports, particularly in the footwear and textile segment. Also, there is a 25% additional ad valorem duty which is expected to come into effect from the 27th of August. It remains to be seen how early both the sides are going to explore a joint resolution or some degree of arrangement as far as ensuring tariff stability is concerned, even as negotiations are still continuing between both the sides. A combination of factors like product differentiation, demand, quality, contractual arrangements are going to determine the impact of reciprocal tariffs on India's exports, including exports from the textile sector. That is the word which has been given by the Commerce Ministry before the Parliament, even as both the sides remain engaged in negotiations.
Abhimanyu, many thanks. On to earnings now. US President Trump's tariffs have dented the performance of Hindalco's US subsidiary Novelis in the first quarter. The company estimated revenues in the second quarter will also take a $60 million hit on account of tariffs. However, Hindalco's India business beating estimates as the company continued to cut its debt burden. Nigel is here with more on Hindalco's performance. Nigel.
Well, that's right. Hindalco was in focus all of today's trading sessions because you had overnight Novelis that came out with a set of numbers, which was actually disappointing. And then you had the India business that reported its numbers that actually was very, very good. Let's focus on the Novelis piece, which is clearly being getting hit by these tariffs. So if you look at the EBITDA per ton, it came in at around $432 per ton. The street was bracing for a number in the vicinity of around $450 per ton. Tariff impact, yes, that played out. The management had highlighted that it could be to the tune of around $40 million on a quarterly run rate. Well, for the first quarter, they got hit by around $28 million. They're saying for the second quarter, going by the current tariffs at around 50%, they could possibly get hit by around $60 million in quarter two itself. And they're saying that if in case these tariffs are fixed at around 25% and 50%, then the impact will be at around $40 million to around $60 million on a quarterly basis. So that clearly is telling you that these tariffs are hurting them. The management, though, they are confident. They are saying that they're calling out bottoming out of the EBITDA and they're expecting things to recover from here on. How is that? Because they're looking at mitigating this impact. They're focusing on the cost side, which could result in savings of close to around $100 million. We'll have to see how that goes, but that number they have up from around $75 million to around $100 million on. Capital expenditure, they're not pulling back. They're talking about roughly around $2 billion for this year itself. So for Hindalco, Novelis was a miss, though the commentary suggests that things could improve from here on. On the India business, no worries though. Aluminium business, excellent numbers out there. The EBITDA number came in much better than what we were working with. And the aluminium, both the upstream as well as the downstream businesses, on a per ton basis, there's a big growth. On the upstream business, there's a growth of close to around 15%, while on the downstream business, it was 92% higher. So both those two looked good. Copper business as well was a pleasant surprise. So from an estimate of close to around 600 crores odd, they came in 10% higher at around 670 crores. The TCRCs have been a little bit weakish, but they got higher realizations from sulfuric acid. So both those two segments did well. And, even though Novelis' debt has moved up, in the consolidated entity, the net debt has come down marginally. So it's a tale of two halves. Novelis is struggling a little bit because of the tariffs, but the India business continues to do quite well.
Nigel, many thanks. Now, China has eased curbs on urea shipments to India, according to a Bloomberg report. This is another indication of a thaw in the tensions between Beijing and New Delhi and President Trump's trade policies targeting both nations. India is the world's largest importer of urea, which is used as a fertilizer. China is a major exporter of the nitrogen-based fertilizer, but it has restricted sales in recent years. We will head into a break, but up next, Sam Altman hits back at Elon Musk after Tesla's CEO accuses Apple of favoring OpenAI on its App Store. That and more when we return. In international headlines, at least 89 Palestinians, including 31 aid seekers, have been killed in attacks by Israel across Gaza in the past 24 hours. 5 more Palestinians, including 2 children, have starved to death in the enclave. According to Gaza's health ministry, the total number of hunger-related deaths now stands at 227. Palestinians held funerals for the 5 Al Jazeera journalists who were killed by Israeli forces in Gaza. This as protesters rallied in the streets of West Bank against the killings. Protests have also erupted globally, with journalists demanding accountability for the attacks. The Australian Prime Minister Anthony Albanese has accused Israel's Prime Minister Benjamin Netanyahu of living in denial over the suffering of Palestinians in Gaza. His statements came a day after he announced that Australia will recognize Palestine as a separate state. Similar moves were made by the UK, France and Canada. The Australian Prime Minister said that Australia wants the killing and cycle of violence to end. OpenAI CEO Sam Altman has hit back at Elon Musk after the Tesla CEO accused Apple of favoring OpenAI on its App Store. Altman has called Musk's allegations remarkable, accusing him of promoting his own firms and ventures using his own social media platform, X. Rachna joins us now to tell us more about the recent war for AI's global dominance. Rachna, so it's Musk versus Altman, with Apple crossing the crossfire.
Apple could soon be dragged into the latest and perhaps most personal chapter of the AI wars. Elon Musk is accusing the tech giant of stacking the App Store in favor of OpenAI, calling it an unequivocal antitrust violation and vowing legal action from his AI startup XAI. But here's the reality check. On Apple's productivity chart, OpenAI's ChatGPT isn't number 1. That spot goes to Perplexity AI. ChatGPT sits at number 2. Google's Gemini is at 6 and Musk's own Grok trails at number 11. On ratings, Grok matches ChatGPT's 4.8 stars, but with 1.37 lakh reviews compared to ChatGPT's 6.23 lakh, a far deeper user base is reflected here. So is this really about Apple's algorithm or about Musk's frustration that his app is still far behind? That's the question. But Sam Altman also tried hitting back, calling Musk's claim remarkable given what he has heard about Musk allegedly using X to promote his own ventures. He also accused Musk of sidelining competitors and targeting people he does not like. Altman said he even hopes for counter-discovery in court when the legal action is taken, saying that many would love to see what surfaces out of it. It's a rare moment where antitrust, App Store visibility and personal grudges are all colliding, and Apple may find itself in the firing line, whether or not it's the real cause of the problem. So we will be keeping an eye out for it.
All right, Rachna, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with a lot more.
Hello and welcome to this special edition of the State of the Economy. I'm Lata Venkatesh. The CPI inflation for July has come in at 1.55%. Okay, 1.6%. This is the lowest reading in 8 years. The last we saw it was in June of 2017. It is nevertheless a little above the CNBC-TV18 poll, which had actually predicted a reading of 1.3%. It's food prices, perhaps, that have come in slightly higher than what we thought. The poll had expected that food prices would fall by 2%, deflation of 2% year on year. The deflation is by 1.76% year on year. Just a couple of highlights in the food basket itself. The important point is the two weighty items, cereals and pulses, are falling even month on month. A little unusual, because as you head into the monsoon season, because of possible dislocation of the monsoons, you actually see food prices rise a bit. But we are not seeing this in the case of cereals and pulses. Early and robust monsoon is actually casting a dampener on even food price expectations. So we're seeing these two heavyweights falling, but it's kind of compensated by edible oils, which have been rising year on year. It's, I think, a rise of 19% or thereabouts, and vegetables as well, up 11%. The reason for the edible oil prices rising is because of the increase in tariffs on these items. Vegetables are higher month on month, but year on year, again, there isn't much to complain. Vegetable prices are down by 20% because a year ago we had seen a sharp rise in the prices of potatoes and onions. Those two under control at this time, but still we are facing higher prices as we know under normal conditions. If you take away the base, vegetable prices are not all that low. The impact is really a cereals and pulses deflation, which has brought down the overall food prices. Core inflation is at 4.1%, lower than the 4.4% that we saw in the month of June. And in core inflation, it's really gold, which is still higher and is adding a bit of pinch to the inflation numbers. Those are the initial points that we are getting from the data itself, but we will have more observations from the guests who are joining us. I'm joined by Devang Shah, who is head of fixed income at Axis AMC. The bond market reaction has been actually quite the opposite. Instead of a 1.5 number, a low inflation bringing yields down, we've actually seen yields rise to 6.47. So, Devang, important. The economists joining us are Aditi Nair, chief economist at ICRA, Madhavi Arora, chief economist at MK Global Financial Services, and Kanika Parsicha, the chief economic advisor at Union Bank. Ladies and Devang, thank you very much for your time. Let me start with you, Devang, first. Bond yields have risen and prices fallen even after the inflation number by, I think, 1 basis point. It was 6.46 before the inflation number came in. Your first thoughts?
Yeah, so I think, Lata, I heard you 20 minutes back. I think you were talking about the fears which markets are having. And actually, bond markets have actually gone into a complete dislocation at this point of time. I would say 2 or 3 things. Importantly, I think was a catalyst last year for the rally were all the macro environment which was weakening, positive demand supply dynamics thanks to fiscal consolidation and open market operations. And lastly, I think all put together, the overall fiscal consolidation which we have happened over so long. All of these catalysts are no longer working, and that is what is worrying, I think, bond markets. Bond markets started sniffing that this is the end of the rate cut cycle. Incrementally, in fact, as RBI pointed out in their MPC, that if next year inflation is going to be above 4.5, at least the Q1 number, and they printed at 4.9, then the room for rate cuts is significantly out. And that is what has scared the market. And the complete mismatch on demand-supply dynamics is creating the worry in bond markets. In fact, our view is that if largely we are done with monetary policy and the room for monetary policy space is limited, if we start talking about fiscal and fiscal impulse, or we start seeing some slippages on the fiscal side, that will scare markets more. So that has been the reason why people are not looking at the near-term inflation print, and probably people are now started looking at what's going on the way forward on inflation and the fiscal side.
Yeah. What I thought would be a boring inflation number is actually turning out to be an interesting discussion, because we've got altogether different factors impacting the bond market. My colleague Abhimanyu just broke a story about some fiscal packages being designed for exporters impacted. We don't know if there will be a bigger package coming in if things are as bad as they are. And plus we have to bring in the GDP discussion here, because nominal GDP is likely to be low, and therefore fiscal deficit as a percentage of that GDP will look larger. So everything going against the bond market at this point in time. And as if to add to it, I just have the NSDL announcing the numbers of FPI purchases. It's a bond sale as well. Of course, it's equity sales as well, but bond markets also are being sold off by the FPIs. But let's get to the heart of the discussion on CPI. Madhavi, what did you make of the number? Are you going to get even lower numbers? What is your year-end inflation number after looking at today's number?
Hi, Lata. So we were expecting around 1.35. I don't think a 10 bips or 15 bips slippage here and there does really change the dynamics of inflation for the year. As a whole, we are still looking at inflation averaging close to 2.75 or 2.8%, around those numbers. And we are much lower than the Reserve Bank, sitting today as well. So I believe that there will be further downside that you will see in inflation in the coming months. In general, of course, it won't be as low as this. The base effect will play out until, the last leg of this calendar year. And from fourth quarter onwards, you will see an uptick, in inflation, and probably that will continue in the first quarter of next financial year as well. And the Reserve Bank...
2.7 is your number. Do you have a rate cut in your expectations?
Yes. I have been sort of arguing the fact that the Reserve Bank's decision to keep rates unchanged in the last policy largely emanates from the fact that they are assessing the forward-looking inflation, which appears to be inching well above 4%, as I said, in the next year. And next year, the base effect will be quite adverse. Ideally, they should look at the average of 2 years to assess the inflation bit. That's one. And plus, in their view, growth is still looking to be pretty decently held up. But to be very honest, in a world which is going to be seeing a new reset, focusing on 1 year ahead expected inflation appears increasingly misplaced to me. The world is extremely dynamic and evolving at this point in time. And you will see a disinflationary impulse playing out in Asia, and India would not be any different in that. So I think, So I think on
the RBI side, I may only add that maybe they have kept some of the ammunition. They may be giving excuses about 1 year ahead inflation, but probably they just want to keep some ammunition because the global and the bilateral situation with the US...
Devang would like that you must be smiling.
Absolutely.
They all need
they probably want to say... will give us some hope, maybe in the September 30th policy. But I'll come to Aditi last because I want to discuss the fisc with her. Kanika, what's your sense? This inflation number, are there any surprises in it? Or can we just go on to discussing what to expect from the Reserve Bank?
I would say, Lata, the only surprise for us was that while inflation has bottomed out at 1.55, we were at 1.24. The only source of surprise was veggies, where the momentum captured in one of the segments, specifically tomatoes, is slightly higher than even shown by Department of Consumer Affairs. But coming to the next sprint now, we are looking at around 2.5% for August. In the coming months, we also think that, till December, RBI's trajectory fits well to 2.1% for this quarter. In fact, it's looking slightly higher now. And December quarter, 3.1. But our estimate currently is showing that Jan to March, while RBI is at 4.4, we're at 3.8. And April to June, RBI is at 4.9. Our number is tracking 4.5. So in our view as well, maybe a token 25-50 basis points rate cut has still been kept in the kitty. We are not looking at specific timing, as growth has not yet shown signs, some fault lines. Once that happens, or as you were stating, if the government eventually gives a fiscal package, not just credit guarantee schemes, but a package, then we've got to see if RBI also joins hands with a token rate cut. Thanks.
Okay. Thanks for that. Aditi, now to you. Your view on inflation, if you want to add anything at all, because much has been said. This 1.24, Madhvi, that doesn't make you the lowest. I had a 1.1 from Citi and a 1.14 from SBI. So there were a lot of people who are kind of slightly surprised by the food inflation number. You all wouldn't have been surprised if you had gone out to buy tomatoes. I had to pay 100 rupees for tomatoes. So I kind of sympathize that the vegetable inflation is at least reflected. You go out and tell people that inflation is at 2% or 1.5%, and that food inflation is at a deflation of 1.7, they are going to laugh at you. Cauliflower is selling at 160 rupees a kilo. Beans, French beans are almost unaffordable, even more than 160 rupees. So this is just a fall from a very high level, which makes it look like deflation, but otherwise things are difficult on the food level. But okay, that's taking it away. Aditi, your thoughts on inflation and more importantly on the fisc. Are we going to, as Devang says, be faced with probably a slightly higher borrowing?
Firstly, we were, looking at a 1.4% for this month, so not terribly surprised. Definitely the bottom. Next month, we're looking at a print around 2% or thereabouts. And for the year as a whole, we're looking at an average of 3 to 3.2%. And we do think we'll cross 4% in Q4. So now on the monetary policy side, we thought that it was an opportune time to have cut rates in the previous policy because the optics are definitely going to be very difficult from the inflation side going ahead. Now coming to the growth argument to support, a token rate cut as Kanika put it. We're actually running a 6.7% real GDP growth forecast for Q1 at this point in time. That data will be out in a couple of weeks, right? And we think that that's going to be the highest growth print for the full year. So the August print is not going to give you the bad news on GDP growth. That's going to come much later in the year. And what are a couple of the factors that have really propped up the GDP growth print for Q1, or at least our expectation? We've had majorly front-loaded government spending, both from the center and the states. CapEx and RevEx numbers are looking a lot better. And that is something that is likely to push up the Q1 growth number. Now, that actually leaves less room to spend as we go forward. Similarly, some exports have been upfronted, at least to some geographies. And there again, it's a cannibalizing effect, right? There's less that we're going to be doing later on. So unfortunately, we may be in for a tapering off of the growth rates going on out, even if the tariff situation gets resolved in the next couple of months and, in a relatively better position for India than what it might be.
Okay. So what are your, let me get one round of your GDP numbers. Of course, all of you have to assume whether we should go with 50 or whether we should go with 25% on the tariff front. But nevertheless, what are your working forecasts, work in progress now? Aditi, your GDP number, full year?
I'm at 6%.
Okay, so 6.7 Q1 and 6% full year. Madhvi?
6% with a massive downside risk if we are being slapped at 50% tariff, which would lead to nearly 60 bips or more slippage in growth. But assuming we'll somewhere settle on 25, I think we still would see at least 25 bips hit to my number.
Okay. And Q1?
Q1 around 6.8.
Sorry,
6.8. Same as Aditi.
Okay, same as Aditi. Kanika?
So Lata, we are at 6.3 right now. Q1 is at 7. We have not yet revised full year numbers, but the 25% tariff hike impact is around 30-40 basis points. So we may go to 6% with a downward bias for the full year.
Yes. Now, if I'm going to ask a slightly more difficult question to the three of you, but before that, let me finish with Devang on the bond front. Devang, there is, of course, this expectations channel which has been blocked by the Reserve Bank changing its stance from accommodative to neutral. Perhaps a crack will open in the door later on because of growth reasons, we don't know. But what is your sense about even the demand for bonds in the market? I hear insurance companies are not buying as they were expected to buy when we were looking at the borrowing numbers in April, when the government put out the borrowing program. I hear LIC is not a buyer anymore. It's almost absent from the market. So our demand, and of course, as we noticed, FPIs are not buying. Is there a surprise there?
So, see, our perspective is that, as you highlighted, the demand-supply dynamics is getting deteriorated. First half of the year, we had all the catalysts. We were expecting rate cuts. We had big bank OMOs. So, actually, RBI funded 5 lakh crores of the entire government borrowing. But in the second half of the year, because of the liquidity, which the way RBI has kept it at today, also durable liquidity is upwards of 4.5 lakh crores. And with the CRR coming in, we will see the liquidity quite ample. And you pointed out that the demand side has started to get weakened. And our perspective is that the demand supply dynamics is actually at the core why the bond markets are not performing. I perfectly agree with all the other panelists and your view also that yes, there is a possibility of a token rate cut and it's not completely done. But I think bond markets are looking at more two perspectives. One is the pace or the amount of rate cuts now is significantly limited. So at the fag end of the cycle, bond markets don't perform. You pick up any cycle in the last 15 years. And the second piece is this demand supply dynamics, which is getting deteriorating. It is also, I think, amplified by the way SDL borrowing has been. So the state development loan borrowing for the year is projected upwards of 11 lakh crores. Last year, it was at around 10 lakh crores. So higher SDL, the demand getting probably skewed. This year, we are not seeing the buyers. Also, there have been some guidelines changes in pension funds where they are shifting a bit of their allocations. We have heard it from multiple pension funds where they're shifting their allocations from bond markets to equities this year. So all of this is actually adding up to the dislocation and the demand supply dynamics.
Okay, that's also not a very good sign for equity markets. When the most conservative element starts buying equity, it usually indicates a weakening off even on that front. I hope I'm wrong. But, you know, I want from our economists the more important analysis of what they expect on nominal GDP. That discussion after the break. We are back in a jiffy. Welcome back to the State of the Economy show. After we got the July CPI numbers, the state of the economy looks a little bleaker when it comes to our inflation expectations. The Reserve Bank's expectation for the full year is 3.1, and it looks like it will be on the dot. The 1.6% inflation for the month of July itself is a little higher than the CNBC-TV18 poll of 1.3%, largely because the food inflation is not as low as our panelists expected. I've been discussing the inflation numbers with Devang Shah of Axis AMC and with economists Aditi Nair of ICRA, Madhavi Arora of MK, and Kanika Pasricha of Union Bank. Ladies and Devang, thank you for your time. Aditi, let's start with the nominal GDP number. Because we are having negative WPI numbers, are you likely to have a nominal GDP which will be very close to the real GDP this full year? What's your nominal GDP expectation?
So we're looking, as I said, at a real GDP growth of 6%. That's the baseline that we're working with right now. We're looking at about a 3%, 3 to 3.2% CPI inflation average, and we're actually looking at a 1% WPI inflation average right now. So this tells me that nominal GDP growth is likely to be a little higher than 8%. That's broadly the kind of number we're working with. Now, specifically, if things like, if we have to change our crude oil supplies, and that is something that could push the WPI up a little bit. It may not push up the CPI inflation too much. That is potentially something that can give us a slightly higher nominal GDP number.
Okay. The nominal GDP number which the budget was going with is 9.7%. And even at your 8%, there is a lag. There is a gap that has to be filled. So, Madhavi, will we be faced with a situation where the fiscal deficit number, aside from the fact that we may spend more, aside from the fact that we may earn less taxes because of, potential lower growth expectations that both of you have at 6%, is there a chance that the fiscal deficit will be more than the 4.4% of nominal GDP?
Yeah, Lata, if you keep everything else constant, the slippage could be as high as 0.2% of GDP. Again, assuming that everything else still falls in place. Just the nominal GDP effect would, optically make it look bad. But again, there will be other variables which also will move and could offset. But I'm hoping that the government actually acts countercyclically this time around when things are not going very well for the global economy as well as domestic markets.
Okay. You have a nominal GDP number?
Yeah, we're looking at around 8.4-ish, actually lower. If I adjust if WPI is in line with my expectation, it could actually be lower than 8.4 as well for the year.
Okay. And similar question to you, Kanika?
So I'm at actually around 7.5, 8, Lata, because 1% WPI, 70% weight and nominal GDP in the GDP deflator, 30% is for CPI at 3, so around 7.5, 8.
Okay. Okay. So in which case we are likely to undershoot the budget's expectation of the nominal GDP and therefore a higher fiscal deficit. Devang, any guesses on what the market is looking at now? Are they looking at a higher issuance or is it only a demand problem? What I heard was that probably the government will manage it with higher T-bill, because the T-bill borrowing has been estimated at 0. Maybe they'll borrow through T-bills and not bonds, but what is the bond market working with?
So, see, my perspective is if you look across at today's, actually, it's not that we are all expecting any kind of higher borrowing numbers. I think as you highlighted rightly, I think it is more the demand side perspective, where some bit of real money investors, as well as we had seen a change in HTM guidelines also for banks, which again, banks are not buying in largely a rate cycle is over. They are also not participating in long bonds. So yes, there is a possibility that second half of this year, where they announce the calendar, they might rejig a part of the borrowing and probably borrow less on the long bonds and shift a bit to the treasury bills or the short end of the curve. Curve is also steep today. If you look at the curve, the 5-year GSEC is 620, 25, 30 levels. The 10-year GSEC is at 645, 50 levels. And the 30-year GSEC is at 750. So the curve is already quite steep. So yes, we can see some bit of rejig. If that rejig happens, we might see some bit of relief rally. But structurally, I think large part of the rally is behind us. Definitely, we can intermittently, because there has been a 30 basis sell-off from bottom, we can see some tactical rallies.
Okay. Well, that's well taken that, we may see a rejig in the borrowing program, but the three economists are telling us that the nominal GDP could be a good 1.5 percentage point lower than what the government has estimated. And that might mean an optically higher fiscal deficit this year, even if the government didn't spend more. But chances of a higher expenditure and chances of a lower than expected revenue from taxes are very much on the cards. While it is the CPI inflation number that we are discussing now, all eyes will be on the growth number that will come on August 31st for the first quarter. And more importantly, what are the lead indicators telling us about the festival season demand, the tariff and the growth for the full year? It looks much gloomier than we thought on the growth front, especially on the nominal GDP front. Well, that's keeping the bond market very unhappy. We have to wrap up this special edition of the State of the Economy. On that note, ladies, Aditi, Madhavi and Kanika, thank you very much for joining us. Devang, thank you very much for your market perspective. That's it on this edition. More news and updates lined up for you.
The Supreme Court has ordered that all stray dogs in Delhi NCR be removed from streets and they should be moved to dedicated dog shelters set up by civic authorities within 8 weeks, making it clear that no captured animal will be released back on streets. The court also termed as absurd a provision in animal birth control rules which say that stray dogs picked up from an area should be returned to the same location after sterilization and immunization. The court said that municipal authorities and states should start working on a shelter for 5,000 to 6,000 dogs in the next 6 or 8 weeks. Joining us now to speak about this order is one of India's most authoritative voices on animal rights, an activist, former union minister and BJP leader Maneka Gandhi. Ma'am, thank you very much for joining us to discuss the impact of this order. You know, what's going to be the cost of this exercise? Many animal rights activists have said that this is absolutely untenable, what the Supreme Court has recommended. But even cost-wise, what's the larger implication?
There are 3 lakh dogs in Delhi. So it's not a question of 5,000 and 6,000. It's 300,000. Now, in order to house these 300,000, you will have to have 3,000 shelters. And none of those shelters can be near colonies, rich or poor. So you have to find, the first cost is finding 3,000 pieces of land. The second cost is building on that land. You'll have to have high walls. You have to have kitchen. You have to have a shed for the dogs. You have to have isolation rooms in case they get, one of them develops distemper or parvo. You have to have employ 150,000 people more who will clean the feces and the urine of the dogs 3-4 times a day. You have to have a watchman to see that they don't run out. You have to have vans, about 500 vans, to pick up these 3 lakh dogs. So the total cost would be close to about 15,000 crores. And then the maintenance cost, please remember, is making the drainage system, bijli, pani, and the food. At the moment, the food will cost you about 5 crores a week, which is now being done free by feeders. So these are just the costs alone.
Right. The court has termed the animal control rules of 2001 as absurd. The bench has questioned why these dogs, once relocated, should be returned to the area where they were originally living. Now, what's the danger of this exercise, ma'am?
Yeah, this is the only way that bites will stop. If a dog is picked up from its own area, sterilized and put back, it knows who to be friendly with, it knows where the food is, it has no testosterone left, so it will be calm and placid. And this is, wherever this is happening, whatever colony, there's been no bites. Unfortunately, the MCD and the RWAs themselves are to blame for this. For the last 6 years, they have been relocating animals. Now, when a dog is relocated, he is taken from my colony, put into your colony. He doesn't have any friends there. There are local dogs already. He doesn't know where his food is going to come from. He's being hit by local guards or random passers-by who don't want an extra dog in the colony. He's going to bite. And who will he bite? The most vulnerable of all. He'll bite children, he'll bite old people, he'll bite women. So relocation is possibly the most dangerous thing, which is why I say that this judgment is not a reasoned or a judgment of somebody who's actually studied the problem. It's very easy when you're a judge to just sound off. But it's not something that, does the government have 15,000 crores in Delhi? Can they afford 5 crores a week when there's so many hungry people, when the roads need to be built, when other things need to happen? What is it that you want to prioritize? I will tell you what we prioritize. We prioritize less dogs, no biting, and harmonious living. And in order to reach that, the first step would be to have very, very good ABC centers. Let us compare ourselves to Hyderabad, or best of all, Lucknow. Lucknow has 1 ABC center. Delhi has 20. And that 1 ABC center has, without any fuss, without any tamasha, sterilized the whole of Lucknow. So there are no bite cases that are reported there. What do we have in Delhi? We have 20 centers. And in 20 years, you have never seen a single center. Some of them don't work. Some of them have infrastructure that is falling all over the place. You have no monitoring committees. These are all run by the MCD. And let me tell you a shocking fact. There was a time when every person in the MCD who would retire would be given an ABC center as a parting gift so that he could continue to earn money. This is one. And the second is RWAs. They will call vans at night, pick up the dogs within the gated community who have lived there their whole lives, and go and throw them 20 kilometers away into a slum or a lower middle class area. Now, these dogs are the ones that are biting. This is the only reason for bites, only. If we can stop the relocation and put them back in their own areas, you will not have bites.
Right.
And
so
we
you're
have
saying, ma'am,
this
relocation is the only reason for dog bites?
Yes. Because you've solved the other problems. Before there was biting because a female comes on heat. So the males then become very agitated and they cross their territories and boundaries. And they fight with each other and any human being that comes in the way of the fight. The second is the female has babies and she knows that out of the 6 babies she's had, 5 will die by being hit, starved, run over. So she's very protective from the beginning. But now with sterilization, you take away both these reasons. So then there's only one left.
Right. That's an important point, ma'am. Let me also ask you, what is the middle path, the solution that you see out of all of this? Now, you have a bench led by Justice Pardiwala and Justice Mahadevan, R. Mahadevan, which has given this order that you need to remove all stray dogs and put them in shelters. You have to build a shelter for 5,000 to 6,000 dogs in the next few months. However, this may be...
5,000 or 6,000 make any difference? How will it make any difference? If they're 300,000, 5,000 is what? I mean, I have 8,000 dogs in my shelter, which have come because they're diseased or they're hurt in the Sanjay Gandhi shelter. So what is 5,000?
It's a very small number. It doesn't address the problem.
It doesn't mean anything. It's like the rest of the judgment. It's meaningless. Not only that, a judgment was given by a 2-judge bench several months ago, Justice Maheshwari. And that was a reasoned, sensible order, which said exactly what I'm saying, which is improve the ABC. That is not just the middle path, it's the only path. Improve the sterilization, improve the ABC centers. And within 2 years, we will have no bites and less dogs. As it is, the ABC, no matter how badly it's run, has brought the number of dogs down from 8 lakhs to 3 lakhs. You continue with the ABC. Now, let me explain to you what will happen. We'll pick up these 3 lakh dogs. We'll put them wherever they want to put them. Within 48 hours, 3 lakh dogs will come from Faridabad, Ghaziabad, the villages, Bhawana, wherever, Meerut, who knows? Wherever there is food, all beings gravitate towards food, including you, me, and ants. So what are you going to do with the next 300,000 or the next 300,000 after that? Does it make sense? Instead, sterilize what you have. Let them lead out their lives harmlessly. By then, the garbage situation will control. After all, this is bad garbage that is attracting everybody. This is illegal chicken shops all over the city, which is attracting dogs. If you can show civic sense. And lastly, if you stop the pet shops from selling hundreds and thousands of foreign dogs every week, every month, you will be able to adopt Indian dogs. If you look at the bite ratios, 70% of the bites have been done by pet dogs. So you're not touching those. What Lucknow has done has said you will have to register all your dogs that you own, and the registration will only be done after sterilization. And you will pay, if you have a foreign dog, you pay 500 rupees a year. And if you have an Indian dog, you pay nothing. These are the measures that we need to take in Delhi.
Right. Now, going forward, ma'am, what is the solution that you would have in mind? On one hand, as you've said, there are previous Supreme Court orders, and I'm told even now one of the benches, one of the judges in the Supreme Court is hearing a matter which is giving observations to the tune of the fact that the current rules must be followed. And then you have a judgment which is against the animal birth control rules. So how do we find a way out, a middle path, where we address concerns of families around dog bites and also address the concerns being raised by the Supreme Court?
But I explained it to you. A, make your ABC centers properly. It will take you 3 months to make them first class. Number 2, stop relocation. Number 3, close down pet shops from selling foreign dogs so that there are not more bites from pet dogs which are owned. Number 4, give respect to the feeders and create feeding spaces so that people don't object to saying, don't feed here, don't feed there. Give them cards. We have a 14-point program which has been studied over many, many months. This was presented to the minister on Friday and to the standing committee of the MCD. Both of them liked the program and said it could be done. But unfortunately, on Monday or yesterday comes this strange judgment. You see, let me give you some of the fallout. You have a problem with monkeys. The minute you remove dogs, the monkeys will come down. Then you'll have to eliminate that species as well. The police say that when they are in training, one of the ways that they are taught to recognize a robbery in the making or a heinous crime in the making is when in that gully dogs are poisoned, leaving the gully vulnerable to a gang that comes in at night. So you are going to have a crime wave after this with no dogs as protectors, nobody making a noise in the gully. How will you be able to deal with that? I'm saying the fallouts are huge. A lot of women who live alone keep dogs. Are you going to remove those as well?
That's a very important point, ma'am. Now, going forward, I would also like to ask you now, the Delhi government has had 24 years to implement the sterilization programs and implement ABC rules. Why do you think this has not been done?
As I told you before, it's a hub of corruption. They give it to their own people. Most of them are not recognized. They have nothing to do with dogs or animal welfare. The ABC itself is in a shambles. But now that, we have presented this for the first time, any government called us to ask our views. Otherwise, it was just MCD handing out tofas in the form of these industries. Now, if they would sterilize one dog, they would write 10 dogs and take the money for 10 dogs. Now, all this has been collated by us. There is enough proof of that. And that is what we took to the government, saying, for God's sake, you want this situation to become better, make the ABC centers properly, professionally, and honestly. Within 2 years, the problem will go away.
Right. Thank you so much, ma'am. Any final thoughts that you would like to leave us with? There is a lot of outrage around this order. Yes, from animal activists, and rightly so, who are saying that there are previous rules in existence. You need to implement them better. Then you have a set of people who feel that this order is absolutely right and these dogs need to be removed and not brought back. They're concerned about rabies and animal bites. So what would be your message to them, saying that we're worried about sending our children out on the streets?
I'm equally concerned, Beta. If this particular judgment could deal with the problem in a humane fashion, I would be the first person to say that. We all have children. I have grandchildren. And I think that, yes, they're right to be concerned. But the point is, what do we want? We want the same as them. We want less dogs, no biting. And this is not the way to do it because, as I said before, you remove those 3 lakh dogs, within 48 hours, you'll get 3 lakh more. And those 3 lakh will be unsterilized, unlike the 2.5 that are sterilized now. And they will bite 10 times more. So this is not the solution. So people who would be happy that the dogs are going to be taken and locked up, unfortunately, their happiness will last 48 hours. And then they will be faced with the next 300,000 dogs. And then what do? We need a more sustained a more sustained way. And one, we must recognize that we're all on the same side. It's not animal welfare people against people. You know, I run orphanages for children myself. And for me, all beings are important.
Yeah, that's a very important point to end on, ma'am, because it is important to send out a message to everyone that we're all on the same page and you have to deal with this problem scientifically at the end of the day. Thank you once again for being with us here on News Center. Welcome back. You're watching News Center with me, Parikshit Luthra. We continue our focus on the Supreme Court order with regard to relocation of stray dogs, asking the municipal corporations to remove the dogs from the streets, take them to shelters, build shelters for at least 5,000 to 6,000 dogs over the next few months. Experts and activists have called this order absolutely impractical, saying that it cannot be implemented, and the ABC, or Animal Rules of 2001, must be implemented to the T. Let me go across to Robin Singh, founder People Farm, who's joining us right now. Robin, could you give us a sense of what's the best way forward now?
See, I think we need to address the problem, but not in this way. The problem's not dogs. The problem is few aggressive dogs, who have behavioral issues, and those are the dogs for which we need a policy, and then we need infrastructure to back that policy. For example, we might need a vet to say, okay, this is an aggressive dog, and this is the dog we need to move to a pound or to a shelter. But it doesn't make sense that because of few dogs, we try to address every dog and then we fail because we simply don't have the manpower or infrastructure to do that.
Right. What's going to be the fallout of this Supreme Court order? Because the municipal corporations, the state governments will now get into action because they have to follow the Supreme Court's directive.
I think what's going to happen is, like, they're going to try to do this haphazardly. Some of the dogs will get relocated. Some of the dogs are going to get killed. And the scheme will fail because, like I said, we don't have enough people. If we had enough people to be able to catch and shift lakhs of dogs, we would have been able to vaccinate and sterilize the dog population. And the problem is going to get worse because all the dogs which are going to be moved will be replaced by dogs from surrounding areas which are not going to be vaccinated, which are not going to be sterilized, and the population will increase. And this will be unvaccinated dogs. And this time, the feeders or the caretakers in colonies will be discouraged to feed dogs, get friendly with them, and try to get them vaccinated and sterilized because they have been villainized along with the dogs.
Right. Now, as far as the ABC rules are concerned, the animal breeding rules, they're very clear. But now the court has said that they're absurd. You cannot just depend on sterilization, immunization. You have to make sure that the dogs don't return to their original habitat. Do you feel that this is going to create a lot of complications because the entire Animals Act will now be under doubt?
See, those ABC rules are science-backed. If you're able to sterilize 70% of the population on a regular basis, you can manage the population, you can control it. But time and again, it has been proved, like if you relocate dogs, which is, if you're taking a dog from the street, putting the dog in the shelter, not returning them back to the street, I mean, you are relocating them, you're creating vacuum. Another dog's gonna take that place. If you cull dogs, if you kill them, same thing happens. So time and again, it has been shown that that doesn't work. The only scientific way is to sterilize dogs and return them in their place so they don't, and that's how you manage the population. So the thing that has been working, that's going to break and the problem's going to get severe and that's going to have more health complications. That's going to have more man-animal conflict.
All right. Thank you very much, Robin, for joining us in the program with your views. This is definitely a disturbing issue which has really concerned a lot of people, a lot of animal activists. We have to find a way out. Let's see what happens in the Supreme Court.
Hoping that, we can all come to our senses and do something that's going to improve things and not make them worse.
All right. Thanks, Robin, for joining us. That's all we have time for on News Center. Goodbye and thanks for watching.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, India's festive season is almost here. Retailers selling jewelry and other gold and silver items are hoping for demand to pick up during this period. For consumers buying silver, there's a new way to verify the authenticity. The Bureau of Indian Standards will begin applying hallmarking to silver jewelry using the Hallmark Unique Identification System from 1st of September, aligning with protocols already used for gold. While the hallmarking still remains voluntary, the marking system is changed. The old system of 4 marks will be allowed only until 31st of August. The new system of marking comprises a unique 6-digit alphanumeric code stamped on each piece, enabling consumers and authorities to verify authenticity. Joining us to discuss this and, of course, the festive demand is Mr. Krishna B. Goel. He's convener Silver Jewelry Panel at Gems and Jewelry Export Promotion Council. Mr. Goel, hi, thank you so much for joining in. First of all, it clearly has been a demand from the silver industry and consumers as well for hallmarking. Now, we have HUID here, but that's not mandatory yet. From 1st of September, what changes? And also, how are you looking at this getting mandatory? I do understand there's a lot of infrastructure that is being created at this point.
See, basically, whenever the regulations of mandatory hallmarking are introduced, the market gets more organized, the consumers' confidence is increased, So this certainly brings positive change in the market. And I foresee that the demand after the hallmarking, mandatory hallmarking, will increase many folds in the country.
Mr. Goel, would you say that when compared to gold, silver is way too fragmented? There are way too many silver pieces. It would take some time before we get to mandatory.
Yes, it will take some time. There are many, you see, whenever we go for a change, there are challenges that the industry and the society have to face. So obviously, I mean, even when the gold, hallmarking gold was introduced, it took some time before that it came into the streamline, So of course, in silver, the numbers of pieces are very huge. And of course, I mean, while introducing the mandatory hallmarking, for example, in gold, under 2-gram pieces are not mandatory to be hallmarked. Same way in silver, the range will be a little higher. So, of course, that will help us mitigating those challenges.
Mr. Goel, also, what is your sense on the prices from here on? I mean, gold and silver prices is something that everybody believes is going to be much higher from here. Silver in the near term has outperformed gold. Do you see silver prices continue stronger?
You see, basically, silver is new gold. And if we see that the prices are regularly rising, and I foresee because the industrial demand is very high, the consumption in other industries is very high for the silver. So the prices, I foresee that they will go very high.
All right. You're not giving me a number here, Mr. Goel, but what also is your sense on this festival season? Because the first half of 2025 wasn't so great in sense of jewelry retail demand. Is second half going to make up for it?
You see, with where the gold prices are today, the preference and consumer preferences are going towards silver. So we have seen a hike in silver demand already. And then other than that, today the destination weddings are giving a new opportunity for silver jewelry manufacturers. Because while going for the destination weddings, the consumers do not want to carry a lot of their precious jewelry. So they are looking for the replicas. So in fact, there is a big shift in terms of designs and in terms of demand. And this trend is going to continue in future as well.
Not just replicas, Mr. Goel. I was talking to somebody and they said silver and diamond seems to be working together as well now.
Today, with lab-grown diamonds being introduced to the market, we really see a lot of jewelry on silver with diamonds. even if you look at our history, the jewelry which was made 50, 60 years back, that was majorly it was with silver and diamonds. Because when I started this business and we entered into diamond jewelry, all the jewelry which was coming for remaking, that was the base metal was silver with diamonds. So I think, as we say that it's a rotating wheel, so we are going back to the olden days.
All right. Mr. Goyal, also, when you look at silver buying in the Indian markets, is jewelry really doing the best, or do you think investment demand seems to be picking up in sense of bars and coins, or the gifting market is picking up?
You see, gifting market is very promising, and today everybody is looking for some or other innovative products to gift. So that is one segment where I think a lot of focus will come. And as far as jewelry market is concerned, it is growing. I mean, of course, the investment demand is also there, but the jewelry market is equally growing because, as I told you, the destination weddings, all the modern elites, working women have that need to change their jewelry every day. The looks are different, the designs are different for the different category of consumer, but this segment is growing rapidly.
Mr. Goyal, I have one more number to ask you of. What is your sense then in sense of buying for the next 3 or 4 months in sense of percentage increase? Because this is the time when you have all the festivals coming in until Diwali, and then the wedding season begins as well. With the kind of imports that we've seen into the country and the kind of inventories that jewelers as a segment hold, what is your sense on the overall demand now that's going to go ahead?
Well, you see, now we are approaching towards the festive seasons. At Diwali, we have tradition of gifting. A lot of gifting takes place. We have tradition of buying jewelry or the coins for our own homes and for the prayers, the puja, and all those things. So the demand is going to increase in the next 3 months. I see that we all will see better number than last year's.
All right, better numbers than last year when it comes to silver as a place. Mr. Goyal, thank you so much for joining in and giving us a very, very strong sense on what really silver means going forward. From here, the hallmarking, of course, will help this industry get organized. And as far as categories go in sense of silver, whether it is about jewelry, investment, gifting, all of that seems to be doing quite well as well. But when it's about the festival season, it also is about gold buying, which comprises of 88% of the jewelry purchases by Indians, while gemstones make just about 2%, even as their prices are less volatile. But can this trend change over the next few years? To discuss that, we are now joined by Abhishek Sandhi, co-founder and director at Savio Jewelry. Abhishek, hi, good to have you. And I do understand that we are predominantly a gold buying market. Silver seems to be doing quite well. Diamond is making a strong penetration here as well. But when it comes to gemstones, it's a very strong, smaller number though, holding steady. Are you looking at more people buying, understanding, getting aware by gemstones?
Well, gemstone is the new gold. See, after gold and silver, gemstone is the new gold.
Mr. Goyal said silver is the new gold.
I'm telling you, gemstone is the new gold because see, if there is a shakiness between the diamonds, the best gap is being filled by the gemstones. And the gemstone has no replica. The design that you make in jewelry, if you see any piece around the world, what identical difference that you create in every piece is contributed by the gemstone. So every gemstone that you buy differs from the previous one. And that is the designing element, the creativity, and the possession happiness that a customer has after buying gemstones. So gemstone is going rapidly, and you see emerald, ruby, blue sapphire. It was all about semi-precious and semi-precious. It's all gone. You'll see kunzite, tanzanite, kyanites, any stone and every stone studded in jewelry and selling around the world.
Abhishek, what would you say is the demand growth then when it comes to the Indian markets? The base is, of course, low, but what is the growth that you're seeing?
So see, already there is a different HSN code if you talk about the colorstone gemstone jewelry, which is rising every single time, because it's not just the domestic market, markets like America, Europe, everyone is now keen on gemstone jewelry. If you just go on Google and type Tiffany, Cartier, Bulgari, Van Cleef, any brand, just name it, and the front page will be of gemstone jewelry. So they are getting the high affluent class customers in the form of gemstone jewelry buyers. And the trend is going upwards. They're getting great response in the gemstone jewelry. So by gemstone, I just don't want to say that it's only gemstone. It's with diamonds, but yes, the main accent part, the attraction part is gemstone. So just imagine a 100-carat emerald sitting in the center of the neck piece. I mean, you'll be the party rocker, and that is what the trend is right now. Gemstones are rocking.
All right, 100 carats is still some time to come. But when you compare gemstones with diamonds and Indians, I do understand that all the major weddings that have happened in India have been about colored gemstones. That clearly seems to be making inroads right now. But would you say it still is a very tier 1, not even tier 2 or tier 3 story when it comes about gemstones? Or do you see awareness and aspirations beginning to show in numbers?
Now, that is a very intelligent question, because India is very popular in the places like, Mumbai, Delhi, and all these metros. But the gemstone is making way to the tier 2, 3, and even tier 4 cities. Now, this is the role point, because when a consumer is searching mobile or taking a mobile and seeing various brands, they're just coming across with the images, or all the big fat weddings where they get inspired by jewelry. They're all seeing gemstone jewelry. Now, even the tier 2, 3 city have a great mobile access and internet access. And that is helping in the gemstone sale overall. So jewelry set with gemstones is even rising in the sale point and figures of tier 2 and tier 3 cities also within India, and not just in India, around the world, in the remotest of the locations, with the help of internet and the glamour that the gemstone brings in. It is penetrating inside the non-metro and non-big cities as well.
Abhishek, lend it on some numbers then. And what is the overall market that you see of gemstone? If there is a percentage point that you could put in sense of India's demand growth, what is that? And how are the gemstone prices doing right now? Because diamond prices in last 2 years have been very volatile.
So this year we're expecting nearly doubling of the gemstone figures, because the gemstone loose was a great consumption, but gemstone as a jewelry is rising very good. And even the HSN code is on the rising curve of the gemstone jewelry. And yes, we might see a greater surprise than that as well. It can double this year.
Abhishek, also, what about the prices? Are they equally volatile like diamonds? Have they been holding firm? Have they been growing?
So as it is all rare and natural and all mined gemstones, so it is getting into scarcity. And you'll see emerald, rubies, blue sapphire, kunzite, kyanites, tanzanites, all these gemstones are all mined. So the rarity and the availability is shrinking every year. So the prices are rising up. You'll see fine gemstones rising in the price around 30% as well in a particular year. So anything that you have bought last year, say a 20-carat emerald or Russian emerald, and then you can expect a 30% rise in the resale value today of gemstone.
Abhishek, when you look at natural diamonds, it is said that 80% of that comes in from institutions. So it is more organized as a market. But when you look at gemstones, the number falls to perhaps a 50%. It's a 50-50 in sense of organized and not. Is that improving?
So, as far as pricing is concerned in the gemstone, like for diamonds, we have a Rappaport, we have a standardization, and by which any piece around the world, if you have, you can get the price through Rappaport. But with gemstones, it is not so. And we have to find the reason. The reason is that every gemstone cannot be categorized because it has a very unique and identical feature of that gemstone itself. So the pricing standardization becomes a very big problem. The unorganized and organized sector, because now the governments around the world and in India are growing towards the organized sector. So yes, the figures will rise because the market is already big of gemstone, but it's not in the organized sector. But right now, if you see the trend is moving towards the organized sector, you'll see the biggest player of the retail segments. Even Aditya Birla has joined the jewelry sector. Tanishq doing well. It was not there like 7 or 10 years back. But today, people want to buy in an organized sector. They want to buy from the organized sector. So that is one of the biggest reasons that this gemstone jewelry and gemstone segment is also getting organized and growing better. So that is the only way how the figures grows up. And we can actually assess how much the growth is there in the gemstone jewelry business. So yes, the figures are rising and it's moving towards the organized sector.
I'll wind down this conversation with one more question, Abhishek, and this one is on your expectation on what you are expecting from this festival season now. Well, the gold guys have spoken, so have the silver guys and jewelry and diamonds and studded. But what is the sense from the gemstones?
See, every gemstone guy I have met, they have stocked in like crazy. They have bought their maximum capacity, even 40 to 50% higher. They are seeking this Diwali to be one of the best because the people who were buying maybe some big solitaires are still maybe waiting for a while. But yes, they are not waiting for the gemstone. They are buying gemstones like crazy. And this Diwali, diamonds are shining, gold is shining, silver is shining. But the best shine will be of gemstones, mark my word.
All right. Abhishek San, thank you so much for joining in and making in sense of a gemstone as a segment, which really seems to be growing quite strong. As said, it's 2% of a penetration for the Indian markets, but growing at a 40 to 50% of a space and clearly catching everybody's eye. So colored gemstones clearly seems to be the flavor in this festival. But with that, let's stop for a very short breather. On the other side, we will be taking all the sense of the sugar markets, because that's yet another thing that the consumption will increase during the festival markets. What is the maths and numbers? We'll tell you. Welcome back, and you're with us at Commodity Champions, and we're talking about sugar now, because when you talk about festivals, you also talk mithais, and food and beverages, eating out just about increases. So what is the calculation that India has in sense of sugar consumption? For that conversation, let's get in Mr. Deepak Balani. He's DG ISMA. Mr. Balani, hi, thank you so much for joining in. We're talking about festivals today and the kind of consumption that sugar can see during the next 3 or 4 months until Diwali and beyond. What is it that you're looking at in sense of numbers, and would you say India stands in a comfortable position as of now?
Thank you, Manisha. Thank you for having me on your show. As we all know, the festival season has started. But if you see the trend of the entire year, the consumption seems to be quite on the lower side if you compare with the last year. with whatever quota has been released and the GST dispatches till July end, looks like that we will be closing the consumption at around 279 or 280 lakh tons by 30th of September. Having said that, the ex-mill prices are quite stable for quite some time. The UP is hovering around 40.5, while Maharashtra is around 38, 39 rupees. And the cost of production of sugar is almost 40 rupees. And if you look at the retail prices where it is directly linked to the consumer, the retail prices at the moment of sugar is around 45.9, which is much lower. If you see the growth, the inflation in the sugar prices is almost negligible if you compare to other commodity prices. And going forward, looking at the demand and looking at the festivals, I don't see the retail prices going up. I think perhaps since we have sufficient sugar stock in the country, and with all the likelihood, we will be closing the sugar season with almost 52 to 53 lakh tons. The prices are expected to remain stable.
Mr. Balani, I want your attention at the USDA report that came in a few weeks ago, which says that while the global sugar average increase is 1%, India, they expect at around nearly 2% at 30 million tons, which you say the Indian sugar consumption is much lower at. And as you said, we're looking at a reverse sugar demand here. We're eating less sugar. So would you say it's not keeping pace, one, with the lifestyle, second, with the population increase as well when it comes to India?
See, I don't believe that our sugar consumption is actually going down. This year, there has been a disruption, not because maybe the sugar consumption has gone down, perhaps last year because of the elections and also some leakages across the border. I believe the consumption was phenomenally down from 290 to around 280. But going forward, I feel although in tier 1 cities, the metro cities, people have become more conscious and perhaps moderating the consumption of sugar. But the tier 2 cities and also the rural areas where we are seeing the increase of the packaged food. So I believe the sugar will still continue to grow at the rate of around 1.52% going forward.
Well, absolutely. Packaged food is what I'm really talking about. Mithai is something that we'll see in festival season, Mr. Balani. But apart from that, ice creams and food and beverages and hospitality, with the way people are eating out more, eating more packaged food as well, 1 to 1.5% is something that we've been seeing all these years as well. Would you see any movement there, or you think this is the new trend now?
No, I think it is going to have a very similar trend as in the past year. While the sugar consumption may be stagnating in tier 1 cities, as I said, it would be compensated by slightly increase in the sugar consumption by way of packaged food in tier 2 and tier 3 cities. So, and 60 to 65% of the sugar sales is to the institutional buyers, to the bulk consumers. So I believe this would keep a slow pace. As you know, our per capita consumption is still very low if you compare to the world average. So I think 1.5% should be the consumption increase which we may look at going forward.
Mr. Balani, do share the per capita consumption numbers that you have, because we've been reading so many numbers and then there are just so many influencers and data that gets thrown at us. What is ISMA's number when you look at per capita consumption in India?
So we, at the moment, in the last interactions, I had actually told you that we have hired a very renowned agency to do a complete sugar consumption study. And that study is almost complete. I think another 15 days, we will be able to give you a complete detail on what is the trend, which sector seems to be growing, what is our actual consumption, and going forward, what may perhaps we look at the institutional segment as well as the retail segment in terms of sugar consumption is concerned. So maybe another 15, 20 days, we can have another interaction on specifically our outcome of the study of sugar consumption.
We are willing to wait another 15, 20 days, Mr. Balani. I know you've had to deal with a lot of things. One, exports, then ethanol, and then, of course, whether or not sugar is harmful for Indians. And now you're talking about what is the per capita consumption. So I'm assuming, yes, you've been quite busy looking at all of those surveys and studies that you're getting done. But what also are you looking at in sense of the overall crop this time around? Because 25-26 also is a year when we are looking at higher sugar production. How do you see India consuming all of that number?
See, on 31st of July, ISMA came up with its first estimate based on our satellite images, based on our crop assessment. And we have estimated around 349 lakh tons of gross sugar production with an upward bias. Why I'm mentioning an upward bias is primarily because that the current estimate is based on the kind of rains which we are having and the health of the crop. Going forward, if we continue to get good rains and if the trend continues, then we might actually have a better production beyond 34.9 million tons. So that is why we have decided this time that ISMA will come up with its second estimate in September after doing a reassessment of the crop and also taking a fresh satellite images. Having said, even if we considered a gross production of 349 lakh tons and sugar consumption of almost 284 to 85 lakh tons this year, we are looking at least 50 lakh tons as a diversion to ethanol, because that is something which is very, very important. Otherwise, we will have a sugar glut in the country, putting a lot of pressure on the domestic prices, then leading to a lot of problems of the viability of the mills. So we are at least looking at 50 lakh tons as a diversion, but subject to the price revision. As you know, the price revision of ethanol has not been done for last 2 years, but this time we are expecting the government to make sure that the price of ethanol is in line with the increase of the FRP. And also, after the ethanol diversion, we are looking at least export of 20 lakh tons. And that is how I think we will be able to create a balance and equilibrium in the industry, ensuring a viable price for the millers and also the timely cane payment of the farmers.
Mr. Balani, I've underlined on what you said that 50 lakh is going to ethanol diversion. If you get a price revision, what is the possibility of that? Because we've been seeing that, talking that for the last couple of years now.
I know it is, we had a very good program going on because of the government's policy and because of the vision of our Honorable Prime Minister. I understand that last 2 years there has not been revision, but I believe with the increased FRP again, which is now 355 rupees per quintal, and my cost of production is almost 5 to 6 rupees more than the current cost of ethanol, I believe government will definitely consider the increase this time.
All right, Mr. Balani, thank you so much for joining in. Well, sugar consumption is expected to be quite stable this time around, 1 to 1.5% of an increase. But, well, there's lots happening with sugar as an industry right now, whether it is about production, exports, and, of course, ethanol. That is the most important story to watch out for as well. But for now, thank you, Mr. Balani, so much for joining us here at Commodity Champions. Thank you, viewers, as well. That's all the time that we have today. Thank you.
headline number, as expected, up 0.2 exactly. Strip out food and energy, up 0.3 exactly as expected. Year-over-year numbers, 2.7, that's the headline. That's 0.1 cooler than we were expecting.
Well, some of your most favorite ice cream brands, whether it's Cornetto, Magnum or Quality Walls, are set to get a new home under a new company, Quality Walls India. This, as Hindustan Unilever, India's largest FMCG company, is demerging its ice cream business into a standalone listed entity, hopefully by the end of next financial year. Now, what does this demerger entail? What is the rationale behind that? And what is this cool business going to entail? We are joined by Ritesh Tiwari, the CFO of HUL, to talk to Mangalam and me, not just about the ice cream business, but also about HUL, the strategic reset that's happening here, and the new management that's coming in. Well, Mr. Tiwari, thank you so much for speaking to CNBC-TV18. Let's start off by talking about the reason we're here, which is to talk about the ice cream demerger. Quickly run us through the very basic details of the demerger. What is the, what is Quality Walls India going to entail as a corporate entity, as a company? And what's been the basic rationale behind the demerger?
So ice cream overall has a very distinct business model. It runs in cold change in terms of manufacturing, distribution. It is prone to seasonality more compared to any other business that we have. It also has higher capital intensity compared to other business that we have. This is what makes ice cream very different to the rest of the business. At HUL, it has low synergies because of this very reason with all other categories that we end up doing business with. So that was one reason why we said that we need to have a solution which is very different. So hence, if ice cream is run with a focused management, with different agile strategies which are suited to its own distinctive business model, it can unlock more growth going forward. The decision was that once Unilever globally decided that they will separate the ice cream business and they will end up listing it, we had to, as HUL, take a decision, what do we do with it? The board came to conclusion after a lot of discussion that it is in best interest to separate the business in India as well, and then form a separate company, demerge it, and then list it. Right. This will ensure that all shareholders will be able to participate in the growth story of ice cream in India.
Right. So if you could give us a sense, as delicious as the business idea and the potential and the product sound, it's a very tough business as well, because supply chains, the capital that it requires for you to have a cold chain across the country, etc. If you could give us basic numbers on the ice cream business, it's about 2 to 3% of your revenue right now. What kind of EBITDA margins does it make? What kind of capital is invested in the ice cream business?
Yeah. So ice cream is roughly for us an 1,800 crore business, and it makes, if I look at last few years of margin, it makes low single-digit margin. This is a business now which is in investment phase. We are a national player. We supply ice cream across the length and breadth of the country. And when you do that, the overall cost of running the business is high, which is why a business like this gets a lot of benefit when it starts to scale up. Our business for the last 1 decade has grown in double digit. And going forward, given the headroom which is there to grow of penetration consumption, we expect this growth trajectory to get even stronger going forward. And which is why today, when the business operates at a low single-digit margin on an average, we will get into an investment phase further. So margins will further go a little bit down. But from there onwards, as the operating leverage kicks in, we'll then start seeing acceleration of margin in times to come.
So if you could give us a sense of the capital that has been invested in this business already, because it's housed in Hindustan Unilever right now, I'm sure there are a lot of operational synergies that come by as well, which may not come once it's demerged. So what are the kind of investments that you entail out there? How low can the ROCEs go before they go up, and what are they right now?
Yeah. So the key criteria there is the amount of capex investment. So for a typical FMCG company, let me say Hindustan Lever example, we spend approximately a little less than 2% of our turnover into capital, in capex. Ice cream business operates anywhere from 5 to 7%. Of course, there are years we'll earn a little more, a little less, but it operates at 5 to 7% capital investment. The point there is you have to further add capacity because of the growth which is happening in the business, and plus the distribution network which you have to set up.
You spoke about low single-digit margins is what you see right now, and then after the investment phase, I think your listed peers does about 5 to 7%, if I'm not wrong. Is that where you would look to get at eventually, or do you think post-investment phase there is scope to expand margins further beyond that?
So if I take margin and make two different components of that, material margin, which is your sales minus all the raw material variable cost, and there's a fixed cost which gets amortized as part of the cost to the entire business. When it comes to material margin, we make industry leading margins. When it comes to total margin, when you add variable cost plus fixed cost, our margins are lower compared to the benchmark that you quoted. And the reason for that is because we are a national player, and hence our infrastructure is spread. As you start getting more amount of scale further in the business, you start getting operating leverage. So the second component today where we are, let me say, under index compared to market, we'll start getting that component also getting counted in terms of improvement in margin. And once that starts to kick in with further amount of growth and scale, we should be able to reach high single-digit margins.
Right, that's very interesting because, you know, the variable cost that there is, you said, is industry-leading already. The fixed cost currently is also shared by the large Unilever, platform. So just trying to figure out if it is individual, then maybe the denominator would be a lot smaller, and as a result of which it will be amortized a lot more.
So ice cream has a separate distinctive business model. So the entire fixed cost for ice cream is ice cream specific.
Got it.
So when I was quoting the example of a fixed cost, this is all ice cream assets. Because ice cream has separate factories, it has separate distribution system, the ice cream cabinet which are in the marketplace that we end up owning either directly or indirectly. I was referring to all this infrastructure which is all ice cream specific. In fact, the synergy with the rest of the business is very limited, especially when it comes to go-to-market. Our sales force, it has a separate sales force on its own. So there is no dis-synergy, let me say, on such operating costs of supply chain that will happen after the demerger.
And what happens to HUL's overall margins, because our ice cream is fairly margin dilutive, and what happens to HUL's own ROC? How much improvement do you see there?
Yeah, so ice cream overall is 3% of turnover. It's 1% of our profit. So there'll be small improvement in our ROC and margin after the demerger, but it is small and immaterial, I would say.
Right. And you know, ice cream as a business, though you spoke about the large scope of growth that there is, it is still seasonal in nature.
Right.
And I think you have spoken in the past, and you've been one of the players that's spoken about how you're looking at de-seasonalizing the business. So how do we look at that? Because if an investor is looking to invest in a company, they would want to be able to reap profits or returns through the year. It cannot be in one season. So how are you looking at de-seasonalizing this? And even globally, in fact, for Unilever, ice cream, a lot of investors have been talking about how ice cream is a business there, the consumption is actually coming down. Is India an outlier in that sense? Is the scope actually a lot more here?
Yeah. So two, three different angles to this. To start with, our key strategy has always been for the last few years, how can we start de-seasonalizing the business? Yes. Now, ice cream can be seen as a dessert, and hence it plays a role in the entire post-meal sweet category. It also has a role as a snacking category. And once you start looking at it a little differently like that, you start seeing that there are many occasions more where ice cream can be center of the plate. So at Diwali season today, for example, we have our own variant which has gulab jamun into it, and we end up marketing that at length during Diwali season. For each when Pujo happens, we have Nolan Gur ice cream. So we have now launched flavors which are relevant during festival season to start to ensure we keep de-seasonalizing. I was quoting an example to you earlier. A US market is much more colder than what India is. Yeah. The per capita consumption there is 13 litre, and we have 600 ml. So the headroom that we have for growing is substantial. And which is why for the last 1 decade, the industry has grown at double digit. Our own business as Hindustan Unilever for quality walls has grown in double digit. And once you're able to focus differently and more going forward, we could end up seeing stronger double-digit growth from the business.
Could you give us a sense of how your sales have panned out across the year over the last many years since you've started to de-seasonalize it? Earlier it was obviously Q1, Q4, and now if you could give us that split. Earlier what it was and post your de-seasonalizing it, or your efforts, how much has it moved?
Yeah, so it's always a gradual move. It will never have a substantial impact. But we keep seeing 100 to 200 BPS move that keeps happening from season to non-season ice cream with every year of effort that we end up making.
So what's the current split right now?
So roughly I would say little less than half the business ends up happening during the peak of the season, and then the balance business is spread across the balance quarters in the year.
How do you see competition? Because, while you're number 2, we have another very large national player, but we're seeing a lot of the smaller new age D2C brands also that are coming in. A lot of money being pumped in by VC investors also into those companies. A lot of focus on health, low calorie, low sugar ice creams, and they're really taking off, especially thanks to quick commerce. So how are you looking at the competitive scenario? And does that then now, with Quality Walls India also having its own business, its own focus, does that also open up avenues for M&A?
So I quoted one of the statistics earlier. So we have our own direct or indirect 2.5 lakh freezer cabinet. As an industry of ice cream, we have a little more than 1 million cabinet out of the 12 million outlets which are in the country. So more players start to participate and help support and increase the distribution infrastructure. Every player in the market will end up benefiting from that. Given the per capita consumption is so low this point in time, there's enough headroom for multiple players to coexist. Ice cream is a business which also has much higher amount of innovation compared to typical FMCG business. What we have done, we focus squarely on innovation for last several years. And as and when required and relevant, we keep getting also brands from the stable of Unilever into India. Going forward, same thing will happen with the Magnum Ice Cream Company, which will ultimately be the owners or majority shareholders of the business in India. We will end up having access to the biggest global ice cream company, the brands from them, the tech from them, R&D from them. So innovation will continue to be exciting. That's what will determine the growth trajectory and competitiveness of the business.
Do you have to pay a royalty to the Magnum ice cream? And
so today as HUL, we have a royalty contract, which is for all the categories that we deal with in Unilever. And once ice cream gets separated, our current contract runs till January 28. So we're going to pass on the royalty contract, which is all three components. It is component for the brand trademark. The brands that we have in India today, Quality Walls, Magnum, Cornetto, these brand trademarks are owned by Unilever. So the access and license to these trademarks will be passed on to Quality Walls India Limited under the same arrangement, existing arrangement that we have. Today, the R&D is a shared R&D across Unilever globally, and which is why as part of the royalty contract, we also have a royalty contract on technical services that will also get benefited. The Quality Walls India Limited will continue to have access of that as well. And third, importantly, going forward, the innovation and trends, so those benefits will be there for the ice cream business as well. After the demerger is completed in India.
Good evening, ladies and gentlemen. It's an absolute pleasure to be here this evening in conversation with the incredible India man himself, Mr. Amitabh Kant. I'm not going to bore you with statistics on where India's tourism sector lies and what's happening with industry. You're best placed to know those numbers, and I'm sure that you know them much better than I do. But what I do want to talk to Mr. Kant about is what we're seeing happen in the world today and its implications and its impact for sectors like tourism, specifically for an economy like India as well. We are in a state of geopolitical flux. There is volatility undeniably. And what does all of that mean for India, for its economy and for its tourism sector? Mr. Kant, without further ado, while it doesn't directly impact India's tourism sector, there is a mood, there is confidence. All of those things are important contributors to the consumptive capacity, to the consumptive power of an economy. As you look at the volatility that we're seeing in the world today, as you look at the geopolitical dynamics that are playing out, we're talking about incredible India from a tourism perspective. How incredible is India from a global viewpoint when we talk about tourism today?
So Shireen, let me say that, the world is in a state of flux. India is being tested. But every crisis is also an opportunity, and we should not let this opportunity slip. We should really use this opportunity to galvanize ourselves to bring in radical reforms. And I think it's a once-in-a-generation opportunity to really make ourselves very easy and simple, to bring out radical reforms in all sectors of our economy, make ourselves very competitive, and make India a very key driver of global growth. So this is, to my mind, a massive opportunity for reforms. We should use this opportunity to make our GST very simple, just 2 slabs. We should use this opportunity to simplify our personal tax. We should use this opportunity to remove a lot of quality control orders that we have put in and actually impacted trade liberalization. We should use this opportunity to reduce taxes on inputs and components so that we become an integral part of global value chains. And we should use this opportunity to clean up our cities so that, we become a great travel and tourism destination. And we should use this opportunity to drive tourism simply because there is no other sector to beat Trumpian tariff than travel and tourism. So if India wants to compensate for the 50% tariff, which is envisaged to be put after 20 days, make your tourism grow. It'll more than compensate for the Trumpian tariff. This is the sector. This is a sector which can really, really drive India's growth story in the coming years. Not merely growth story, but this is a sector which can create jobs for India. So growth with jobs will come from travel and tourism.
Well, the big headline there from Amitabh Kant that tourism is the answer to offset the Trumpian tariffs, as he called them. But Mr. Kant, let's talk about that. In 20 days, if nothing changes, then India is going to be hit with a 50% tariff. Now, you talked about competitiveness. Where does that leave India's competitiveness, and what can be done to offset the impact of that tariff? I understand trade diversification. We're also talking to the EU. We're talking to other countries as well at this point in time. But, in the list of priorities, in the order of priorities, what should we focus on to ensure that we don't lose competitiveness once we are hit with those 50% tariffs, if we are hit with those 50% tariffs?
So Shireen, first and foremost, there's lack of what Trump has done is he's brought absolute unpredictability and inconsistency to trade policies across the world.
Yeah.
He did 25% with Canada one day, next day he did 35%. He put tariff on China. Today's administrative order has stayed
a 90-day pause again.
90 days pause. So across the world, for a private sector entrepreneur, he doesn't know where to export from. For a textile exporter, whether he should be exporting from Cambodia, Vietnam, Hong Kong, or India, he doesn't know. It's difficult to work out the tariff rates, and where to invest is even more difficult. So, absolute unpredictability and inconsistency of policy, and I think none of us know the response to what it will be 20 days later. So first and foremost, pharma gets exempted, electronics gets exempted, what gets hit is textiles, seafood, etc., etc. But I am quite hopeful that India should be able to arrive at a win-win situation with the United States at the end of 20 days. These are strong-arm negotiating tactics which are being worked out, as they've been done with many other countries. The only country, actually, if you look at it in terms of negotiation, the only countries which have not buckled under pressure is China
and Brazil.
And
Brazil.
And?
Brazil.
UK?
Well, UK's got a deal.
UK got a very good deal, 10%. Yeah. The only other country, Brazil's got a 50% duty.
Also,
and India. So I think one thing I'm very clear about is that India should not succumb. India should not compromise on its strategic autonomy, because if you compromise now on your strategic autonomy, you'll keep succumbing. And you need to hold firm on this, because you may lose this battle, but you have to win the long-term war. It's very important to win the long-term war. And the long-term war is that 25 years it's taken you to build up a relationship with the United States. It's also important to understand for all of us that the United States is the only country in the world which actually holds 26% of the global GDP, 48% of the market capitalization with 4% of the market share. So it's an important market, but it's there was bipartisan support for India throughout for last 2.5 decades. So I think Trumpian policy for a short while may upset it for a short while, but we must look at winning the war over a long period of time.
Well, speaking of winning the war, Mr. Kant, and I want to go back to your point about you believe this is the opportunity for India to go forward with big-ticket reforms. My first question to you, why do we wait for a crisis to do big-ticket reforms? Everyone's saying that this is like a 1991 moment. Why does India wait for a crisis to reform? Number one, is that a bureaucracy problem? Is it a political will problem? What exactly is the issue there? And two, again, when we talk about what India can do at this point in time, a two-rate structure for GST, I mean, the hotel industry would be very, very happy if that were to happen. But is that practical? Is it feasible? Is it doable?
So it's not that India has not carried out reforms. In the last decade, we were amongst the fragile five From fragile 5, we moved to the top 5 economies. We are now the 4th largest economy and probably will be the 3rd largest economy. We've been able to do it because we introduced GST, IBC, RERA. We did ease of doing business. We did many, many things to be able to, and on top of that, we push for digitization in our economy. We push for a greening of our economy. We push for large-scale infrastructure creation. We are amongst the few countries which have been able to provide houses, water connections, electricity. So a lot of things have happened. It's not. But to manage a country of 1.4 billion people, which is bigger than 24 countries of Europe, and to push for hard-ticket reforms needs some kind of a crisis. I mean, you need crisis to get everybody together, to galvanize. This is a moment for galvanization. This is a moment of a once-in-a-generation opportunity. This is a moment to ensure that you become the most competitive economy in the world. I mean, and that requires a huge amount of reforms. So use this opportunity. Every crisis is an opportunity. Use it to your advantage.
Okay, so in the list of, you've already said GST rationalization, GST rate rationalization is one big ticket item on the pending reform agenda. What would the other top 4 items be?
So provide 20,000 crores to the tourism industry to go and promote and penetrate global markets.
20,000 crores?
20,000 crores. Nothing less than 20,000 crores. This is the sector which will more than compensate for Trumpian tariff across any other sector. Penetrate every single global market with a brand campaign which will get you tourists from across the world. Nothing less than 20,000 crores. For a large country like India, it will transform India, it will transform, you need to do several things. The budget had announced 1 lakh crore for urban revival, for cities to compete for that. We should push for that because you need to clean up your cities, but minimum 20,000 crores for the tourism industry so that you can do the best brand campaign on Incredible India across the world, penetrate every single global markets, get the rich and famous to visit India, attack Trump with travel and tourism.
Attack Trump with travel and tourism. 20,000 crores is what you're asking for. Why haven't we seen a new Make Incredible India campaign, Mr. Kant? You're talking about 20,000 crores for the industry to be able to market the India story globally. Why haven't we seen an Incredible India 2.0 so far?
No, I don't have an answer for all the problems and all the challenges of India. But I really feel that you need, at this moment of time, you need to galvanize yourself to handle this challenge. You need to look at sectors which will drive India's growth story with job creation. So, the World Travel and Tourism Council has said that in travel and tourism industry in India can create 63 million jobs. Which sector can create 63 million jobs? No other sector can create 60, and politicians want growth with jobs. This is the sector which will create jobs for Indians.
The lament, though, from the industry is that even though industry status has been provided for, the reality on the ground is very different. There is no execution after that big ticket announcement. Now, that's where the problem is. The announcement is one thing. The execution roadmap and the deficit therein is the challenge. How do we address that?
So, Shireen, my view is that the tourism industry must go to every single chief minister. The faith must go and actually go to every single chief minister and bring out the significance and importance of this. They should also go to the prime minister and tell him that we are going to give you, for your 20,000 crore spend, we are going to make up for all other sectors as far as this challenge of United States is concerned. And I think they should seek led by Mr. Puneet Chhatwal as the chairman of Faith. They should go and meet Prime Minister directly and give him a 5-page note saying that we'll more than compensate. This is a challenge which the travel and tourism industry takes, subject to 1, 2, 3 things that we want from the government. That's all. And I think everybody is in favor of travel and tourism. Prime Minister has gone on record so many times to actually promote travel and tourism himself. He's a great believer. But the domestic tourism has done its bit. We could handle all this during the COVID period because the domestic tourism took off. But domestic tourism beyond a point will not sustain it in the long haul. You need international tourism to grow and expand. You have the airports. You have now the airlines coming in. When I was a joint secretary in the Ministry of Tourism, we neither had the airlines, we neither had the airport. We launched the Incredible India, which led to a huge upsurge and led to the creation of many airports. But now you have Indigo, you have Air India, you have Emirates, you have many airlines flying in. You have the best of airports. This is the time really to go international in a big way, and in the long run, use this domestic tourism as a springboard for driving international tourism.
You know, you're talking about driving international tourism, Mr. Kant, and I know we've spoken about this previously, and I'm sure this audience has addressed this issue as well. But, you know, when we talk about competitiveness, how do you make Indian tourism competitive? You keep hearing anecdotal stories as well as hard data on how people are willing to go to Vietnam, people are willing to go to Thailand, numbers which you know, are significantly higher than the tourists that India draws. How can India's tourism industry make itself more competitive?
So I don't think we should get into the numbers game, Shireen. I mean, you know, the point is that India is
high-value customers.
So two things. One is that India is a long-haul destination. The people who come to India spend the longest number of days here. The highest number of days spent is in India. Number two is that don't go in for garbage tourism. Go in for high-value tourism. Go in for people who want to come. You know, these are the days of experiential tourism. People want to experience India, its culture, its heritage, its architecture. Go in for people who are willing to spend that money. Don't become the lowest common denominator. That's my view on this. Get people who are going to experience India, travel across India, spend about 20, 21 days across India, and really get a feel for India.
You know, if we are going to be able to draw in the high-value, high-paying customer to India and really experience India for what it is, what do we need to prioritize now, especially when we talk about our cities? I know that you've previously spoken about the need for hygiene, for safety, security, and so on and so forth. You know, this urban renewal plan that you spoke about, this has been something that's been in place and in play for several years now, yet we are seeing civic bodies, civic authorities across our cities fail in keeping our cities safe, secure, as well as clean. What do you believe is the priority at this point in time that civic bodies, along with state governments, need to focus on? And we cannot leave this to the court, as we've just seen in the case of Delhi with the stray dogs issue.
So, you know, I've been a long-term believer that actually there are two sectors which need a massive impetus by both the states and the center. Tourism also needs a massive push by the states because you need to create state brands. You need about 20 state brands. Every state has to understand that tourism is going to create jobs for them, not just Rajasthan and Kerala, but every state of India needs to create the tourism brand, and Incredible India has to be the mother brand. Similarly, on the urban rejuvenation, my belief is that cities are the biggest drivers of growth. They are the biggest cities become the center for innovation. They become the center for all creativity. They become the centers for biggest job creation. And therefore, a huge amount of, focus on urbanization. The municipal standards have to improve. The garbage management has to improve. The segregation of waste has to improve. And, states have to understand that it's not merely the focus on rural India, but urbanization will be the biggest driver of growth in the coming years. The more money you spend on agriculture, actually, 46% of India is already in agriculture. You need to get them out into urban areas to create new quality jobs. That can only happen through urban. So the budget had a very good scheme. 1 lakh crore for urban rejuvenation, create competition. I think we need to get that implemented ASAP.
You know, public-private partnerships, specifically as far as this sector is concerned, and we saw some ideas being presented in the budget. What do you believe could be the viable way of creating a public-private partnership model that works in furthering the cause of creating India as the new tourist destination?
So first and foremost, I'm a great believer that government must get out of many areas, because countries which have grown and prospered are those where free enterprise has grown. you know, government in India is in too many areas. If you look at state government especially, they run businesses, they run hotels, they run motels. I mean, it's all substandard. They run to poor balance sheet, they mismanaged. So all government must get out of all tourism related activity, hotels, etc. Allow the private sector to run them. You know, from arrival to departure, it's all private sector and tourism. But yet state governments believe in running hotels. I mean, even in a progressive state like Kerala, there's a Kerala Tourism Development Corporation which runs hotels, and the best hotels. It should all be driven, and it has a terrible balance sheet, the best location. It should all be driven by the private sector, to my mind. And so I'm a great believer that get out of businesses, allow private sector to drive it, allow private sector to flourish. That's the way. So Kerala, we actually sold 6 hotels to, we gave 6 hotels to Taj in a joint venture. And Taj's Taj Hotels line used to be that in every state of India, Taj has 1 hotel, but Kerala, being God's own country, it has 6 hotels. So that's how tourism took off in Kerala. So we need to push that in a much bigger way. I'm a believer not in private-public, but I believe in private-private partnership. Get the government out.
Get the government out and create more private sector enterprise and private entrepreneurs in this space. But let me go back to that big number that you threw to this audience with much applause, Mr. Kant. 20,000 crores, you believe is the ask that they should have for the government. What should you do with the 20,000 crores if the government were to sign off on it?
Can you believe it? A country, large country like India, having a budget of 3 crores for tourism? I mean, it's absurd. A budget of 3 crores. I mean, it's nothing less than 20,000 crores to penetrate US market, respond to Trump via massive Incredible India campaign in United States of America. Yeah. Do it in Europe, do it in the Far East, get tourists from all over the world to actually experience the massive transformation that Mr. Modi has brought about in India in the last decade.
So if I
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Ritu Singh. These are the top headlines from the startup space. Premium electric motorcycle maker Ultraviolet raises $21 million in its latest funding round. This funding was led by deep tech investor TTK Ventures and existing investors including Zoho Corporation and Lingotto.
Entertainment AI startup Dashverse raises $13 million in a Series A round led by Peak 15 partners with support from Z47 and Solaris Venture Partners.
Luxury vacation rental platform Elivas has raised over $10 million in Series B round led by Vertex Ventures. Founded in 2023, the company aims to transform second home ownership and the luxury travel experience.
US President Donald Trump has hinted he may allow Nvidia to sell a scaled-down version of its next-gen GPU chip in China. The move follows the chipmaker's agreement to share 15% of its China sales revenue with the US government. This comes despite ongoing concerns over Beijing's potential military use of A1 technology.
The Department for Promotion of Industry and Internal Trade has signed 2 MOUs with Hero MotoCorp and Zepto to boost early-stage startups. Selected ventures will get a chance to work on paid proofs of concept, paving the way for successful pilots and greater market exposure.
Those are the headlines that we're tracking for you today on Startup Street. Now, Dashverse, which is a full-stack AI entertainment company developing platforms for mobile-first entertainment, has announced that it closed a $13 million Series A funding round, making it the largest Series A round in the sector. The round was led by Peak 15 partners with participation from returning investors, Z47 and Solaris Venture Partners. The milestone comes as Dash Reels, which is their newly launched micro-drama app, surpassed 5 million downloads within a month of launch. But for more on the company's growth prospects, joining me now is Sanidhya Narayan, who is the co-founder and CEO of Dashverse. Sanidhya, welcome to Startup Street. Thanks for your time here. $30 million, the largest Series A we've seen in this sector. What convinced the investors to back you at this scale, and how does this now position you for the next phase of growth? Sanidhya, we're unable to hear you. I think you're on mute.
Hi, Ritu. Thanks for having me, and I hope you can hear me now.
Yes, go ahead.
Thank you so much. Yeah, I'm really grateful to our investors, Speak, Z47, and Stellaris for showing the trust in Dashwords. And the trust comes from what we have been doing for the last 2 years, and we have been building in AI, and building the comics app first with a Dashwood Studio, which was like making comics with AI, and it was like first in the world product that could actually use generative AI, and any creator could use it to make their comics. And now we have launched Dash Reels, which is very focused on India, and we want to truly build a lot of leverage on the creator ecosystem by also providing a Fremio. Fremio is a web application which is state of the art. It lets you create serialized episodes using AI tools, all of them combined. And I would just add that we have created 2 technologies which are in-house that focuses on character consistency, which is a big problem in the AI world. So the images or the videos that you create, you are not able to get the consistency in the characters. And that is why storytelling with those models is really tough. And that is the problem that we have solved with Fremio. So you could tell your story, you could get the same character, even if you make a small video or a movie over there. So yeah, that's the technology we have built. We have a very competitive and very smart engineers working for our company.
Got that.
Yeah.
Well, Sanidhya, we're left with little time. So briefly, how are you going to allocate this money, between, AI, R&D, product innovation, creator acquisition? I mean, what is the expected payback period for these kind of investments as well?
So our Dash Reel app, which is the microdrama app, is doing really good. And we really have a great product market fit with the consumers. So the majority of investment is actually going to go into R&D, almost 60 to 70% of the money that we have raised. And we are going to continue building the cutting edge technology. And our goal is that from India, we'll make the best AI creator ecosystem in the world.
All right. You spoke about Dash Reels that hits 5 million downloads in about a month. How much of this is really organic versus marketing driven? And what is your retention curve looking like after this initial spike?
So we have this app live for almost 2 months, and last 1 month saw a huge surge as the content started getting added on Dash Reels. The retention curve is actually much stronger than we anticipated, because in just first month we get something like a 12% retention on D30 for our consumers. So I mean, it's going to be $100 million product in the next 6 months. That is what I believe. It's going to be the number 1 downloaded app in India pretty soon. In a month, it is like number 3 already on the Play Store.
All right. You're running an integrated ecosystem from AI creation tools to, this consumer-facing app. Where is the bulk of your current revenue really coming from, and how do you see that mix evolving over the course of the next year or 2?
So the most of the revenue that we make today, or we are going to make in future, is going to be through the consumer-facing apps, which is Dash Reels, where consumers can pay a subscription and consume content. On the creator side, we want to keep it as subsidized as possible. So we don't want to burn a lot of money apart from R&D. But we are not very inclined towards making a lot of revenue from there. We truly believe that we want to democratize the supply. Running a 2-sided marketplace is tough. But once it starts moving, I think even the creators and the company will start seeing fruits from it. So yeah, revenue should be Dash Reels, and Fremio should be the one-stop solution for all the creators across the country.
All right, Sanidhya, we have a lot more questions, but unfortunately we've run out of time. Thank you very much for being here on Startup Street. It's been a pleasure speaking with you, and we will, of course, follow your journey.
Thank you so much for having me.
Well, moving on to the hot seat segment now. The sleep company, known for its patented smart grid mattresses and ergonomic chairs, has raised 480 crore rupees in Series D funding led by private equity firms Chris Capital and 361 Asset. From an online-first disruptor to a 150-store omni-channel brand, it has hit an annual revenue run rate of 700 crore rupees and is growing at 60% year-on-year. The fresh capital will power new manufacturing units, a deeper offline presence, entry into new comfort categories, all while doubling down on R&D and product innovation. Joining me now to talk about building the future of comfort tech is Harshil Salot, the co-founder of the sleep company. Harshil, welcome back to Startup Street. Now, this round comes on the back of strong momentum. Like I mentioned earlier, 60% year-on-year growth in FY25, 700 crore ARR and doubling monthly revenues since your last raise. Tell us what has been the biggest growth driver, Harshil.
Shruti, thank you so much for having me here. It's a pleasure to be here. I think a growth over the last few years has been driven down by mainly three things. One has been our amazing omni-channel strategy. Over the last few years, we've done a lot of work on that, which includes everything from figuring out where to open stores, how do you drive traffic to the stores, and ensuring the value proposition at the stores is so compelling that we have the best-in-class conversion rates. The second thing has been a constant obsession on the product. Smart grid technology is a material-based innovation. And if you look at any comfort material, it is far ahead of the curve in terms of the features that it offers. And the third and the most important real focus for us has been on consistent brand building and standing truly for a very, very disruptive and an innovative company that, we are trying to build.
All right. With the fresh funds raised, Harshil, you plan to invest in manufacturing and building new categories. What new capabilities are you adding on the manufacturing front? Give us a glimpse into what the new comfort categories might be.
Sure. So, Shruti, the vision for the sleep company is to really step change the way people sleep and sit. And all our investment is going to be focused on creating products which can really improve those two parameters. So, we're just completely coming up with a new greenfield facility in our Bangalore unit, which is going to increase our capacity by almost 3x in that geography. At the same time, we've launched two very new categories and new products which are gaining a lot of traction. One is that of adjustable desk, which is used to ensure much better ergonomics and better productivity. And the second product that we've launched is a massager sofa. We believe that those products are really, really innovative and the need of the hour today.
All right, Harshil. So you plan to focus on extending your patented smart grid technology into everyday use cases and as well as strengthen core teams. You have gone from 650 to over 1,500 employees in just a year. Tell us how you're building the right team and culture to keep pace with this growth.
Yeah, so I think Priyanka and I focus very, very strongly on building a great organization along with a great business. One thing that we've done is we've given ESOPs to a majority of our employees, and I'm happy to also inform that we will be conducting a third round of ESOP buyback. We focus a lot on ensuring that our policies are best in class and very, very employee friendly. And that really helps us keep the motivation high for all our team members. And we are committed to creating value for them as we go forward.
Okay. You've also just opened your 150th store designed as a sleep lab with interactive zones and science-backed trials. Is this the future of retail for you, Harshil? And, more experience-driven, less transactional? And what impact do you expect this to have on customers?
At TSC, we strongly believe in the concept of experiential retail. We believe these products in India were sold like commoditized products. And through great customer education and great customer experience, you can actually convince the customers to buy the right products for themselves. The awareness levels of these products have been very low, and we are trying to change that by giving them great experiences. So we believe that this is the start of the journey for these kind of products, and we have a long way to go.
Offline retail now contributes 70% of your revenue. What is your expansion playbook from here, Harshil? Which new geographies are on the radar?
So, Shruti, we've been having more than 150 stores, and we are adding one store every 5 days in the country. We are currently present in 45 cities. So the expansion strategy is twofold. One is go deeper in our existing cities, the top metro cities, and add more density, and at the same time go wider and get to more than 100 plus cities across the country.
You know, Harshal, sleep has moved from a low involvement purchase to a lifestyle choice. What's driving this premiumization in India's consumer mindset, and how do you see the comfort tech space evolving over the next 3 to 5 years?
So, Shruti, if you see, India is actually the second most sleep-deprived country in the world. And today we see a lot of people who come to us in their 30s and 40s suffering with some kind of back pain, shoulder pain issues. So we believe that great sleep, great ergonomics is the need of the hour. We believe the awareness levels is just creeping in, and it's just going to explode over the next 3 to 5 years. Comfort is going to be a necessity and not a luxury. And I guess everyone needs to definitely deserve great sleep and great comfort when it comes to their lifestyle. So I personally am extremely bullish on this particular category.
Absolutely. You know, one final question, and if you could answer that quickly, you've set a goal of becoming a cash positive, innovation first business. What is the timeline, Harshal, that you've set for yourself for achieving that?
So we've just turned EBITDA profitable in our last quarter, and the idea is that over the next 3 to 4 quarters, continue to focus on that and also turn cash positive. So I think it's not very far away from where I'm looking at.
All right. On that note, it's time for me to wrap up this conversation. Many thanks, Harshal, for your time on Startup Street, and wish you the very best with all your growth plans.
Thank you. Thank you so much, Shruti.
Well, also on Hot Seat today, Hyderabad-based Turbo Hire, an AI-powered recruitment automation platform for enterprises, recently raised $6 million in Series A funding led by IVCap Ventures to take its enterprise-grade platform global. To tell us how Turbo Hire is turning hiring into a strategic advantage with its advanced agentic AI and deep HRM's integrations, joining me now are Deepak Agarwal, the co-founder and CEO of Turbo Hire, and Vikram Gupta, the founder and managing partner at IVCap Ventures. Also with me is my colleague Ritu. Deepak and Vikram, welcome to Startup Street. Deepak, let me start with you. Before we talk about your Series A funding, let's understand your model. You talk about agentic AI and a single configurable platform for all hiring scenarios, you know, from high volume walk-ins to C-suite searches. How does this change the game for large complex enterprises, and what kind of efficiency gains are you delivering?
So glad to be here, Shruti. And Motilal Oswal, by the way, is one of our customers. Just notice that. Today in every industry, any person you have on your payroll has a smartphone in his or her hand. What Turbo Hire does is to create an AI-powered digital hiring ecosystem for the mobile-first world. Now, if you look at our customers like Cipla, Lenskart, Pine Labs, and Seat or Tata Motors, you have people who are lining up outside your manufacturing plant, or people in the field sales, or people in the corporate. They all need a very high responsive hiring system by which you need to interact with them, you need to engage with them, and you need to onboard them. Where the data is too high, you need AI, and where there are too many repetitive tasks on recruiters for multitude of candidates, you need automation. Now, on this platform, which we have enabled these experiences, and therefore, for Cipla, for example, we help them with their manufacturing hiring in different plants in Sikkim and Goa. We help them hire their field sales across the country. And we also help them hire in South Africa and US using the same platform, which they can configure for their country or the function hiring needs. Now, agents.
Well, Vikram at IVCap. Sure. Deepak, sorry, if you could conclude, we're running out of time. Yes.
Yeah. So it is the configurability of the platform which is helping it service financial services companies like Motilal, also manufacturing companies like Cipla and Tata Motors, also the fast growth startups like Ola and Lenskart and others. So we have really created an enterprise-grade platform to change the 3x faster hiring outcomes for our enterprise customers. And if you can hire 3x faster, you can maintain your business plan integrity. And that's why customers are adopting us.
Sure. Sure. Vikram, you've backed several category-defining businesses. What really convinced you that TurboHire is the right fit for leading an AI-led hiring transformation? What got you to sign the check?
This is a fairly large market globally. We're talking of a $7 billion market. Even if you just look at Indian market and look at the overall employment, I think India added about 17 crore jobs across all categories. And if you just look at the blue collar jobs, we're talking about 25 million jobs added over the last 6 years. Just look at the startups, about 180,000 startups today. And just the startups added about 2 million jobs over the last 9 years. And we are looking at about 5 million jobs which will get added just in the startup categories. I think we are very excited about the AI capability of TurboHire and the way it's building the capabilities to just streamline the entire recruitment process and the AI-powered matching engine they have, the intelligent workflows it has created, also the enhanced candidate experience on the platform. All these things actually are not found otherwise in the traditional available platforms. There are quite a few other platforms, but very hard to combine the power of AI with the workflow automation and the potential scale that one can achieve. And we are quite excited about the potential that TurboHire brings to the table.
Well, Deepak, a big differentiator for you has been the deep integrations with firms like SAP, Oracle, Workday. How critical is really this plug-and-play capability in winning these kind of enterprise deals? And very briefly, can you share a real-world example where you delivered a strategic hiring win for a client?
Yeah. So, any large enterprise which moves on people, they will have a HRMS like SuccessFactors, Oracle, or Workday, etc., to manage the internal operations of the people function. But when it comes to the external facing part of the HR function or people function, that is recruitment. And that has to be digital, that has to be consumer grade, and that has to be flexible and fast. To answer your question, it is at PwC that we have been able to provide their partner hiring using TurboHire platform in integration with Workday. Now, the play we have is that TurboHire will handle the entire candidate journey, and the entire employee journey will be on the HRMS, and you combine A plus B, and you have the full stack of people function with just on 2 products. A, TurboHire for everything hiring, HRMS, B, for everything for employees.
Okay.
And that is a beautiful playbook to be replicated across the globe on all the 4 major HRMSs in the world.
All right. Vikram, coming to you very quickly from an investor's lens, if you could tell us where do you see the biggest opportunity for AI in recruitment over the next 3 to 5 years, especially for enterprise clients?
Yeah, I think, as I mentioned earlier, I think one is, of course, the entire automation in the process. I think AI has a huge role to play in not just sourcing the right candidates, but also streamlining the workflows. The challenge also happens in terms of matching the right candidates to the right jobs. And then the other thing which people forget is the experience that the candidates themselves get across the entire process. And typically, if the candidates don't get a good experience on the platform, they don't get a good impression of the company they are recruiting for. Some of these things are very unique that are typically missed out in most of the other platforms. So we're quite excited about the features that TurboHire has created in addition to a lot of intelligence which is built into the platform for various other features.
Deepak, coming to you for my final question, very quickly, if you could answer that. The Series A funding will also go into strengthening product capabilities. If you could tell us what's next on the roadmap, any new AI features or workflow innovations we should be watching out for?
Yeah, so video interviewing analytics is huge. It is making the experience of candidates far better to be in the pipeline. The second is the quality of joining people joiners. That also depends upon the both recorded video interviews as well as live video interviews today. Second thing is the funding will help us make Turbo Hire available across the globe. It's a serious enterprise platform with data sovereignty and data privacy and compliance requirements. And this funding will help us build that infrastructure by which we can take it global. Besides getting integrated on Workday, Oracle, and other softwares. So these two, video analytics plus that platform availability across the globe, will be the big help we will have because of this funding.
All right. Since we're just left with a few minutes, Deepak, if you could quickly share into how, what next is on your roadmap, any specific things we should watch out for from you?
You should watch out for something very interesting, that we are a conglomerate level player now. So some of the biggest conglomerates across companies, across different industry segments within the same conglomerate and across the globe. So our joy is to be that enterprise player besides the biggies in the segment like SAP, Workday, and Oracle, to be helping transform the larger companies and larger conglomerates with one single solution. And what we are doing for that is on 4 fronts. Make that platform usable and compliant in every geography. Second, the AI should work in all geographies and be compliant with New York AI law, California AI law, whatever. And constantly innovate for the candidate experience, as Vikram said. Candidate is the biggest currency. If you don't handle them in a very swift, very pleasant, and very timely manner, they drop out like e-commerce customers. So continuously expanding that experience, these 3 will be our goals.
Well, on that note, it's time for us to wrap up our conversation. Many thanks, Deepak and Vikram, for joining us on Startup Street, and wish you the very best with all your aggressive growth targets.
Thank you.
Thank you so much, Vicky. Okay.
Well, with that, it's a wrap on this edition of Startup Street from both Ritu and me. More news and updates coming up on the other side. Stay tuned.
Well, some of your most favorite ice cream brands, whether it's Cornetto, Magnum or Quality Walls, are set to get a new home under a new company, Quality Walls India. This, as Hindustan Unilever, India's largest FMCG company, is demerging its ice cream business into a standalone listed entity, hopefully by the end of next financial year. Now, what does this demerger entail? What is the rationale behind that? And what is this cool business going to entail? We are joined by Ritesh Tiwari, the CFO of HUL, to talk to Mangalam and me, not just about the ice cream business, but also about HUL, the strategic reset that's happening here, and the new management that's coming in. Well, Mr. Tiwari, thank you so much for speaking to CNBC-TV18. Let's start off by talking about the reason we're here, which is to talk about the ice cream demerger. Quickly run us through the very basic details of the demerger. What is the, what is Quality Walls India going to entail as a corporate entity, as a company? And what's been the basic rationale behind the demerger?
So ice cream overall has a very distinct business model. It runs in cold chain in terms of manufacturing, distribution. It is prone to seasonality more compared to any other business that we have. It also has higher capital intensity compared to other business that we have. This is what makes ice cream very different to the rest of the business. At HUL, it has low synergies because of this very reason with all other categories that we end up doing business with. So that was one reason why we said that we need to have a solution which is very different. So hence, if ice cream is run with a focused management, with different agile strategies which are suited to its own distinctive business model, it can unlock more growth going forward. The decision was that once Unilever globally decided that they will separate the ice cream business and they will end up listing it, we had to, as HUL, take a decision, what do we do with it? The board came to conclusion after a lot of discussion that it is in best interest to separate the business in India as well, and then form a separate company, demerge it, and then list it. Right. This will ensure that all shareholders will be able to participate in the growth story of ice cream in India.
Right. So if you could give us a sense, as delicious as the business idea and the potential and the product sound, it's a very tough business as well, because supply chains, the capital that it requires for you to have a cold chain across the country, etc. If you could give us basic numbers on the ice cream business, it's about 2 to 3% of your revenue right now. What kind of EBITDA margins does it make? What kind of capital is invested in the ice cream business?
Yeah. So ice cream is roughly for us an 1,800 crore business. And it makes, if I look at last few years of margin, it makes low single-digit margin. This is a business now which is in investment phase. We are a national player. We supply ice cream across the length and breadth of the country. And when you do that, the overall cost of running the business is high, which is why a business like this gets a lot of benefit when it starts to scale up. Our business for the last 1 decade has grown in double digit. And going forward, given the headroom which is there to grow of penetration consumption, we expect this growth trajectory to get even stronger going forward. And which is why today, when the business operates at a low single-digit margin on an average, we will get into an investment phase further. So margins will further go a little bit down. But from there onwards, as the operating leverage kicks in, we'll then start seeing acceleration of margin in times to come.
So if you could give us a sense of the capital that has been invested in this business already, because it's housed in Hindustan Unilever right now, I'm sure there are a lot of operational synergies that come by as well, which may not come once it's demerged. So what are the kind of investments that you entail out there? How low can the ROCEs go before they go up, and what are they right now?
Yeah. So the key criteria there is the amount of capex investment. So for a typical FMCG company, let me say Hindustan Lever example, we spend approximately a little less than 2% of our turnover into capital, in capex. Ice cream business operates anywhere from 5 to 7%. Of course, there are years we'll a little more, a little less, but it operates at 5 to 7% capital investment. The point there is you have to further add capacity because of the growth which is happening in the business, and plus the distribution network which you have to set up.
You spoke about low single-digit margins is what you see right now, and then after the investment phase, I think your listed peers does about 5 to 7%, if I'm not wrong. Is that where you would look to get at eventually, or do you think post-investment phase there is scope to expand margins further beyond that?
So if I take margin and make two different components of that, material margin, which is your sales minus all the raw material variable cost, and there's a fixed cost which gets amortized as part of the cost to the entire business. When it comes to material margin, we make industry-leading margins. When it comes to total margin, when you add variable cost plus fixed cost, our margins are lower compared to the benchmark that you quoted. And the reason for that is because we are a national player, and hence our infrastructure is spread. As you start getting more amount of scale further in the business, you start getting operating leverage. So the second component today where we are, let me say, under index compared to market, we'll start getting that component also getting counted in terms of improvement in margin. And once that starts to kick in with further amount of growth and scale, we should be able to reach high single-digit margins.
Right, that's very interesting because, you know, the variable cost that there is, you said, is industry leading already. The fixed cost currently is also shared by the large Unilever, platform. So just trying to figure out if it is individual, then maybe the denominator would be a lot smaller, and as a result of which it will be amortized a lot more.
So ice cream has a separate distinctive business model. So the entire fixed cost for ice cream is ice cream specific.
Got it.
So when I was quoting the example of a fixed cost, this is all ice cream assets. Because ice cream has separate factories, it has separate distribution system, the ice cream cabinet which are in the marketplace that we end up owning either directly or indirectly. I was referring to all this infrastructure which is all ice cream specific. In fact, the synergy with the rest of the business is very limited, especially when it comes to go-to-market. Our sales force, it has a separate sales force on its own. So there is no dis-synergy, let me say, on such operating costs of supply chain that will happen after the demerger.
And what happens to HUL's overall margins, because our ice cream is fairly margin dilutive, and what happens to HUL's own ROCE? How much improvement do you see there?
Yeah, so ice cream overall is 3% of turnover. It's 1% of our profit. So there'll be small improvement in our ROCE and margin after the demerger, but it is small and immaterial, I would say.
Right. And you know, ice cream as a business, though you spoke about the large scope of growth that there is, it is still seasonal in nature.
Right.
And I think you have spoken in the past, and you've been one of the players that's spoken about how you're looking at de-seasonalizing the business. So how do we look at that? Because if an investor is looking to invest in a company, they would want to be able to reap profits or returns through the year. It cannot be in one season. So how are you looking at de-seasonalizing this? And even globally, in fact, for Unilever, ice cream, a lot of investors have been talking about how ice cream as a business there, the consumption is actually coming down. Is India an outlier in that sense? Is the scope actually a lot more here?
Yeah. So two, three different angles to this. To start with, our key strategy has always been for the last few years, how can we start de-seasonalizing the business? Yes. Now, ice cream can be seen as a dessert, and hence it plays a role in the entire post-meal sweet category. It also has a role as a snacking category. And once you start looking at it a little differently like that, you start seeing that there are many occasions more where ice cream can be center of the plate. So at Diwali season today, for example, we have our own variant which has gulab jamun into it, and we end up marketing that at length during Diwali season. For East, when Pujo happens, we have Nolan Gur ice cream. So we have now launched flavors which are relevant during festival season to start to ensure we keep de-seasonalizing. I was quoting an example to you earlier. A US market is much more colder than what India is. Yeah. The per capita consumption there is 13 liter, and we have 600 ml. So the headroom that we have for growing is substantial, and which is why for the last 1 decade, the industry has grown at double digit. Our own business as Hindustan Unilever for quality walls has grown in double digit. And once you're able to focus differently and more going forward, we could end up seeing stronger double-digit growth from the business.
Could you give us a sense of how your sales have panned out across the year over the last many years since you've started to de-seasonalize it? Earlier it was obviously Q1, Q4, and now if you could give us that split. Earlier what it was and post your de-seasonalizing it, or your efforts, how much has it moved?
Yeah, so it's always a gradual move. It will never have a substantial impact. But we keep seeing 100 to 200 BPS move that keeps happening from season to non-season ice cream with every year of effort that we end up making.
So what's the current split right now?
So roughly, I would say little less than half the business ends up happening during the peak of the season, and then the balance business is spread across the balance quarters in the year.
How do you see competition? Because, while you're number 2, we have another very large national player, but we're seeing a lot of the smaller new age D2C brands also that are coming in. A lot of money being pumped in by VC investors also into those companies. A lot of focus on health, low calorie, low sugar ice creams, and they're really taking off, especially thanks to quick commerce. So how are you looking at the competitive scenario? And does that then now, with Quality Walls India also having its own business, its own focus, does that also open up avenues for M&A?
So I quoted one of the statistics earlier. So we have our own direct or indirect 2.5 lakh freezer cabinet. Yes. As an industry of ice cream, we have a little more than 1 million cabinet out of the 12 million outlets which are in the country. So more players start to participate and help support and increase the distribution infrastructure. Every player in the market will end up benefiting from that. Given the per capita consumption is so low this point in time, there's enough headroom for multiple players to coexist. Ice cream is a business which also has much higher amount of innovation compared to typical FMCG business. What we have done, we focus squarely on innovation for the last several years. And as and when required and relevant, we keep getting also brands from the stable of Unilever into India. Going forward, same thing will happen with the Magnum Ice Cream Company, which will ultimately be the owners, or majority shareholders of the business in India. We will end up having access to the biggest global ice cream company, the brands from them, the tech from them, R&D from them. So innovation will continue to be exciting. That's what will determine the growth trajectory and competitiveness of the business.
Do you have to pay a royalty to the Magnum Ice Cream? And
so today as HUL, we have a royalty contract, which is for all the categories that we deal with in Unilever. And once ice cream gets separated, our current contract runs till January 28. So we're going to pass on the royalty contract, which is all three components. It is component for the brand trademark. The brands that we have in India today, Quality Walls, Magnum, Cornetto, these brand trademarks are owned by Unilever. So the access and license to these trademarks will be passed on to Quality Walls India Limited under the same arrangement, existing arrangement that we have. Today, the R&D is a shared R&D across Unilever globally, and which is why, as part of the royalty contract, we also have a royalty contract on technical services that will also get benefited. The Quality Walls India Limited will continue to have access of that as well. And third, importantly, going forward, the innovation and trends, so those benefits will be there for the ice cream business as well. After the demerger is completed in India, and once the global company gets also listed, and they might end up getting into a new relationship of royalty with them later point in time. But as of now, we are equipping the Quality Walls India Limited with access to brand rights, technical know-how, with innovation and R&D capability and leadership from the biggest global ice cream company.
And by when do you expect this entire exercise to complete and shareholders of HUL to get Quality Walls shares in their demat account?
Yeah. So our entire demerge is a court-driven process. We have now got the first motion from NCLT. On 12th of August, we have a shareholder vote to review, and we are proposing for approval for the demerger. Once we get shareholder approval, there are other regulatory steps we have to do. We expect by end of this financial year, the business to get demerged and listed.
Right.
And start trading as well.
Hello and welcome to this special edition of the State of the Economy. I'm Lata Venkatesh. The CPI inflation for July has come in at 1.55%, okay, 1.6%. This is the lowest reading in 8 years. The last we saw it was in June of 2017. It is nevertheless a little above the CNBC-TV18 poll, which had actually predicted a reading of 1.3%. It's food prices, perhaps, that have come in slightly higher than what we thought. The poll had expected that food prices would fall by 2%, deflation of 2% year on year. The deflation is by 1.76% year on year. Just a couple of highlights in the food basket itself. The important point is the two weighty items, cereals and pulses, are falling even month on month. A little unusual, because as you head into the monsoon season, because of possible dislocation of the monsoons, you actually see food prices rise a bit. But we are not seeing this in the case of cereals and pulses. Early and robust monsoon is actually casting a dampener on even food price expectations. So we're seeing these two heavyweights falling, but it's kind of compensated by edible oils, which have been rising year on year. It's, I think, a rise of 19% or thereabouts, and vegetables as well, up 11%. The reason for the edible oil prices rising is because of the increase in tariffs on these items. Vegetables are higher month on month, but year on year, again, there isn't much to complain. Vegetable prices are down by 20% because a year ago we had seen a sharp rise in the prices of potatoes and onions. Those two under control at this time, but still we are facing higher prices as we know under normal conditions. If you take away the base, vegetable prices are not all that low. The impact is really a cereals and pulses deflation, which has brought down the overall food prices. Core inflation is at 4.1%, lower than the 4.4% that we saw in the month of June. And in core inflation, it's really gold, which is still higher and is adding a bit of pinch to the inflation numbers. Those are the initial points that we are getting from the data itself, but we will have more observations from the guests who are joining us. I'm joined by Devang Shah, who is head of fixed income at Axis AMC. The bond market reaction has been actually quite the opposite. Instead of a 1.5 number, a low inflation bringing yields down, we've actually seen yields rise to 6.47. So Devang, important. The economists joining us are Aditi Nair, chief economist at ICRA, Madhavi Arora, chief economist at MK Global Financial Services,